people, happy morning once again. Apologies, I forgot to do the recording, so we are restarting this. So as I said, the agenda for today in FM Marathon is covering two important topics, that is investment decision and working capital management. So we'll directly start with investment decision wala topic. Now, investment decision, right? We take in FM investment decision, we take with the help of a small technique. What is that technique called, people? Capital budgeting technique. This is what we use. This technique is what we use for investment decision process in FM. Okay. Now, why is this technique necessary? Why the necessity becomes important here is because these decisions are not way too simple. It will have a large or a big time wala consequence. Just to give you an example, let's say company wants to do, for company to do a particular project, they want to buy a machinery. One option is that machinery can be purchased in India itself by paying how much rupees? 8 crore rupees. And this particular asset ka useful life which is purchased from Indian vendor is 8 years. And if you buy it in India, you can use it for how many hours a day? 10 hours a day. But another option is, instead of buying it locally, we can import it from Japan, let's say. If you import it from Japan, instead of 8 crore, it will cost how much? 9 crore Indian rupees. But the life, instead of 8 years, it will be 8 years only. But instead of 10 hours a day, you can use it for 12 hours a day. Now, if you are the finance manager or finance damager of this company, which one will you go for? Local or importer? Local or importer? Is it straightforward or careful analysis is required? Analysis is required. That analysis only we do it. That analysis only what we call it as what? Capital budgeting technique. Because this outflow looks small. No, this is a huge amount. And moreover, this decision is impacting what? 6 months, 1 year or 7-8 years. Sometimes you can have an impact on 15 years, 20 years and all. So it will have a long-term consequences, and even the outflow is also very, very high. Hence, you need to carefully analyze, then only take the decision. Hence, these techniques are required. That is the significance of investment decision. Okay, sir? All right. The next one is, sir, capital budgeting is the main technique. Under capital budgeting, we have many methods. Right? Some we call it as discounting method. Some we call it as non-discounting method. But we'll come to that in a bit. Whichever method we use, almost all the method, take the decision not based on profit. Not based on profit, but based on what, sir? Cash flow. For every capital budgeting technique, we have to estimate something called what? Cash flow. Because majority of them use this. Why is that is? Sir, P&L that you prepare as per accounts. How do you prepare? How do you get profit? Income minus expenditure. Your P&L will include non-cash expenditure also. Like example, depreciation. Right? All this non-cash expense, non-cash income also will be considered for P&L purpose. But when it comes to investment decisions, you are actually investing money. So we don't want profit. We want actual what? Cash flow. How much is the cash inflow? How much is the cash outflow? That is what we are concerned for with respect to the investment decisions. Okay, Nasarji? Now, this cash flows, what makes the investment decision a 10 marker or a 14 marker question is cash flow will not be given to us in the problem. We need to estimate. What they will do is they will give you many incomes and many expense. From those income and expense data, we will have to estimate cash flow. How do we do it? Very simple. First start with, you can have various things. You can prepare your normal income statement. First is sales minus variable cost is contribution. Contribution minus fixed operating cost is EBIT. Like that you can maintain, or simply you can write, start with sales and reduce all the expense. You don't have to give the heading, this is variable cost, this is fixed cost and all. You can just simply say from sales, if you reduce all the expense, that expense could be variable cost, fixed cost, interest, depreciation, whatever. From sales, if you reduce all expenses, what are you going to get? Profit before tax. From profit before tax, reduce tax. What are you going to get? Profit after tax. So first step is to derive PAT. Profit after tax. Okay, sir. After this, people, 5 adjustments. How many? 5 adjustments. Add back depreciation. First, I'll tell you. Then we will discuss why do we do these adjustments. First, find out PAT. From that, what do you do? 5 adjustments you need to do. First is add back what? Depreciation. Then OVAS. What do? Chaminda Vasu. OVAS. OVAS we need to add. O for opportunity cost. W for working capital, A for additional capital or investment, S for it could be salvage value, it could be subsidy, or it could be short-term capital gain or loss. So from this, from earnings after tax, if you do add back depreciation and OAS, then the final number what we're gonna get is what we call it as what's it? Cash flows. This cash flows is what we take for investment decision topic. Majority of capital budgeting techniques base their analysis on cash flows. Yes, sir, people. This becomes your 1 or 2 working notes. That makes this problem little lengthy or little bigger. Otherwise, it's pretty straightforward. Done, Sarji? Now, I'll discuss why do we do all this one by one. First, you got to know why we take cash flow and why we don't consider profit. Why don't we consider profit for our decision making, people? Because what is the topic name? Investment decision. Investment will involve what? Inflows and outflows. That's the reason we are interested to find the cash flow for analysis purpose and not a profit. Okay. All right. Now that is one. First step. Why do we add back depreciation? Why do we add back depreciation? It's a non-cash expenditure. So that means why should we consider? Sir, you will pay tax to the government after deducting all the expenditure. First, to find out what profit after tax, you have to reduce all expense. All expense will include what? Depreciation. But did cash go out? See, you already reduced depreciation here. Suppose you have reduced 1 lakh depreciation. Did 1 lakh cash go out or it did not go out? But you already reduced. Hence, what to do? Add back. We have to reduce depreciation for what purpose? Tax purpose. Once the tax is already paid, due to depreciation, cash outflow did not happen because depreciation is a non-cash expenditure. Hence, the first adjustment is what? Add back depreciation. That is one. Second one, opportunity cost. Opportunity cost means, what is the meaning of opportunity cost? Cost of letting go something. Cost of sacrifice. Or you can simply say it's a sacrifice cost. Like I used to give same example in class if you remember. Now I'm teaching. I'm getting teaching income. But am I working in corporate? Am I working in corporate or am I teaching now? So that corporate salary I am getting or I'm sacrificing? Sacrificing. So that corporate salary, whatever I'm letting go or whatever I'm sacrificing, is what we call it as what? Opportunity cost. For accounting purpose, opportunity cost we don't consider because this is actual or notional. Now my corporate salary I am getting or I am not getting. So that particular, suppose if I worked in corporate, let's say my monthly salary would be 3 lakh per month. Let's assume. If I worked in corporate, you're looking at me differently. Okay. You want me to add one more zero? Or you're saying for your face cut 30,000 only is more. You want to make it 3 lakh or 30 lakh? 30 lakh, 3 crore. Okay. Fine, fair enough. Suppose if I worked in corporate, my salary would have been how much? 3 lakh. Am I getting this or am I not getting? It means I will not pass any journal entry for this in my accounts. But suppose if I am starting, suppose I want to quit teaching and start something else. Will I ignore this or consider this? Because I know that if I quit teaching, I can go back to corporate. My corporate by minimum, how much I will get? 3 lakh. That means whatever next I'll start, whatever next business I start, minimum I will expect how much? 3 lakh. Right now, if I'm getting more than 3 lakh, then I'll think about starting a new business. If I'm probably getting less, then maybe I'll go back to corporate. So whenever you're taking decision making, this opportunity cost or the sacrifice cost will be ignored or it will be considered. Hence, in FMA, opportunity cost will always get considered. That is point number 1. So you have written plus minus here. Yeah, opportunity cost can be on the inflow side or it could be on the outflow side, depending on the problem. That's the reason either we will add or we will minus. Like in my example, corporate salary I am getting or I am not getting. One benefit I am not getting. If I am, that means it is what, sir? Inflow ka reduction is happening. Benefit is an inflow, correct? Am I getting that inflow or I am not getting? So if I am not getting one inflow means it will become what? Minus. Because I am not getting this. It's as good as reduction in inflow. Reduction in inflow you can call it, or you can simply call it as a outflow. So if one income, if you are sacrificing, what you will do for your analysis perspective? Minus. One expense if you are sacrificing. Suppose currently we were factory, we were generating some waste. From factory we were generating some waste. That waste, we used to appoint a contractor. Contractor used to come and clear all our waste. Contractor used to come up to our factory and clear out all our waste. I used to pay 1 lakh for that contractor every month to clear this waste. Now I decided I will use that waste to produce another product. Now what did I decide? I will take that waste product, garbage I will take and make it into what? New product. Now you tell me, should I have to pay 1 lakh money to contractor or I will save this? This is what? Income saved or expense saved? One expense you are incurring or saving. Then opportunity cost will become what? Plus. So the opportunity cost can be on the inflow side or it could be on the outflow side depending on the question. Hence I have written it as plus minus. Okay, Sarji. This is one. Next is something we'll have to consider is OVAS. O may again what people tell me once again. O for opportunity cost. W for working capital. Now we're going for W. W as in working capital. Now you tell me when you want to start a particular project. Now ArivuPro. Let's say we want to start a new branch. We need a building. We need our fixed assets like our whatever, like laptops, so AC and all. Is that the only thing we need or we need employees also? We need to incur what? Rent, electricity also. All those are what? Day-to-day expense, which we call it as what? Working capital. So in order to start a business, you need capital investment also. You need money for day-to-day business also. So now you tell me, when you invest for working capital, money is coming in or money is going out? So when you start a project for working capital at year 0 in FM means what? Year 1 beginning. When we say year 0 in FM, it means year 1 beginning. At year 1 beginning, working capital, you will consider it as a negative. Why negative? Because company is investing the money. Cash is going out. Now suppose we invested some money for electricity means by doing CA project, will we let go of this or recover this cost also? While doing business, every cost we want to recover. Whether it's a revenue cost or whether it's a capital cost, everything we want to recover along with what? Profit. Hence, at the end of the project, you will take working capital as what? Positive. Fine. Because by doing a project, every cost we want to recover. Sir, you should recover working capital only at the end of the project, sir. No, you might recover working capital within first year only. Or you may recover within second year. Which year recovery will happen will not be given to us in the problem. Hence, we assume what? Working capital is recovered at the end of the project. Hence, at the end of the project, we take it as what? Positive. So, if you wanted a simple formula, working capital at year 0, you take it as minus. End of the project, you take it as positive. That end of the project could be year 5, year 10, year 7, depending on the problem. That is your W as in working capital. Next is what, sir? A for what? Additional capital or additional investment. Now, if you're doing a big project, full amount you will invest at starting only or you may invest at multiple installment. Multiple installment. Yes, no. So that is your additional investment. That additional investment, when it will come? It may come at the end of first year, end of third year, end of fourth year. Question will specify. So your additional investment means it's an inflow or an outflow. If company is investing additional money, money is coming in or money is going out? Going out. So additional investment, what will you take it as? O over, W over, A over. Last is what? Salvage value. Now, if you have a machinery, at the end of useful life, what will you do with that machinery? Sell it or scrap it. So that time what? You will get some money. That we refer to as what? Salvage value. So salvage value for a company is an outflow or an inflow. When will you get salvage value? Every year or end of the project? At the end of the project, whatever is the ending of the project, depending on the problem. That last year you will take salvage value as a plus. Are we okay? This is one. And also subsidy. Subsidy is again a specific adjustment. Sometimes when you do a specific project, government will give you some money. That we call it as what? We can call it as subsidy, government grant or whatever. So that grant for a company, it's an outflow or company is getting it. That means it is what? Inflow. So even this subsidy, I've just put it at क्या वो? हाँ? नहीं मेरे पास नहीं है. अखिलेश सर ने नहीं दिया मेरे को. शायद उनके पास होगा. पूछ लीजिए. Okay. So subsidy you are receiving from the government. So it will be what? Inflow. So which year you will receive? Question will specify. Maybe first year, maybe second year, or maybe at the end of the project. We don't know. I've just written it at the end. It could be received at any year. That is one. STCG, STCL, you have done it in tax. Full form is what? short-term capital gain or short-term capital loss. This maybe I'll tell you when we go to the problem. One specific problem, I'll cover this. Now I'm just giving you an overview, okay? Then we will discuss all the methods. Again, the thought process is once all the concepts quickly we'll revise like this. Then we'll take up based on the time, some about 6-7 questions I'm planning to cover, which will target all this. Okay, na Sarji? That's our agenda. Okay. All right. Thank you for online for still sticking around. Next, I think we've covered all this. And now, by doing all this, what are we going to get? Cash inflow. Give me a quick summary again. What are we doing over here? Which technique are we using? Capital budgeting. Most of capital budgeting works on profit or cash flow. How do you get cash flow? From income, reduce all the expenses. You will get profit before tax. Then reduce tax. You will get profit after tax. Then 5 adjustments. What are those? Add back depreciation. Why are we adding back depreciation? Because initially you have reduced, but cash did not go out. Hence, add back. Then OVAS. O for opportunity cost. W for working capital. A for additional capital or additional investment. S for salvage value, subsidy, STCG, STCL. Maybe all the 3 may come. Maybe only 1 will come or maybe nothing will come. Depends. Fine, people. By doing all this, the net number, the final number is what we call it as cash flows. This cash flow could be positive or it could be negative. Usually, obviously, if you're doing a project, you do expect some cash inflows to happen. So you ideally expect this number to be positive. Done now. Now, if you're doing a particular project, all the cash flow, you'll get it in first year only. Now, that means all these cash flows are on what platform? Future value platform. Suppose you're running a project for 5 years. You're running a project for 5 years. That means all these cash flows are what? You'll get it immediately or over a period of 5 years. Means all these cash flows are on what platform? Future value platform. Are you deciding, making the decision in future or now? If you are deciding that, if you're making the decision today, we want future value or we want present value? Present value. From future value, how do you get present value? Multiply something called discount factor. Take the future cash flows, multiply by the discount factor, which will be given to you in the question. Then you will get what's a present value of cash flows. This is the funda. Okay, Sarji? Okay. Now let's move on to the next one. Now we'll directly go into some techniques. So first sort of technique for capital budgeting is non-discounting technique. Another name for this is traditional techniques. Some of them are payback period, right? Your accounting rate of return, etc., etc. Or maybe we'll go one by one. What does payback period mean, people? Name itself is saying payback period. It means, what is the meaning of payback period? In how many months or in how many years we will recover our initial investment. Suppose we invested 10 lakh. For a particular project, we invested 10 lakh. In how many months or in how many years the company will recover 10 lakh. Such a period is what we call it as what? Payback period. You can express this in months or in years or whatever. Usually payback period we express in years. It can be expressed in months also. Fine, people. How do you calculate payback period? For that, first check if your annual cash inflows. Previously you calculated annual cash inflow. Whether it is same every year or fluctuating. Whether the annual cash flow, whatever you're getting, is it constant? Yes or no? Need to check. If every year annual cash inflow, if it is same, then payback period is simply given by the formula initial investment divided by annual cash inflow. Like suppose you invested 12 lakh. You invested to start a project, we invested 12 lakh. Now suppose because of this project, how much inflow you are getting every year? 3 lakh. Because of this project, every year you are getting an inflow of 3 lakh. Tell me in how many years will you recover this 12 lakh? You have invested 12 lakh today. Every year you are getting 3 lakh means how many years it takes to recover 12 lakh? 4 years. Now tell me that formula. How did you get 4? 12 lakh divided by 3 lakh. What is 12 lakh? Initial investment. What is 3 lakh? Cash inflows. So hence payback period is simply given by the formula initial investment divided by your annual cash inflows. This formula works when what? When cash inflow every year is same. But possible that cash inflow can change. If cash inflows is changing every year, then we don't use formula. We use something called cumulative approach. We use what approach? Cumulative approach. Cumulative means what? Adding up. So suppose, let's say 5 years, this is the cash flow. First year you will get 1 lakh. Second year, 2, 4, 5, 6. This I've assumed. Now how do you calculate cumulative cash flows? Add. First year, how much cash flow totally you got? 1 lakh. Second year, how much did you get? 2. second year you got 2 lakh, but till second year totally how much cash flow you recovered? Second year you recovered 2 lakh. First year you already recovered 1 lakh. So totally how much? 3 lakh. So by the end of second year totally you have recovered how much? 3 lakh. That's how you do the cumulative cash flow number. So third year ka cumulative number will be what? This 3 lakh plus 4 lakh. How much is that? 7 lakh. This 7 lakh plus 5 lakh. How much is that? 12 lakh. This 12 lakh plus 6 lakh. How much? 18 lakh. How much did you invest for the project? 12 lakh. Now check, is this 12 lakh appearing in any years? Yeah, this 12 lakh is appearing in which year? Fourth year. That means that fourth year only becomes what? Payback period. Like that. Under cumulative approach, this is what we look for. Done, Sarji? Suppose initial investment is 14 lakh. Suppose initial investment is 14 lakh. Now you tell me 14 lakh is appearing anywhere here. Is 14 lakh appearing anywhere here? No. In that case, no, what to do? Very simple. Up to fourth year, how much you have recovered? 12 lakh, right? Up to fourth year, you have already recovered 12. But your initial investment is how much I have assumed? 14 lakh. That means 14 lakh, can I say it's somewhere between year 4 to year 5? 14 lakh is between 12 lakh and 8 lakh. Yes, sir. 12 lakh and 8 lakh is between what year? Year 4 and year 5. That means payback period is somewhere between year 4 to year 5. How do you do is take the lower number between year 4 and year 5. Which is the lower number? Year 4. So the formula is take the lower year plus required cash flow divided by actual cash flow. Lower number plus what? Required cash flow divided by actual cash flow. Between 4 and 5, which is the lower number? 4. Plus required cash flow from 12 lakh, how much it should become? 14. From 12 lakh, it should become 14 lakh. Means how much is the required cash flow? 2 lakhs. That is the required cash flow. How much is the actual cash flow you achieved in 5th year? 6 lakhs. So that means payback period here will be given by what formula? 4 plus required cash flow is 14 lakh minus 12 lakh, which is 2 lakh. Divided by actual cash flow for 5th year. How much is it? 6 lakh. Do this. How much is it? 4.33 years. Huh? 4.33 years. That's your payback period. You'll take in Coimbatore. Yeah, ma. I mean, taking in Coimbatore only. Yeah. Coimbatore, you know, this one is. Last time I checked, this was Coimbatore only. But you have any doubt? Huh? Yeah. All right. Yes. Yeah, we'll be covering some LDR question also. Okay. Please share FM. FM question bank. Okay, fine. I'll ask the team. Okay. It's anyway from the class notes. Don't worry, I picked up majority of the questions are from study material and some RTP. I'll give you the code, at least a reference of it so that you can use it in case you're watching the marathon. And people, this marathon will be uploaded later on YouTube also. So it's available. You can cross-reference it later in case you need it. Okay. First, is this part okay for everybody? Now you tell me for payback period, is there any question required or we sorted this? This example is good enough, I think, now. Right? If it's a simple one, I'll try to cover it with an example. If there are some complications, we'll take some better questions. Are we okay with this approach? Okay, done. This is done. Next, after payback period, related to payback period, one more is there called payback reciprocal. Name itself is saying payback reciprocal. How do you get reciprocal? Inverse, ulta. So if you want to get payback reciprocal, simply you do 1 divided by payback period. 1 upon payback period if you do, that number only what we call it as payback reciprocal. That's a way to calculate. Why do we calculate this is, there are some analysis which proves that payback period, or rather payback reciprocal will be more or less equal to IRR. Payback reciprocal, what you call, suppose you calculated payback period as 5 years. Do 1 divided by 5. 1 divided by 5 is 0.2, no? Or if you want to express it in percentage, 20%, correct? Okay. This is what? PR. PR as in payback reciprocal. What some theory says is, how much are you getting as payback reciprocal? 20%. Some theories argue that if payback reciprocal is 20%, then IRR, another technique, we know this, we have done. IRR means what? Internal rate of return. So if payback reciprocal is 20%, then more or less IRR also will be 20%. These are some analysis which they have done. Sir, if they ask IRR in the question, can I calculate like this, sir? No. If they ask IRR, you have to calculate in the normal way. If they ask a theory question on payback reciprocal, you need to put some blade. This is a blade. Okay, now one formula you write and then one line you write. This is a popular theory question used to come for 2 marker. In some many examination, it is repeated. Fine, people. Okay, one technique is over, which is what? Payback period. Next one, ARR. ARR ka full form is what, sir? Accounting rate of return, or another name, average rate of return, or some may also call it as book value rate of return. Okay. Now this is the only technique. Once again, tell me once again, what is the name? ARR ka? Accounting rate of return. In accounts mein we show what? Profit, right? Accounts mein P&L means it's not cash flow, it is profit, right? This is the only technique which actually uses PAT. Every other capital budgeting, it uses what? Cash flow. But ARR is only technique which is decision making is based on PAT. That's all. This is the only one, right? Okay. ARR ka formula. Anybody remembers what is ARR now? How do you get ARR? Don't look at the screen. Average PAT divided by, either you can take initial investment or you can take average investment. Average PAT divided by either average investment or initial investment. Study material uses both. Your call. My preference is average, because since numerator is on average platform, according to me, denominator also should be on average platform. That's my preference. But ICA uses initial investment also in the denominator. Both are acceptable as per the ICA standard. That is one. Okay, Sarji. Now, how do you get average profit? If they give you 5 years profit, how do you get average? Add all the years profit divided by the number of years. If they give you 5 years profit, add all the 5 years profit and divide by 5. That way you will get what? Average PAT. Okay, this is one. Another way is, sometimes what they will do in the problem is, right, they will give you cash flows. They will give you what? Cash inflows they will give every year. Okay, suppose they give cash inflows for 10 years individually. They have not given, sir, ARR uses cash flow or PAT? PAT. But is PAT available to us in the problem or cash inflow? Cash inflow. Suppose they give you 10 years ka cash inflow they gave. You summed it up. How much are you getting, I'm assuming? 10 lakh. Let's say every year ka cash inflow is 1 lakh. For how many years have they given? 10 years. So totally how much is the cash inflow for 10 years put together? 10 lakh. Okay, na Sarji? Now to start the project, suppose we invested 2 lakh. To start the project, how much investment we made at year 0 or year 1 beginning? 2 lakh. This data is given to us in the problem. And they have asked us to calculate ARR. Now, can we use this to calculate ARR or we need PAT? ARR does not use cash flow. It uses what? PAT. Now, there is a workaround for this. How to do it? If no other information is available, but only if cash inflow and cash outflow is available, what we interpret is inflow, we interpret it as income. Inflow, we interpret it as income. Outflow, we interpret as expense. How do you get profit? Income minus expense. What is the total income? 10 lakh. What is the total expense? 2 lakh. That means what? Total profit is 8 lakh. 8 lakh is average profit or total profit? For 1 year or 10 years? We want 10 years ka profit or average profit? How do you get average profit? 8 lakh divided by 10, which is how much? 80,000. This is another way to calculate the PAT. Understood, everybody? So again, tell me how do you get an average? Normally, how do you get PAT? Income minus expenses. But if that income and expense data, if it is not given, but if what have they given? Inflows and outflow. Then what do we do? Add all the inflow. Basically, inflow you interpret it as income. Outflow you interpret it as expense. All the years ka inflow you add. That becomes your total income. In my example, that is how much? 10 lakh. Year 0 ka outflow you treat it as an expense, which is given as how much in the problem? 2 lakh. So 10 lakh you will take it as a total income. 2 lakh you will take it as a total expense. Total income minus total expense will give you how much? 8 lakh. What is that? 8 lakh is the average profit or total profit? For how many years? 10 years. How do you get average profit? 8 lakh divided by 10 number of years basically, which is 10. So that means your average PAT becomes 80,000. Done now, people? That's another way. This is your numerator. How do you calculate the average PAT? Now, what is denominator for ARR? Tell me once again. Initial investment or average? Initial investment is this. At year 0, how much did you invest? 2 lakh. This is your II as in initial investment. That will be given to you in the problem. Either you can take that in the denominator or you can take what? Average investment. Now, very simple. Oh? I'll just prove it to you that how is this. But don't use this for exam. Oh? There's an easy way, but ICA gives a fancy formula. Now, let's say, sir, you bought a machinery for 10 lakh. You bought a machinery for, you want to do a project. For that, you need a machinery. How much you need to invest for machinery, I've assumed? 10 lakh. Let's say salvage value is 1 lakh. Useful life is 9 years. Calculate depreciation for me under straight line method. How do you calculate depreciation? Original cost minus salvage value divided by useful life. Do that. How much is it? 1 lakh. Yes, sir, people. So every year depreciation is 1 lakh. How many years? 9 years. So calculate total depreciation for me. 1 lakh is depreciation every year, means for 9 years, how much it will be? 9 lakh. You bought the asset for how much? 10 lakh. How much did you totally depreciate? 9 lakh. That means what is asset ka closing balance? At the end of 9th year, what is the closing balance of the asset? You bought it for 10 lakh, you depreciated totally by 9 lakh, means the asset ka closing balance will be 1 lakh. Any problem? Sir, how much did you buy the asset for? 10 lakh. That means the 10 lakh is the opening balance of the asset. Sir, how do you get average? How do you get average? If they ask you average investment, you will take investment ka opening balance and you will take investment ka closing balance divided by 2. Opening plus closing divided by 2. What is opening balance of the asset? 10 lakh. What is closing balance of the asset? 1 lakh. Calculate average investment for me. Opening is 10, closing is 1. 10 lakh plus 1 lakh divided by 2. How much is that? 5.5 lakh. What is that? Average investment. Okay, sir. This is one way to calculate, quite straightforward. But our ICA uses, mother body uses fancy formula. What is that fancy formula? Half, 1 by 2. Open the bracket, initial investment minus salvage value, close the bracket, plus salvage value plus working capital. This is the formula they use for average investment. Let's try it out with this. Half. What is initial investment in this example? How much did you buy the asset for? 10 lakh. So initial investment is 10 lakh. Minus salvage value. How much is salvage value? 1 lakh. So minus 1 you do. So do this in your calculator. 10 lakh minus 1 lakh. How much? 9 lakh. 9 lakh by 2. How much? 4.5 lakh. Plus salvage value. Salvage value is what? 1 lakh. Add 1 lakh. Here working capital is not there. Leave that. How much are you getting? 5. Previously, how much did you get? But don't use this for examination. Use always average investment. You find out using this formula only because our suggested answer will have this formula. Done now, people? Okay, once again, quickly tell me. Sir, I'll recap it again and again, no? So that I want you to remember. And moreover, one thing you need to keep in mind for FM is, sir, FM is a topic which has not changed much in the last 30 to 40 years. Okay. I mean, probably since the day, it's a common concept. Okay. Even when I remember when we used to study also, we used to have all this. I wrote my inter almost 18, 20 years back. That time also, it was there. All this. Maybe after you are passed, no, and then when if some of you become teacher and start teaching, you'll be saying, I also learned this only. I learned it from that fellow West, Sandesh guy. He also told same thing. I also am telling the same thing. So it will come like that, right? So why am I saying this is, in FM, there is always a scope of adding 1 or 2 new concepts here and there in the question. It can always come. So don't freak out if you see some new adjustment. Now focus on what you know. At the end of the day, remember, you don't have to get 100 on 100 to pass. You need to get only 40. For aggregate, you need to get 50. So there is 50% scope for you to do mistake. 50% ICA is only telling we will forgive you. So it is all right. So just I see many students, the moment they see the paper, shiver. New question came and all this. It can happen. In 2 papers, out of 6 papers, at least 2 papers will come on the lengthier and tricky side. One in group 1, one in group 2. Which one will keep varying attempt to attempt. Okay, now when paper comes tough, FM paper comes tough, don't give galis to me. Right? Maybe last attempt FM was tough. This attempt maybe costing may be tough. I'm just saying I don't know. Right? Just say. That is just the way CA is, exam papers revolve around. So it is fine. Even in the toughest of toughest paper, still there is a scope. Easily, even in the toughest of toughest paper also, you can score 60. Provided you're a little smart and use your time properly. And you have studied once and practiced once. It is still a possibility. That's what I believe in. Ultimately, I'll leave it to you, but do understand it's a competitive examination. Little bit of here and there, twist or trick are expected. Okay. But still, we handle those twists and tricks and we are sitting here, no? So, in other 6 months or maybe soon you will also cross this level and get to see a final level. So, have always that belief. Right? You feel it's okay. They say, no, 3 idiots, all is well, all is well, all is well. You keep telling that in the examination, it is fine. Okay, it will clear. Pakka you will clear. Don't worry about that. Fine? It's fine. 1 or 2 attempts here and there can happen. Don't freak out because of attempts. The important part is you're still hanging on. So I'm proud of you. Those of you who are still hanging on, mighty, mighty, mighty proud of you. You are truly warriors. Jai. This attempt, we'll do it. Pakka na? Pakka. I'm not getting the Josh. Online, mein? Give some, online Papa will give the Josh after 5 seconds. Delay, no? Relay in delay. Yeah. So all of you, Pakka will make it? Yes. Let me hear it loud and clear. Yes. This is better. Okay, awesome. So let's keep that confidence and motivation throughout the sessions and throughout our examination at that level only. Let it not dip. Okay, this is done. Now, so let's have a quick recap. ARR, how do you calculate, people? Average PAT divided by either average investment or initial investment. How do you get average PAT? Take profit for all the years and divided by number of years. One approach. Or take the total cash inflow. From that, reduce the total cash outflow. You will get total profit. That divided by number of years, if you do, you will get the average profit. That is one. And how do you get initial investment? You don't have to find that. It will be given to you in the question. How do you get average investment? Half of initial investment minus salvage value. Close the bracket. Plus salvage value plus working capital. Awesome. So we'll move on to the next technique. Next technique, your favorite, NPV. NPV means net present value. Now we are moving on to the discounting techniques. Sir, what is the difference between non-discounting technique and discounting technique, sir? Non-discounting techniques. Now here if you just check, anywhere we used future value, present value concept. No. So these techniques don't give a damn about time value of money. So you don't need any discount factor, present value, future value for any of them. But going forward, whatever techniques we are using, we have to consider the present value, future value concept. Hence the name for them is what we call it as what, people? Discounting techniques. Some of the discounting techniques are, you tell me some of the techniques that you are aware of. Net present value, NPV, then PI, profitability index, then IRR. IRR as an internal rate of return. So how do you get, first one we'll go for this. NPV. How do you get NPV? This is the most popular. NPV, profitability index, is most popular. Majority of the questions you will base your answer based on either NPV or profitability index. Even if they don't mention anything in the problem, you will give the answer. By default, you will solve investment decision using which technique? Net PV. If they don't even mention, still you will go for NPV. Name itself is saying net present value. Sir, how do you get net assets? Net assets, how do you get? From assets, if you reduce liability, that number we call it as what? Net assets. In the same ground, now we are calculating net present value. Net present value means present value of cash inflow minus present value of cash out. Inflow ka and outflow ka present value cash flow, if you net off, that netted number only we call it as what? Net present value. How do you get present value? Simply take the future value and multiply by the discount factor. You will get what? Present. Okay, Sarji. Since outflow happens, generally outflow will happen in future or immediately. So outflow will be already there on which platform? Present value. So you don't have to really find out present value of cash outflows because most of the project investment will happen immediately. But inflows, if you do a particular project, inflow you will get it immediately or in the future? Future. So inflows will be on the future value platform. Multiply a discount factor to that and get what? Present value. But keep in mind, we are talking about what? Not profit. Present value of cash flows. How do you get cash flow? Previously estimation we did, no? So you'll have to put up one working note to estimate cash flows and then only calculate what? NPV. This is what we're going to do. Yes, sir, Sarji? Okay, super. Now, NPV ka brother, chota brother is what? Profitability index. How do you get profitability index? Here you netted off, no? There it is numerator denominator. Do that. Tell me the formula of profitability index. Present value of cash inflow divided by present value of cash out. That's your profitability index. These two in fact are same. Their decisions making are one and the same. Sir, what is the decision making rule? Very simple. If the NPV is 0, if the NPV is 0 or positive, if the NPV is 0 or positive, you can accept the project. If the NPV is exactly 0 or greater than 0, because what is NPV ka formula again? Tell me. Present value of cash inflow minus present value of cash outflow. Suppose inflow ka present value is 10 lakh, outflow ka present value is 8 lakh. So what is the netted number? You use your common sense, no? Totally how much inflow you are getting in today's terminology. 10 lakh. In today's terminology, how much is outflow? 8 lakh. Inflow is 10, outflow is 8 lakh means how much you are still left with, how much extra? If you are left with extra means this is loss making project or profit making? Profit making. So will you reject this or accept it? Accept it. So if the NPV is positive or even if the NPV is 0, still we accept. Why? As long as we are not making loss, we are okay with to do that particular project. So hence NPV is either 0 or greater than 0 means the decision rule is accept. Otherwise, if NPV is negative means reject the project. Same ground mein profitability index. Index, remember, always is 1. That means what is the decision rule for profitability index? If profitability index is equal to 1 or greater than 1. If it is equal to 1 or greater than 1, accept. If it is lesser than 1, then reject. That's your profitability index ka, or another name for profitability index is desirability factor ka decision rule. Okay na sir ji? Correct. Okay, next, IRR. IRR, again, full form is what? Internal rate of return. IRR is basically a rate at which present value of cash inflow will be exactly equal to present value of cash outflow. At what rate, at what percentage inflow ka present value equates to outflow ka present value. Such a rate we call it as what? IRR. So if inflow ka present value, outflow ka present value is exactly same means what will be NPV? 0. That means we also say NPV is rather IRR is a rate at which NPV becomes 0. Okay. Now how do you calculate IRR? You know this. They will not give. So IRR we need to calculate means basically we are calculating discount factor. That discount factor they would have not given. We need to calculate that as what? IRR. So how do we do this? Assume 2 discount factors. It's done by a trial and error in a way. Assume 2 discount factor. You can assume any rate. But sometimes they will only give you discount factors in the question. If they give you discount factors, then you'll have to assume the same. If nothing is given in the problem, means you can assume any rate like 8%, 12%, 10%, 15%, whatever. Take 2 discount factors and find out what? NPV. How do you find NPV? How do you find NPV? Inflow ka first you find out the present value. Outflow ka you find out the present value. At 2 discount factors, first find what? NPV, and then use something called interpolation formula to find out what? IRR. Anybody remembers what is interpolation ka formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus 2. So plug those numbers. Assume 2 discount factors and find out NPV and substitute in this interpolation formula to get what? So if you assume 8% and 10%, what is the lower rate? Among 8 and 10, which is the lower rate? 8%. So LR is in lower rate. So you will take it as what? 8%. At 8%, what is NPV you need to take? Divided by NPV at lower rate minus NPV at higher rate. What is the higher rate here? 10%. 10% ka NPV take. Multiplied by higher rate minus lower rate. Ideally, if you want to get a close enough number, what ICI does is, they assume 2 rates in such a way that one NPV number is positive, another NPV number is negative. Okay, and that way they do it. In case you are not able to do that in exam, it's fine. You can assume any 2 random rates. Based on your assumption, a final answer will change, and that is fine. Maybe one of you may get 15.94. Some of you may get 16.05. It is okay, because if you assume different discount rates, then final answer will of IRR will also change. That's the reason usually if ICI asks IRR question, they will only give you the discount factor so that everybody will take the same rate and everybody's answer also will be same. But if they don't, you are free to assume any rate and get the answer absolutely fine. Okay, na sir? Any problem in this so far? Okay. This is done. Next, it's fine, no? Another 1 or 2 small concepts are there. We'll revise off and then go for the questions in one shot. That approach is okay? Okay, next is something called MIRR. Modified Internal Rate of Return. MIRR. Modified Internal Rate of Return. What is MIRR ka concept is? MIRR brings in reinvestment factor into picture. What did I say? MIRR considers the reinvestment element. Like, just to give you an example. Where example went here. Last time I did good job. Wrote all this example. Okay. Suppose to do a particular project, how much you need to invest immediately? 20,000 I've assumed. So initial investment at year 0 is 20,000. Now discount factor, let's assume, is given in the question to be 10%. Okay. Now people, this is the cash inflow for how many years? Now if you do a particular this project by investing 20,000, you'll get cash inflow for how many years I've assumed? 4 years. And this is the cash inflows I've assumed. Done now? Now what is MIRR ka concept is? First year, how much did you get? 10,000. Now if you get 10,000 rupees money, will you keep it idle or will you reinvest? So nobody would like to keep their money idle. If you have cash, you will keep it in wardrobe, almara, and daily look at it like, oh, and all you will do. No, right? You will keep investing. Yes or no? So 10,000, if you get it at the end of first year, and if it's a profitable project, what will you do? You will reinvest. This project will end on which year? 4th year. This 10,000, when did you get? You got it on year 1 ending. I mean, this 10,000 you can invest in this project for how many more years? You are in first year ending, project ends on 4th year ending. So how many years are still pending? Year 2, year 3, year 4. I mean, this 10,000 you can invest for 3 more years and get a return. Do you agree with me? This 10,000 we can invest for 3 more years and get a return. Sir, if you invest this 10,000, is the value of this going to be 10,000 only or it will increase? So how much return you're going to get? 10%. So take your calculator, find out what is the value of this 10,000 after 3 years. How will you get that? Basically, if it's very simple. If you invest 10,000 in the bank today, and if bank gives how much return? 10%. What will be your deposit ka value after 3 years? Simply take 10,000, add 10% 3 times. 10,000 plus 10% plus 10% plus 10% you do. How much is it? 13,300. That means the value of this 10,000 will become 13,300. Any problem? Any problem or okay? Fine. This is the value now or at the end of 4th year? That why 4th year? Because project is ending at 4th year of assume. That we call it as terminal. Terminal means ending. So this 13,900 is now ka value or end of 4th year? That we call it as terminal cash flow or TCF. Okay. Similarly, you tell me now, this 15,000 when did you get? 2nd year ending. Will you keep this 2nd year ka 15,000 inflow idle or will you reinvest? For how many years will you reinvest this? You are in 2nd year ending, project ends at 4th year ending. So how many more years can you reinvest this? 2 years more. How much return you will get every year? 10%. That means at the end of 4th year, what will be this 15,000 ka value? 15,000 plus 10% plus 10%. How much is that? Comfortable? Similarly, this 12,000, when did you get? At the end of 3rd year. How many years can you invest this? You are at 3rd year ending, project is 4th year ending. So you can invest this for 1 more year. So 12,000 plus 10% you do. How much is that? 13,000? This 20,000, when did you get? 4th year ending. Can you reinvest or you can't? I mean, this value itself is 20,000. Now, all these are value now or at the end of 4th year? At the end of 4th year value only, we give a fancy name. What is that fancy name? Terminal cash flow. What is total terminal cash flow? Adding all this. 64, 650. 64, 650. Comfortable? How much did you invest for the project? Totally, how much are you getting from the project? At what rate these two present value are same? Such a rate only we call it as MIR. At what discount factor these two ka present value is same? That only. If I have to find the 64, 650 is now value or year 4 ka value? Year 4 ending value. Find out the present value of this. This 20,000 you are investing in future or now only? Now. At what rate these two ka present value is same? Such a rate only we call it as what? MIR. It is same like IRR. It is same like IRR. What is the difference? Is IRR ignores the reinvestment. MIRR considers the manner of calculation is just the same. For IRR, we simply take inflow ka present value equated with outflow ka present value. For MIRR, we take present value of terminal cash flow with present value of cash outflow. That's all it is. Okay, that's what I've written over here. IRR is basically a rate at which present value of cash inflow will be equal to present value of cash outflow. MIRR is a rate at which present value of inflow or terminal cash flow. Present value of terminal cash flow will be equal to Present value of cash. That is your MIRR. Okay, na sir? Let's do a thing. Can we do a one question, 5 minutes quickly on MIRR? Just to rephrase. Okay. So 1 minute. I think I do have a question. It's a study mat question only. This one, huh? Yeah, this one only. Okay. Question number 15. It's an, or 14 rather. It's on in a study material only. I picked it up. Easy. An investment of 1,36,000. What is this 1,36,000 people? Year 0 ka outflow, or you can call it as initial investment. Okay. Yields cash inflow. So they have only given cash inflow. For how many years cash inflow they've given? 5 years. How much is the cash inflow? Is it same every year or changing? Changing. Okay. And how much is the cost of capital or discount factor? Or reinvestment factor is how much? 8%. Now you tell me, sir. They have asked you to calculate MIRR. You just need to calculate here MIRR. So quickly we'll do it here only. Tell me what you will do first now. Guide me. This is cash inflow. We need cash inflow or terminal cash flow. How do you get terminal cash flow? This 30,000, when will you get? End of first year. The project is ending on 5th year ending. So how many years can you invest 30,000? We are at first year ending and you will receive this money, or you can invest it for till 5th year ending. So how many years can you invest? 4 years. How much return you will get every year? 8%. So how many times you will add 8%? 4 times. Add that. Tell me how much you're getting. 40,000? 815. Okay. Similarly, this 40,000, when did you get? 2nd year ending. Project is ending on 5th year ending. So how many years can you invest this 40,000? 3 years. That means you will add 8%. How much time? Thrice. So 40,000 plus 8%, you added thrice. How much are you getting? 15 or 50? 50. 5? 50? 38? 388. Okay, this 60,000 you got it at the end of 3rd year. You can invest for how many more years? 2 years. So 60,000 plus 8% plus 8%. Chapati? 60,000, 69,000? 984. This 30,000 you got it at the end of 4th year. So how many years can you invest? For 1 more year. How much is that? 32,000? 400. Okay. This 20 you got it at 5th year ending. Can you invest anymore or you can't? So its terminal cash flow is same, 20,000. Add everything. All this number quickly you add. How much? 2 lakh 30? 213? 213,587. So what is this? Your total terminal. Done, Sarji. Now I'll quickly just prepare a table, and for IRR we'll see. So what you have to do, first of all, MIRR means what? This is now ka value or 5th year ending. All this you will get at the end of 5th year. But are you investing at 5th year ending or now? How much did you invest? 136. At what rate this 136 ka present value and 213 ka present value is same? Such a rate only we call it as MIR. So now for MIRR calculation and IRR calculation is same. What we have to do? We have to assume 2 discount factors. Just to prove that 8% is not MIRR, first discount factor will assume it as 8% only. Let's try. Okay, now same. Year, cash flow, and first discount factor I'm taking it at 8%. Then I'll take present value of cash flow. Okay, first year 0. Year 0 means what, sir? Immediately. Immediately, how much you have to invest for the project? 1,36,000. So at year 0, we have to invest 1,36,000. Done now. Now, this terminal cash flow, you will get it now or at the end of 5th year? So 2,13,587 is the value, not now, but the end of 5th year. Now, 8% is the first discount factor I've assumed. Okay. Sir, year 0 means it is already what? Immediately. Means this 1,36,000 is on future value or it's already on present value. So year 0 ka discount factor is always 1. So how do you get present value? These two ka multiplication. Multiply. 1,36,000. 136 is outflow. In FM, outflow we show it as negative. Inflow we show it as positive. So this is 136 negative. Now tell me, at 8%, what is 5th year ka discount factor? How do you find out discount factor, by the way? What's the formula for discount factor? 1 divided by 1 plus I whole power n. So I have assumed here is 8%. So 1 divided by 1.08, press equals to button 5 times. 1 divided by 1.08, press equals to button 5 times. How much your calculator is getting? 0.68? 0.6806, huh? Okay. This is the future value, this is a discount factor. Multiply, you will get present value. How much is that? These two come multiplication. Quickly do. 1,40,000? 1,45,000? 145,367, huh? Okay, so these two you net off. This is inflow ka present value, this is outflow ka present value. When you net off, you are getting what? 0 or some number? 9,367. So is 8% my MIR? So if 8% was MIRR, means this NPV should have become 0. Because IRR is basically a rate at which inflow and outflow ka present value should be same. If inflow and outflow ka present value is same, means NPV should be 0. Is it 0? No. That means 8% is not MIRR. Now what we have to do? Assume another discount factor. You can take 12, 14 or whatever. Number is close. Maybe I'll take 12. So let's try it at 12. At year 0, discount factor is always 1. Now tell me at 12%, what is 5th year ka discount factor? 1 divided by 1.12. Press equals to button 5 times. 0.5674. Now find out the present value of cash flow now. This is your cash flow. This is your discount factor. Multiply. How much are you getting? This is 1,36,000 negative. These two come multiplication. 1,21,000. 195. When you sum it up, 136 minus 121, 195. If you do, I think you're getting a negative number. What? 14,805. So is 12% my MIRR? No. If 12% was MIRR, means NPV should have become 0. Is it become 0 or negative? That means MIRR is somewhere between 8 to 12. Now use that interpolation formula. What is that interpolation formula? Tell me, people. Same. MIRR is nothing but lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. I've assumed 8 and 12. Among 8 and 12, which is the lower rate? 8%. So I'll take full number. 8% and full number will be 0.08. At 8%, what is NPV? At lower rate, NPV is 9367 divided by NPV at lower rate minus NPV at higher rate. Higher rate is 12%. 12% ka NPV is already negative. I have to minus that. It's already negative. Negative of negative will become positive. So what I have to do here? Add 14,805 multiplied by higher rate 12%, 0.12 minus lower rate 0.08. Solve this and tell me what's the number you're getting. I think I've solved this. It's okay. I think here I've taken 11% and 8%. Okay. If you solve, how much are you getting? 9.55%. Okay. That's your MIRR. So here I had taken 8 and 11. I got the answer as 9.36. So based on your assumption, answer will change. That is okay. That's okay. Someone is saying, sir, it is 1,21,899. It's okay, pa. Based on the decimal. Some of you may take 2 digits. Some of you may take 3. Some of you may take 4. So based on your decimal also, answer will change. Okay, based on your discount factor also, final answer will change. Based on your decimals also, it will change. That is absolutely acceptable. I think marks will not be deducted for these. So did you get a basic concept of MIRR, how it works now? Sorted off. All right. So let's come back then. Next to, I'll have to maintain the space. I hope it's okay with you, right? Because I have to, usually I've kept the funda is before lunch, this after lunch working capital, that's what we have kept. Okay, so I have a certain number. Pakka, no, the space is okay. All right, move on to the next what? Next is something called capital budgeting under capital rationing. So ration something means carefully utilize it. When we say ration something, it means carefully utilize it. Just to give you an example, let us say company have 1 lakh rupees budget. They have how much money? 1 lakh rupees money. Using this money, company found it is possible for the company to do 3 projects. The project name is what? A, B, C. Okay. But to do project A, how much money is required? 50,000. To do B, how much money is required? 40. To do C, how much money is required? 25,000. Add all the 3. Add all those 3. 1 lakh? 1,15,000. To do all the 3 projects, how much money company needs? 1,15,000. Company has 1,15,000 or only 1 lakh? So company has 1 lakh. Now they want to select the project, not one. They want to do more than one. But can they do all the 3 or not possible? Now the question will arise, in this 1 lakh budget, which project will you select? Will you do A and B? Or will you do A and C? Or will you do B and C? Because all the 3 are not possible. So which 2 will you select? That is a question. That case only we call it as what? Capital budgeting under capital rationing or ration. Okay, Sarji. So straight away, I'll give you some data. Check. A ka NPV is this, B ka NPV. This will be given to you in the problem. In these sort of problem, initial investment and NPV and project. These 3 data now will be directly given to us in the problem. Okay, maybe we'll read the whole thing again. Project A ka, how much is the investment required? 50. If you do project A, how much NPV you will get? 15,400. If you do project B, you need 40 investment and this is the NPV. For project C, this is the investment, this is the NPV. Now, if they give you multiple projects, simple decision rule is that if you, for a single project, the decision rule is if NPV is greater than or equal to 0, you will accept. For individual project, this is the decision rule. If you have 2 projects A and B, and if they say select one based on NPV, how will you decide? Sir, NPV is the benefit. NPV is the benefit. You will select that project with the lowest benefit or the highest benefit. That means among multiple projects, the decision rule is you will select that project with the highest NPV. Whichever project has the highest NPV, you will go ahead and select that. Now, the problem is, check here. Among these 3, which project has highest NPV? Among ABC, which project has highest NPV? B has highest NPV. Correct? Huh? So that means ideally now, if you want to rank, ideally, what will you say? First to do which project? B, sir. Because why? It has the highest NPV. Next, which project has higher NPV? A has 15,400, C has 10,100. Which has more benefit? Okay, that means the rule will be what? Probably based on your rule, you will select do A and B. That's what you would say. Because compared to C, A and B is offering a higher NPV. Agreed. That's your rule. But what we also need to consider, what you're thinking is right, but you also need to consider one more factor, which is what? Amount invested. Is the investment amount same for all the 3 projects or changing? See, here it is 40, here it is 50, here it is only 25. So what capital budgeting and the capital rationing says is you don't take a decision only based on NPV. You also need to consider what? Amount invested also. And amount invested, is it same for every project or different? Hence, what we do is get the NPV on one platform. What platform? Usually we get it on 1 rupee platform. Oh, but here is the investment same or investment is changing? Changing. What first you do is first find out if 1 rupee is the amount invested. If 1 rupee is if the amount of investment is 1 rupee, how much would be the NPV? If the initial investment is 1 rupee, how much is the NPV? First try to find out. Basically get them on a common platform. Are they on the common platform currently or different amount? Since the amount of investment is different, you find out this. If you invest 1 rupee in all of this project, how much NPV will you get? How do you get that? Very simple. Look at this. Initial investment. Initial investment NPV. What is the initial investment of project A? 50,000. If you invest 50,000, how much totally NPV you will get? 15,400. If you invest only 1 rupee means how much NPV will you get? Calculate this for me. How do you get X? Cross multiplication. Basically, what is X now? 15,400 divided by 50,000. How much people? 0.308. That's what we have got here. Done now. Now do it same for this is for project what? A. Do it for same for B. What you have to do? Same. Initial investment NPV. What is the investment for B? 40,000. If you invest 40,000, how much NPV project B will generate totally? 18,007. If you invest only 1 rupee, how much is it? Sir, should we always get it on 1 rupee platform? Sir, you can get it on 1 rupee, 1,000, 100 rupee. Any platform is okay. But suggested answer will always bring it on 1 rupee platform. If you bring it on any other platform also, final answer will be same. Okay, no answer will not change, but better to follow. I say Zindabad in my view. Okay. Alright, calculate NPV here, so now what you do? Basically 18,700 divided by 40,000. How much is this? I'll round it off as 0.47. So, or if you wanted a simple formula, how do you get 1 rupee ka NPV? Take the total NPV divided by the total investment. So, do it quickly for project C then. Total NPV 10,100 divided by total investment. These two you divide, how much are you getting? 0.4. Clear, sir? Now, all these are on different platform or 1 rupee investment platform. All are on same. If 1 rupee is the outflow, mean this is the NPV each project is generated. Now they are better comparable. Yes, sir. If you invest 1 rupee under all this project, this is the NPV they generate. Means now you will select that project with what? Lowest NPV or highest NPV? Now, which among this has the highest NPV? B. That means first rank will be awarded to what? B. So you'll select B. Next, which project is having a higher NPV next? A is 0.3 and B is C is 0.4. So second rank will be given to C. Last rank will be given to A. That means what is the order? First you will select project B. So how much will you invest for project B? 40,000. Okay, now then you will go for second rank project. What is second rank project? C. C requires how much investment? 25. So that means how much have you spent? 40 for B, 25 for C, means totally how much spent? 65,000 you have spent, but what is your budget? 1 lakh. Still money is there. How much money is there? 35,000. In this problem, they will say projects are divisible. They will say what? Projects are divisible means you don't have to do the project 100%. You can take up the project partly also. The question will specify that. That means should you have to do now? How much money is left again now with us? 35 is left. Can we take up A? No. To take up A fully, we need 50. Do we have 50 or only 35? How 35? We have already invested 65. Our budget is 1 lakh. So we are left with 35. But to do project A, we need 50. Can we do project A fully or partially? Partially. And can we do partial project? Yeah, as per the question. Question will say part project is acceptable. Like that they will say. Or they will say projects are divisible. Divisible means you can do partial project. So how much money balancing figure is there? 35,000 you will use for project C. Okay, na sir? This is how you're going to ration your amount of investment. So that's how 1 lakh totally got invested. Once more or through? Once more or through? Through. Okay, now project B generates how much NPV? First, project B generates totally how much NPV? 18,700. And you're doing project A partially or 100%? 100% NPV you will get. Project C, are you doing partially or fully? So you will get full NPV. How much is that? 10,100. Now for project A, can I copy 15,400? No, 15,400 is an NPV provided you invest how much money? 50,000. Are you investing 50,000 or only 35? Means you need to proportionate. What is that? A, for project A, 50,000 if you invest, how much NPV you will get? 15,400. Are you investing 50,000 or only 35,000? Only 35,000 is your initial investment, means how much is NPV? Find this out for me. How do you get that? 35,000 into 15,400 divided by 50,000. How much, sir? 10,000. So that means this is how you're going to utilize your 1 lakh and that's how you're going to get your NPV. Clear, Sarji? So capital budgeting and capital rationing will come into picture when the initial investment is same for multiple projects or different. When different projects have different investment, this will get triggered. That's a fun. This concept is also over. I don't think so we need any question for this. Same thing as there as question. I think this is comfortable. Now we can take care of it. Okay, done. Can we get to the next one? Okay, next one is project with unequal life. Project with unequal life, Andre. What does that mean? One project can give you the inflow for maybe 5 years. Another can give only for 4 years. Or maybe another can give for 10 years. So basically you have multiple projects and all the projects are generating cash inflow for same years or different years. Different years. Like here, an example you just check. Let's say we have 2 projects, X and Y. For X also, Y also, both the project requires same initial investment, 10 lakh. No change in investment. X ka, how much is the total NPV? 15. Y ka total NPV is 19 lakh. If only these two data are given, if you have to select among X and Y one project, which one will you go for? If only this is given, if you have to do the selection, you will select project X, you will select project Y. Why? Among multiple project, you will select that project with the highest NPV. Here it is only 15, but Y is generating 19 lakhs. So obviously you will go for Y. Yes, huh? But hang on, one more data you just check what X will give you. X will run for how many years? The life of project X is 4 years, but the life of project Y is 5 years. So that means they are same or unequal. So in case of unequal life, what we say is don't directly decide based on NPV. Because it's common sense. No, if you do a particular project for a longer duration, you will get same benefit or higher benefit. Longer project will always generate higher. More the longer the project, to more the benefit. Yes or no? Hence, what this concept says is don't take the decision only based on NPV. Also consider what? Life. Also consider what? Life. This also has to be considered as a parameter for you to decide. That's all this is concept. This is a 2-marker question, to be honest. So, okay, I think let's try to finish it here only. A question may not be required. Check. What we do here is, okay, some of you may think of it like this. Sir, what is the total NPV you are getting? 15 lakh, right? This is for how many years? 4 years. So, some students will say, sir, I'll calculate average NPV. Here in this case, you have to calculate something called what? Average NPV. How do you get average NPV? 15 lakh is an NPV for 1 year or 4 years. So, divide by 4. 3.75. Similarly, 19 lakh is an NPV for how many years? 5 years. So, what is the average NPV? 3.8 lakhs. Agreed. Now, can we do like this? Like this, you should not do. Why? Sir, NPV is based on time value of money. NPV is based on time value of money concept. Is first year ka discount factor and second year ka discount factor same? Now, if you divide by 4, then it's as good as you're saying first year, second year, third year, fourth year, everything is same. Sir, if I say I will give you 1 lakh after 1 year, if I say I will give you 1 lakh after second year, which one will you choose? Is it same or different? Getting 1 lakh within 1 year, getting 1 lakh within 2 years are completely different. Hence, we have to find here average NPV, but it's not a simple average. It is what average? Weighted average. And we have to assign weights based on the time value money concept. Okay, now people. So we have to find average NPV here. How do we find average NPV? It's very simple. If you want to find that average NPV, we call it as EAC. Anybody remembers the full form? EAC ka full form is what? Equivalent annualized criterion. EAC is what we find. Equivalent annualized criterion. That is nothing but your average NPV. How do you find out that? Is very simple. Take the NPV and divide by, instead of doing divide by the number of years, you divide by present value annuity factor. Present value annuity factor. Sir, what is the difference between PVIF and PVAF? First tell me this. What is PVIF? What is PVAF? Each year ka discount factor if you are calculating. Suppose if the project is year 1 to year 5. How many years project? 5 years project. Each year ka discount factor if you are taking, we call it as PVIF. Present value interest factor. PVIF, annuity factor, is always cumulative or total. For 5 years put together, if you calculate discount factor, that we call it as what? PV? Okay. So here we'll take, how many years is the life of this project? 4 years. Let's say discount factor is 10%. Now give me, sir, at 10%, what is 4 years ka put together discount factor? PVA. How do you find out this? Do 1 divided by 1.1. Press equals to button 4 times and then press GT button in your calculator. 1 divided by 1.1. Press equals to button 4 times and then GT, grand total button. How much is that? Tell me. 3.1698. Everyone is comfortable with PVAF. If GT button is not there, ideally buy a calculator which has, or you can use M plus button also. M plus each 1 divided by 1.1. Then you can press equals to button and M plus button. After doing this 4 times, then you can press MRC, memory recall button. That will also give you the answer. But that will be a little extra time. Better I suggest that buy a calculator with GT function, much easier. Okay. Same thing here also. Calculate that. How much you told? 3.169. So how do you find out average NPV here? 15 lakh is a NPV. And what is the PVAF? 3.1698. Divide these two. 4 lakh 72 or 73 216 I am getting. That is what? Your average NPV. Project X is generating an average NPV of this. Same thing, do it for project Y. At 10%, now find out AF for 5 years. At 10%, find out AF for 5 years. 1 divided by 1.1. Press equals to button 5 times and then press GT button. How much are you getting? 3.7907. How do you get EAC? NPV divided by PVAF. These two you divide. You're getting 5,01,227. Okay. So X ka average NPV is this. Y ka average NPV is this. NPV here is a benefit. X ka average benefit is this. Y ka average benefit is that. Now you will select that project with the lowest average benefit or the highest. Which has the highest EAC? Project Y. So the decision rule is select Y as it has the highest EAC. Okay, na Sarji? Everybody good with this? Fair enough. Sir, don't mug it up. Don't always say select project with highest EAC. In this problem, you will select the project with highest EAC. Why? They gave NPV. NPV is what? Cost or benefit. So if you're working from benefit angle, you will select that project with the highest average number. In some problem, they will not give you benefit. They'll only give you cost. They'll not give you any benefit data. They'll only give you cost. In that problem, you will select that project with the highest average cost or the lowest average cost. That we have done 2 questions in regular class on both. Okay, here I'm just saying. I think I've done it here also. Okay, I have an example. Check here. Let's say company has to choose between machinery A and machinery B. A ka running cost is, or A ka life is 4 years, B ka life is 5 years. To buy machinery A, how much we have to invest now? 10 lakh. To buy machinery B, how much we have to invest now? 11 lakh. Okay. Comfortable? In fact, I've only given you directly. Present value of cash outflow. Present value of cash outflow. What in these problems, what they will do is they will give you multiple outflows. Multiple outflows could be one, to purchase machinery A, there is an outflow. If you have an asset, you have to maintain that asset by incurring repairs and maintenance. So they will give you maintenance cost. That's all they've given. They'll not give you any benefit. They'll only give you 2 data. What is that? One is they'll give you purchase cost. Another one they will give you maintenance cost. I mean, they've given you only what data? Cost cut data. So first find out the present value of cost, which I've given to you in the problem already. What is present value of cost? 10 lakh. What is present value of this machinery ka cost? 11 lakh. Comfortable. There is no benefit. Only find out the present value of cost. Clear? But life of both the asset is same or different? Different. So straight away, if you are doing the decision based on cost, you'll select that project with the highest cost or the lowest cost. This ka cost is 11 lakh. This ka cost is 10 lakh. Ideally, which one should you select? A. Correct? Because cost is on the lower side. But hang on. A ka life is how many years? 4 years. B ka life is 5. Is it same or different? Whenever we have unequal life, we have to find something called what? EAC. And then only do the decision. And how do we do the decision? How do we calculate EAC? NPV divided by PVA. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Here inflow is there. No. What have they given? Only outflow. Outflow ka present value have you found out? Yeah, use this data only. If inflow is not available, cut that. What is present value of cash outflow? 10 lakh. Take this in the numerator divided by what in the denominator? PVAF. At 10%, find out PVAF for 4 years for me. At 10%, what is 4 years ka PVAF? 1 divided by 1.1. Press equals to button 4 times and GT button. How much? 3.169. Same at 10%, find out 5 years ka PVAF. 3.790. Comfortable? Everybody? Good. Okay. Divide these two number. How much are you getting? This two can division you do. How much are you getting? 3,16,000. These two you divide. How much are you getting? 2,90,000. What is this number? This is your average cost. This only we call it here as EAC, equivalent annualized criterion. But this is on the benefit side or cost side. Now you will select that project with the highest average cost or the lowest average cost. Which has the lowest? Machinery B. So you will select machinery B as it has the lowest EAC. So check the problem. So first of all, EAC will only come into picture when life is same or life is different. When you have unequal life or different life, EAC comes into picture. And before you do, you need to check whether you're working ESC from the benefit angle or cost. If you're working from the benefit angle, you'll select that project with the highest benefit. If you're working from the cost angle, you'll select that project with the lowest cost. Both the type of question can be asked. Okay, sir. Someone's online question is, sir, shouldn't the life be same? No, you can't equate the life, no much. See, you may be smart. You may clear your CA in 1 attempt. Maybe another student can take 3 attempts. Is it wrong? It can happen, no. Now, can you say, no, both has to be same, otherwise I will not give degree? Can institute say, I will only give degree to those students who clears in 3 attempts. Or I will give degree to only to those students who clears in 1 attempt. Is it like that, or it can happen? One student can clear everything in first attempt. Some student can take 3 to 4 attempts. So life of every project will not be same. Okay, macha machi, it can change. Okay, life can be different. Your name is Shriya Dance, huh? Okay, dance okay or no? Reenath, I think that is. Okay, all right, comfortable. This is the funda. Okay, na Sarji. All right, we'll move on to the next one. Then no, next one is now. Few things are there. I don't know how much of this. All these are bigger problem ka adjustment. Okay. I'll just call it out once. If we don't understand it fully, absolutely okay. We'll apply each one of these in the bigger questions. But once I would like to summarize before I start. Okay now? Alright. Now, what is the first concept is? Sir, you're estimating cash flow. Okay, give me a recap again. How do you estimate cash flows? Or 1 minute, hang on. Jai Govinda. Recap, give me from the top what and all we have covered. Let's see. What is the first of all topic, Govinda? Investment decision. We take this decision with the help of a small technique. The technique is capital budgeting techniques. Okay. All capital budgeting techniques take the help of cash flows. Only one technique, that is ARR, uses PAT. All others uses cash flows. So some problem mein cash flows will be directly given. Some problem mein we have to estimate cash flows. So how do we estimate the cash flow? Give me that workthrough. Basically, from income, you have to reduce all the expense. Usually, they will start with sales. Take sales, and if there is any other income, take that. Basically, add all the income. Reduce all the expense. That expense could be variable cost, fixed cost, depreciation. You can give it any name, really doesn't matter. From income, if you reduce all expense, you're going to get profit before tax. Reduce tax. You'll get profit after tax. Can we take that? No, we need cash flow. From PAT, we need to arrive at cash flow. What do we do? Add back depreciation and ORs. O for opportunity cost. Opportunity cost can be added or subtracted depending on the information. If one benefit, if you are sacrificing, it is an outflow. One cost, if you are sacrificing, then it's an inflow. Then O over W. W for working capital. Working capital at year 0, you will take it as a outflow, because to do a project, you have to invest in for day-to-day expense also. At the end of the project, you will recover that. So the end of the year 0, you will take it as working capital as an outflow. End of the project, you will take it as a inflow. Then A for additional investment if required, if any question will specify. Whichever year it can come. S for salvage value, subsidy or STCG. Salvage value will always come at the end of the project. STCG, short-term capital gain loss, also will come at the end of the project. But subsidy can come whichever year depending on the question. Okay, subsidy means money received from the government. That is always inflow. Okay, by doing this, we'll get the annual cash inflows. But all these cash inflows are on present value platform or future value? Future value. We multiply by the discount factor to get the present value. Correct? Now? Okay, then we looked at some non-discounting techniques or traditional discounting techniques of capital budgeting. What are those? Payback period. Payback period means what? In how many months or in how many years are we going to recover our initial investment? So if annual cash inflow is same every year, then how do you get payback period? Payback period is simply given by the formula initial investment divided by your annual cash inflows. If cash inflow every year, if it is changing, then we have to do cumulative approach. Cumulative approach means go on adding the cash inflow. Okay, now? And then how do you get payback period? Check if initial investment is matching with cumulative cash inflow. If it is matching, means whichever year it is matching, that is your payback period. If it is not matching, then you need to find out the range. Suppose it is falling between year 5 to year 6. What you will do? Take the lower number, which is 5, plus required cash flow divided by the actual cash flow. That will give you a payback period. Then payback reciprocal. How do you get payback reciprocal? 1 upon or 1 divided by payback period. That is your payback reciprocal. Then we went for ARR. How do you get ARR? ARR ka full form is accounting rate of return or average rate of return. So how do you get accounting rate of return? Always remember, in accounts it is not cash flow, it is PAT. So ARR is given with the formula average PAT divided either by a average investment or initial investment. How do you get average PAT? One way, if they give you 3 years profit, 3 years PAT, add all the 3 years ka PAT and divide by 3 number of years. That is one. Another way is, if they only give you inflows and outflows, then take the total inflow, from that reduce the total outflow. You will get the total profit. The total profit divided by the total number of years will give you average PAT. That is one. Initial investment will be given. How do you find average investment? Half of initial investment minus salvage value, close the bracket, plus salvage value plus working capital if any. Done. Then we went for discounting techniques. First common discounting technique is NPV. How do you get NPV? Present value of cash inflow minus present value of cash outflow. Decision rule is, for an individual project, if the NPV is greater than or equal to 0, accept. If it is NPV is lesser than 0, as in if it is negative, then reject. How do you get profitability index? Present value of cash inflow divided by present value of cash outflow. Decision rule, if profitability index or desirability factor, if it is greater than or equal to 1, accept. Lesser than 1, reject. Then excuse me, we went for IRR. IRR is basically a rate at which present value of cash inflow will be equal to present value of cash outflow. Or IRR is basically a rate at which your NPV becomes 0. So NPV, IRR, we have to assume 2 discount factor and find out NPV and use interpolation formula. And what is that interpolation formula? Lower rate plus NPV at lower rate divided by NPV at lower rate minus NPV at higher rate. Whole thing multiplied by higher rate minus lower rate. What is terminal MIRR? MIRR ka full form is modified internal rate of return. Each year ka cash inflow, whatever you are getting, you have to reinvest. Okay. When you reinvest, you will get what? Terminal cash flow. You first find the total terminal cash flow. At what rate your total terminal cash flow ka present value will be equal to present value of cash outflow. Such a rate only we call it as MIRR. Okay. Manner of calculation is same. Then we learned what after MIRR, we went for capital budgeting under capital rationing. This is a scenario where we have one amount. Using that amount, we have to select multiple projects, but all the projects ka initial investment same or different? Different. Hence, what to do? Get them on one platform. Which platform are we getting to? 1 rupee platform. So first find out if you invest only 1 rupee for the project. If 1 rupee is an investment, means how much is NPV? If you want to express that as formula, how do you get that? NPV divided by total initial investment. If you do, you will get 1 rupee investment ka NPV. Based on that, rank the project and select. If projects are divisible, means you can do the partial project also acceptable. Someone asked the doubt, what if projects are not partially divisible? Then you can't do partial project. Then you will select that combination which gives you the highest NP. That way you will do. Okay. Another one is projects with unequal life. Project with unequal life means one project ka life is 7 years, another ka is 10 years. In that case, we find something called EAC. EAC is your equivalent annualized criteria. That is nothing but your average. How do we find that? First, check whether you're working from benefit angle or cost angle. If you're working from benefit angle, take the total NPV divided by the PVAF. You'll get the average benefit. So the decision rule is select that project with the highest average benefit. Okay. Suppose if you're working from cost angle, then what you'll do? Find out the present value of cash outflow. Okay, if they have given, take it. If they have not, find out the present value of cash outflow. That is your numerator divided by PVAF. Then you will get the average cost. Now you will select that project with the lowest average cost or the lowest EAC. Okay, fine. Okay, I think that's it. Now, 1 or 2 small concepts, then we will go for this. What is that next concept is? Excuse me. People, at any point of time, if you feel taking a break, short break and resuming is good, I don't mind. You let me know. If you want to take a small break, I'll finish this first in about maybe 5-10 minutes. Then you let me know. Or if you're comfortable, we can go with the questions. Your call. I'll leave it to you. We'll keep it open. Okay, now. Or you can also give me a signal like this. That is my signal that, okay, I have to give you a break. That is also acceptable. Sorry, now. Okay. What is this next concept is? Fine. RTP, MTP, we'll do it later. Okay. Let me give me some time. After this, I have to do CA final ka marathon. This time I'm planning to do every marathon. Advanced accounting marathon over. Now FM marathon. Now CA final first accounts marathon I'll have to do, and then I'll figure out about RTPs, MTPs. Let them release all of it. I don't like to spend time doing individually. Let RTP, MTP together, let them release. Then one fine day we'll do a session. Okay, na? Fine. We'll post it on YouTube. Don't need to worry. But give me some time. Okay. I also need a little breather. After this, I'm planning to take a small break. It's been almost 3 months I've not taken break. I just finished FR class and all this started now. Yeah. So yes, I'll do it, but give me some time. Okay. Till then, aram se you chill pill with other things. Yeah. I'll also chill pill with other things. Oh, okay. Is it first day of marathon? Yeah. It is the first day and the last day of marathon also. Yeah, true. Okay. All right, fair enough. Online people are still there. Mighty happy. Thank you. Keep the same gusto and keep the same things up. Oh, thank you. Thank you also much. Okay. Next concept is something called carry forward of loss. Sir, when you estimate from income, if you reduce all expense, you will get, suppose income is 100. Income is 100. Expense is, let's say, 140. Expense is, let's say, 140. What did you get? Profit or loss? How much? Okay, now this is your profit before tax. So it's a profit or a loss? So when there is a loss, suppose the tax is at 30%. Tax is at what rate? 30%. Now you tell me, it's very simple concept. When you make a profit, when a company makes a profit, they pay tax to the government. But in the year of loss, will you pay tax to the government? No. In the year of loss, usually what happens? You will not pay any tax. So tax amount will be how much? 0. So your earnings after tax will be what? 0. I mean, earnings after tax will be same 40. Agreed? Any problem? Okay. Let's say this is year 1 ka data. Suppose in the second year, income is 200. Expenses, let's say 120. Expenses 120. So second year you made loss or profit? How much profit? Or maybe let's take a slightly different number. Let's make this as 110. So how much is the profit before tax you're getting? 90. Second year, will you pay tax to the government on 90 rupees or you'll first set off? Our Income Tax Act rule says that whatever loss you have made in 1 year, no, can be carried forward to the subsequent 8 assessment years. How many years is that? 8 assessment years. Okay. So next year, you will not pay tax to the government on 90. What you will do? From 90, you will adjust how much is previous year ka loss? 40. That means how much is your profit? 50. On 50, you will pay tax at the rate of 30%. How much is that? So next year, you will only pay how much tax to the government? Sir, 90 ka 40%. Profit is 90. Na? 90 ka 30% rather is how much? 9 3s are 27. 27. Yes, no? Are you paying 27? Or let's assume that all these numbers are in lakhs. Okay. Are you paying 27 lakhs tax to the government or only 15 lakh? 15 lakh. Agreed? Okay. Everybody good? So instead of paying 27 lakh, you're only paying how much tax to the government? 15 lakh. That means future year ka tax you saved. Due to what? Loss. How much tax you saved? Check. Instead of paying 27, you paid only 15. How much did you save? 12 lakhs or 12, right? What is that 12? Take. How much was the loss in 1 year? 40. 40 ka 30% you calculate. 40 ka 30% is how much? Means what? Due to loss, you're paying more tax or you'll pay less tax. So this is a tax payable or tax benefit? Tax. So this also should be considered for your cash flow calculation. That is what we're calling here as what? Carry forward loss. Everybody got it? There are 2 ways through which this carry forward loss adjustments can be done. That is what I've summarized this 2 points over here. Can I call that now? Yes. Did you understand the meaning of this carry forward loss? How it impacts our problems? Okay. Now, what is a 2 way of structuring the question or 2 ways in which this adjustment can come in exam is? One of the common ways in which this adjustment will be asked in exam is they will say loss can be carried forward for 5 years, 10 years, 3 years. Like this they will mention. How many years can you carry forward the loss? That data will be given to you in the question. That's what I've written here. Maybe I'll read the exact line. If question mentions loss can be carried forward for certain number of years, could be 1 year, 2 years, 5 years, whatever. Then what you will do is, in this example, which year you made the loss? First year. So first year ka tax amount you will make it as what? 0. That's what I've written here. If the question says you can carry forward the loss for a certain number of years, then whichever year you make the loss, that year you'll take the tax amount as what? 0. And what? That's it, or subsequently you'll adjust this loss. In the subsequent years, may adjust this loss and calculate the tax amount. I mean, this is the example, whatever I constructed now relates to which point? Point number 1. Whatever we did now here, it's related to which years? Which points? Point number 1. Comfortable? This is one way. Everybody good? Some problem may they will not mention any of this. Some problem may they will not mention how many years loss you can carry forward. You calculated cash flow. When you calculated profit before tax, immediately you got what, sir? Profit or loss? Loss. But how many years loss can be carried forward? They have not mentioned. If they don't mention, what do we do is, and maybe I'll read this point and then I'll maybe tell you once again. If question is silent on loss carry forward, meaning if question does not mention how many years the loss can be carried forward, then what you do is you take the tax benefit. You take the tax benefit in the year of loss itself. On loss, because of loss, you will pay more tax or you will pay less tax. That means it's an outflow or a benefit. Understood, everybody? It's a benefit. Here, check. Ideally, in second year, how much tax you have to pay? 90 lakh ka 30% is how much? 27 lakh. Are you paying 27 lakh or only 15 lakh? How much did you save? 12 lakh. What is that 12 lakh? First year you made 40 lakh loss. 40 lakh ka 30% is how much? 12 lakh. Yes, no. Because of this loss, future year ka tax you are saving. So it's an outflow or an inflow. Here, sir, here in this terminology, benefit you show it as a positive number. Cost and outflow you show it as a negative number. Due to loss, you are paying more tax or less tax. So it's an outflow or a benefit? Benefit, yes. So if the question is silent about if question does not mention how many years can you carry forward the loss, then first year only calculate 40 lakh 30% how much? 12%. Or maybe I'll read this. Check this. Same data, tell me what is that income, how much? 100. Expense, how much? 140. So how much are you getting profit before tax? Negative 40. Now question does not mention how many years you can carry forward the loss. In such problem, what you'll do is, what is the tax rate we have assumed? 30%. Calculate 40 ka 30%. Write 12 lakh in first year. Okay, now everybody. That means your profit after tax will become 28. Since on loss, you will get benefit. Benefit you'll show it as a negative number or positive number. So this 12 lakh you'll show it as what? Positive. Done. Now, don't take this benefit in the future years. Take this benefit in the year of loss itself. That is what my point number 2 is trying to say. Got it up? Go in there. Got it up? For loss, not pay tax. Yes, correct. On profit, you pay tax. On loss, you don't pay tax. Rather, you will carry forward this. If you can carry forward the loss, you will do it like this. Understood? If carry forward treatment question does not mention mean, then you will do it like this. Either this or this. Comfortable? But mostly examination question will target this. Mostly they'll ask this. But in some RTP, MTP, we have seen this treatment also given. So hence both I wanted you to be comfortable. It will come in the problem. This scenario will come in the problem again. But I hope this part is okay with you. Tell me in your own words, what did you understand about carry forward of loss? What did we understand? Tell me. First you will check. Question mentions, can you carry forward or not? If they say you can carry forward for 1 year, 2 years, 5 years, whatever number of years, then what you will do? Whichever year you made a loss, that year tax you will make it 0. And adjust this loss in the future years. And accordingly, future year ka tax amount will change. Okay, na sir? If this carry forward data, if it is not mentioned in the problem, then what you will do? Whichever year you got a loss, that year only you calculate the tax, but don't calculate. Here you'll not pay the tax. You'll rather get the tax benefit. So tax amount will be negative or positive? That's what I've tried to summarize here. Can we get to the next one? Everybody? Alright. Next. Okay. Maybe this one also I'll explain. Is it okay? I'll try. It will come in the problem. Maybe once I'll try. If you have not got it completely, it's fine. It'll again come in a bigger problem. I'll explain it once more. But try to keep an open mind. I think it's possible to understand. Let's see. You remember we saw short-term capital gain and short-term capital loss. Because our adjustment was from PAT, we have to do 5 adjustment. Depreciation and OVAS. S for what? S can be for salvage value. Or S can be for Short-term capital gain, short-term capital loss, or it could be subsidy. Now we are targeting STCG or STCA. Now what is this concept is? Suppose you purchased a machinery. Investment decision was whether to purchase the machinery or not purchase machinery. Okay. Let's say machinery ka life is 5 years. How many? 5. So you come to do the project, you need a machinery. Machinery will last for 5 years. After 5 years, what you will do? Scrap it or salvage value. So let's say salvage value at the end of 5th year is 80,000. They'll give you this data. At the end of 5th year, when you sell this machinery, how much money you will get? 80,000. Any problem? Okay. But if you check the book value of this machinery at the end of 5th year is how much? 1. As per our accounts, or rather as per what is the book value of this asset? At the end of 5th year, 1 lakh. But did you sell it for 1 lakh or 80,000? Happy face or sad face? So value of the asset as per our records is 1 lakh. But we sold it only for 80. That means we made a loss. How much loss? You're making this loss now or 5th year? When you sell the asset, you'll make this loss. You will sell the asset immediately or end of the project. Here I assume project will end on 5th year. So this loss, which year it will come? 5th year. This loss we call it as short-term capital loss. This loss we call it as what? Short-term capital loss. Now just now we learned on loss you will pay tax or get the tax benefit. Get the tax benefit. Question will specify the short-term capital gain or short-term capital loss ka tax. Capital gain tax ka rate will be mentioned. Let's assume it is 30%. Let's assume short-term capital gain ka or capital gain tax is how much? 30%. So calculate 20,000 ka 30%. How much is it? 6. Comfortable? Huh? On this 6,000, when you are estimating cash flow, you will take it as a negative number or positive number? I think I took it as a ulta number. Actually, this sign is ulta, people. Okay, actually, the 6,000 you'll have to take it as a positive number because what? This is a tax paid or tax benefit. Benefit means in our cash flow working, we show it as negative or positive number. Which year ka cash flow you will take this? Every year you will take or 5th year? When you are estimating 5th year cash flow, you will also take 6,000 rupees as positive number. Okay, everybody? Just 1 second now. Okay, are we okay with this? Now let's say ulta case. What is the ulta case? Let us say you sold the asset. Book value is still how much? 1 lakh. Book value of the asset is 1 lakh. But now you sold it for 1 lakh 30,000. Salvage value is 1 lakh 30,000. Sad face or happy face? 1 lakh is the value of the asset. So you sold it for 1 lakh 30,000. That means 30,000 is your short-term capital gain. Short-term capital gain. If you make any gain or profit, you will get the tax benefit or pay the tax. So 30,000 is your gain. Tax rate is how much? 30%. Calculate 30,000 ka 30%. How much is it? Well, I think I take 9,000. The amount, it's okay. So 9,000 positive or negative? Negative. So this what you will do for this 9,000? Tell me. When you are estimating cash flows, this 9,000 you will take it as a negative number for every year or only 1 year? Which year is that? Year 5 you will take 9,000 as a cash out. That's all is your short-term capital gain or short-term capital loss ka concept. Understood, people? Some problems they will say ignore capital gain. Ignore capital gain. So you will do this or you will not do it. You will not do it. If they say calculate capital gain, then we will do this. It will come in a bigger problem. This is another working note you may have to put as an extra, as an add-on. Done. 2 more concepts. Small one. First I'll do of this. Subsidy. It's not subsidiary, it is subsidy. Okay. Now 2 ways subsidy problem can be asked. One, they will say subsidy is related to asset. Subsidy is related to asset. Now use your common sense. Suppose we purchase the asset for 10 crore. We purchase the asset for, because we purchase the asset. Okay. Now we are in 100% export business. We manufacture the goods and we do the export. Now government has an initiative. Whichever company is doing an 100% export business, government is saying we will give 1 crore incentive. We will give how much? 1 crore incentive to such company. Let's assume. So we bought a machinery for how much value? 10 crore rupees. So government gave back to us how much money? 1 crore rupees. We spent 10 crore for the machinery. Government gave us how much grant or subsidy? 1 crore. Yes. Because we purchased the asset, government gave a grant of 1 crore. Like this, government has put a condition. If for 100% export purpose, if you buy any machinery, government is telling, I will give you 1 crore rupees. That means you tell me, is the cost of the asset really 10 crore or 9 crore? 9. So what we have to do here? In this case, my subsidy amount, whatever you have received, you will reduce it from the cost of the asset. That means your net cost of the asset will be how much? So you will take 9 crore for calculating depreciation. Whenever now you're calculating depreciation, you will not calculate 10 crore. You will calculate it on 9. Because this subsidy is related to what? Asset. Question will specify that. If subsidy is related to asset, reduce that subsidy from the cost of the asset and then calculate what? Depreciation of that net number. So in this case, on 9 crore, you will calculate your depreciation and do the work. Easy na, Sarji? Point number 1. Second one, sometimes the government will say, if you are doing a business in a backward area, company is saying, if you do a business in backward area, then I will give you 50 lakh subsidy. Now you tell me, the subsidy is related to a particular asset or whole business? Whole business. If subsidy, if it is related to a whole business, then can you reduce it from the cost of the asset or you should not? No. That's what you should. If subsidy is related to a particular activity or a whole business, then you will not reduce the subsidy from the cost of the asset for depreciation purpose. So in the second case, you will calculate depreciation on what amount? 10 crore. So check the subsidy accordingly. So subsidy will have an impact on depreciation or it may not have impact on depreciation. But subsidy is always an inflow. Subsidy is always a inflow. Which year? Whichever year you receive. That question will specify. Year 1, year 2, year 4, year 5, whatever. Whether you will receive it. When will you reduce the subsidy from the asset? When will you reduce the subsidy from the asset? When it is related to the asset. If it is not related to the asset, don't reduce. But always consider subsidy for your cash flow calculation in the year whatever you have received. That question will specify. This is about subsidy. Done, Sarji? Okay. Then this, so I'll do a thing. This one maybe leave. I'll tell it probably in problems only. It's okay. This alone, I'll take it up one question on this. And now, your call. Now, we have done theoretically all the concepts relating to this we have covered. Now, questions. So, we have around 2 hours. Okay, roughly 2.5 hours. I'm planning about 6 questions. Let's see. Should be possible. So, now your call. If you want to take a short 5-10 minutes break and resume, we are comfortable with that. Or do and give us lunch break, one shot under it. That is also fine by me. Whichever way you say. What do you want to do, Govinda? This is where you say and I listen. You know, if you want break, I don't know, we can keep it open. We can take 5-10 minutes break and resume. I'm fine with it. Break, Okay, so how many minutes break you want? 10 minutes? 11:05, can we resume? Come back in about, 10 minutes break. Okay, sir. Thank you. Done, people. I think we have covered all the concepts. Now we'll have to do some questions relating to this. So one by one, let's start off. I think MIRR related one we covered. So it's fine. And now this one. Okay. Payback period. You just maybe one. Actually, they've given 3 projects. And they've asked us to calculate multiple things. They've asked us to calculate payback period, NPV, IRR, ARR. NPV and IRR I'll skip. That is way too simple. We have already calculated. And NPV you have to calculate in bigger problems. We'll leave that. Payback period. Maybe for one project, can we calculate payback period quickly? Just to have a little idea. Okay. Now, here for project A, if you just check, year 0 May, they've given negative 5,000. So what is this? Outflow. All these are positive numbers. So these are inflow. If you just check, they've given it for 10 years. It's these two are there in the next page. So I've written here. Project A has how many years ka cash inflow? 10 years. Is it number changing every year or same? Same. Sir, if annual cash inflow is same every year, payback period is simply given by what formula? Initial investment divided by annual cash inflow. Initial investment is 5,000. Every year ka cash inflow is 900. So divide these two. How much are you getting? So 5.5 years is payback period of project A. Straightforward. For project B, is the cash inflow same every year or changing? Hence what we have to find. Here only can we find. You have to find something what? Cumulative cash we have to find cumulative cash inflows. For payback period, don't start with outflow. Start only with the inflow. First year inflow, how much? 700. First year, can we add anything or nothing to add? So second year, it will be 700 plus 800. Totally, how much have you recovered? 1500. 1500 plus 900. Third year, how much? 2400 plus 1000. 3400 plus 1100. 4500. Our initial investment is 5000. So we have to cross. Till we cross 5000, you have to go on finding. 4500 plus 5200. 1200. 5700. My initial investment is only 5000. Is any number exactly 5000 or no? No. But by the end of 5th year, how much you recovered? By the end of 5th year, you have recovered 4500. By the end of 6th year, you have recovered 5700. That means payback period is somewhere between year 5 and year 6. So take the lower number. Between year 5 and year 6, what is the lower number? 5. 4500 you have already recovered. But we want to recover how much? 5. So formula is lower number plus what? Required cash flow divided by actual cash flow. 5. Required cash flow is 5000. But we have already recovered how much? 4500. So how much more we have to recover? That is the required cash flow. How much do you actually recover? These two difference is how much? These two difference is how much? 1200. That is nothing but your 6th year. What is the 6th year actual cash inflow? 1200. So do that. 500 divided by 1200. 500 divided by 1200 plus 5 you do. How much are you getting? 5.42 years. That is a payback period for project to be easy. Okay, CA I'll leave it. It's okay, comfortable overall, no? So payback period we have done. Next, NPV we are leaving. ARR. Now ARR, if you just check for ARR, we need, all these are cash inflows. All these are cash flows. For ARR, we need cash flows or PAT. But have they given or not given? Now we already know what is that. If they don't give PAT, there is a workaround. How do we find? Maybe let's do it for project C. How do we do? First, find out what total cash inflow. Add all this. Only cash inflow you had? 7,000. Okay, now what is the total cash outflow for project C? 5,000. So inflow you can interpret it as an income. Outflow you can interpret it as a expense. From inflow, if you reduce the outflow, how much are you getting? 2,000. What is that 2,000? Profit, average profit or profit for how many years? This is a cash flow for 1 year or 4 years. So this is what? Total PAT for 4 years. Why 4 years? Because project CA, if you just check, cash flow only comes for 4 years. Yes, sir, people. We need average PAT. How do you get average PAT? For 4 years, if the PAT is 2000 means, for an average, how much is it? That's your average PAT. Clear, Sarji? Now we need one more number. What is that? Average investment. Initial investment is 5,000. I will not do using initial investment. I will take up average investment. Both are acceptable. Tell me what is average investment ka formula? Half of initial investment minus salvage. Close the bracket. That's working. Initial investment for project C is 5,000. Salvage value, any data? No data. Plus 0 plus 0. Nothing. So how much is this number? 2,500. So your PAT is 500. Average investment is 2,500. So what is your ARR? Average PAT 500 divided by average investment 2,500. Since the return we express in percentage, multiply by 100. That's a quick calculation. Showed you the proper format and all here, but just say quickly we are doing it, revising. That's okay with you, no? Yes. So, from this problem, I think takeaway is that we don't have to spend any more time on this. Agreed? Okay. Holiday, madam. No. After today, full holiday, much, huh? Yeah, this is done now. Next. Okay, next. Few questions. You can say all these are some exam questions. Or maybe one I'll do a thing. I'll take this in a bit. Let's start with this question maybe. It's a question number 30. It's there in study material also. I think this was an RTP or MTP question. Now it's added to our study material only. Let's see. Okay, these kind of question you can expect in the examination. This one may be somewhere around 6 to 7 marks or 7 to 8 marks. We'll see. Check. Navajivani Hospital is considering purchase of machinery for some purpose. That's okay. That's their problem. How much is the price? 2 lakh. In order to buy the machinery, how much it will cost? 2 lakh. So inflow or outflow? So this 2 lakh is an outflow. Okay. Life of the machinery is 8 years. Salvage value is 18,000. So All this data is helpful for us to calculate depreciation. That is one. Okay. The annual operating cost of the machinery is 22,500. If you have any machinery, you will also have to maintain it. No? So there is some extra expenditure of 22,500. Okay. It is expected from this machinery, you are expecting to generate how much revenue? 1,20,000 per year. Every year you will get this much revenue. And this is what, sir? 22,500 is one-time cost or annual operating cost? Every year you will get this expense. Every year you will get this income. But we don't want income and expense for this analysis. We need cash flow. So we know how to find cash flow, right? We have discussed that. We have to estimate cash flow here. Okay, read this line. Presently, hospital is outsourcing the radiography work. Currently, this hospital, no, they don't have machinery. So they are outsourcing this to some other testing center. Normally, when hospital gives the work to some testing center, there are many testing centers. No? Why should they give it only to one particular testing center? Because they will get some commission. So here, is there any commission check? Presently, hospital is outsourcing this radiography work to one of the neighboring testing center and earning commission of how much? 36,000. Currently, this is commission paid or commission received? We are giving this work to some testing center. That's the reason that testing center is giving the hospital 36,000 commission. There's an income. But now you tell me, once we buy this machinery, will we give this work to testing center or we will only do that work? We will only, let's radiography or our understanding, let's keep it as X-ray for simplicity purpose. So currently all the X-ray work we are giving it to testing center. Now if you buy an X-ray machinery means, will you outsource or hospital only will do? So this commission now henceforth hospital will get or they have to sacrifice? To sacrifice. This only we call it as opportunity. Now this one you will take it as a positive or negative? Negative. One income which the hospital was getting, they are sacrificing. One income, one benefit, one positive number which hospital was getting, now they are sacrificing. So that means we should take this as positive or negative. This is an income sacrifice. So you'll have to take this as what? Outflow. Understood? And income is reducing. Income is reducing means you will put a positive sign or a negative sign. Negative sign. Understood, sir? Got it. Next, and this is of net of tax. Great. Now you need to analyze whether the hospital should purchase the machinery. Whenever they ask you analysis, give the analysis based on NPV. Or sometimes they'll only say give the analysis based on profitability index, based on NPV and all. So give your, here only they have told, check. Give your recommendation based on NPV and profitability index. So to calculate NPV, what do we need? Present value of cash inflow minus present value of cash outflow. Outflow is very clear. How much? 2 lakh. And we have purchasing the asset now only means outflow is already on which platform? Present value platform. We just need to find cash inflow. Given or not given? Not given. So, but they have given income and expenditure. Give me estimation of cash flow. Again, that estimation statement. From income, reduce all the expense. You will get profit before tax. Reduce tax. Have they given tax rate? No. Oh, I think here it's given. Tax rate is 30%. So then you will get profit after tax. Then 5 adjustments. What are those? Depreciation. Oh. Here opportunity cost is there. Working capital not there. Additional investment not there. Salvage value there. Subsidy short-term capital gain not there. No information. Clear, sir? And at 10% present value factor, they only given from year 1 to year 8. So this is each year ka discount factor. Each year ka discount factor is PVAF or PVIF? PVIF. Done, sir. If you add all this, what are you going to get? If you add all this, you will get PVAF. Sir, if they have given 3 decimals, you will have to take exactly 3 decimals. Now you don't have a choice. If it is not given, you have a choice to take 2, 3, 4. Usually ICA these days in the last 2-3 years have starting to take 3 decimals. Majority of the suggested answers, they are taking 3, but it's okay. I mean, sometimes they modify that. But if they have given 3 here, you have to exactly take 3. Add all this for me once. Quickly tell how much is this. Add all this. No, don't calculate. Only add this and tell me how much is PVAF. Hmm? 5.334. Okay, first working note we'll have to put up is the estimation of cash flow. Okay, take your calculator. Now people, every year cash inflow, is it changing or same? Same. Sir, every year you are getting same revenue. Every year operating cost is also same. Have they told depreciation is under WDV method? No. If they don't mention depreciation, we'll always take depreciation under SLM. If they mention WDV, take it. Otherwise, depreciation always be calculated under SLM. In SLM method, depre will be same. Sir, if every year ka income is same, every year ka expense is same, means cash flow also will be same. Na? I mean, should we have to have 8 columns or 1 column is good enough? Even if you have 8 columns, it is pointless. Why? You'll get the same data. So in this problem, I have a luxury. What luxury? To put up 8 column or 1 column is enough. But suppose every year ka income expense changes means, then you need to have all the years ka column. Here all or 1 is good enough. 1 is good. Now this we will solve. Check. So take a calculator. How much is the income, people? 1,20,000. That's the only income available. Okay, taken that. Next to operating cost is there. How much is operating cost to? How much is the annual operating cost they told? 22,500. From income you have to reduce all the expense. So this is your expense, annual operating cost. Done now. One more. What is one more? Depreciation. So calculate if they don't mention which method we will go for, SLM. What is the cost of the asset? 2. How do you calculate depreciation? Original cost minus salvage value divided by the life. Original cost 2 lakh, salvage value 18 divided by life 18 years. Calculate how much is depreciation? 22 cents. That's it. Any other expense, any other income, or that's all? So from income, if you reduce all expense, you'll get profit before tax. Tax they told in the last line 30%. So I've reduced 30% tax rate. We got profit after tax. Agreed on. After PAT, need a minute? Or okay. After PAT, 5 adjustments. What are those one by one? Add back depreciation. How much we add back? Whatever you have reduced. First, again tell me, why do we reduce here? Why do we add back here? We have to reduce here for the purpose of tax. You will pay tax after deducting all the expenditure. But you have reduced 22,750. Did cash go out due to depreciation or it's a non-cash item? Hence add back. That's the first adjustment. Then what? OAS. Oh, here opportunity cost is there. Huh? Yes. One expense you are sacrificing or one income you are sacrificing. Income. What is income? What income is that? Commission income. How much is that? 36,000. Always keep in mind, we should always take opportunity cost after tax basis. You have to take opportunity cost on a after tax basis. Because this number is what? This number is after tax. Hence, all this number should be what? After tax. Either they will say after tax or they will say net of tax. Okay. But by chance, if they say opportunity cost is before tax, then what you will do? You'll have to do after tax basis. Maybe first I'll do this and then tell you how to get that. But in this problem, it is net of tax only they told. No, I mean this is after tax. After tax opportunity cost is how much? 36,000. I have to take it as plus or minus? Minus. Why minus? One income we are sacrificing. So minus 36,000 is done now. Yes. Done. Next, W, working capital. There are no. O over W over. Then additional investment, not there. S for salvage value. But here be a little careful. Sir, this heading is what? Annual cash inflow. That means all these numbers you will get it every year. This income, this expenses, opportunity cost, you will get it every year. Salvage value, you will get it every year or only once. So when you are doing one column approach, salvage value, you should not put it here. Consider it separately. Because if you consider here, salvage value should be considered, but it should not be considered in this working note. Why? Because all these numbers comes every year. Salvage value comes every year or only once. If you don't want that, then put 8 years. Then you will consider properly. But that will be wastage of time. Are we okay with this? Yes. I need to consider salvage value, but I can't put it up here because all these numbers repeats every year. Next table, I will consider salvage value. Okay, Sarji? Yes. Alright. By doing all this, how much is the cash inflow you're going to get? 39,075. Now we'll calculate the NPV. Tell me people, for NPV calculation, we need 2 data. What are those? Outflows and inflow. Both has to be on what platform? Present value platform. How much did you buy the machinery for? 2 lakh. So when will you buy the asset? Immediately. Immediately only we call it as year 0. At year 0, inflow and outflow. We have to buy the asset by incurring 2 lakh. So this is outflow. Agreed? What is the discount factor they told in the question? They only told discount factor is 10%. So this is your 10% discount factor. At year 0, discount factor is always 1. So these two, if you multiply, you will get present value, which is 2 lakh. Agreed? Then every year, how much is the cash inflow? 39,075. This cash inflow means you will show it as negative or positive. What is the life of this project? 8 years. You will get this number only once or every year? For how many years? 8 years here, I think, no? So if number is same every year, should you have to have 8 column or can we use PVAF? If cash inflow is same every year, you can put 1, 2, 3, 4, 5, 6, 7, 8 and copy 39,075 in all the years. But wastage of time. Rather we can do what? PVAF method. Same cash flow every year, no? So take the annual cash inflow. Instead of discount factor, will you take PVIF or PVAF? PVAF you already calculated. When you added all the discount factor, you got how much? 5.334. Take 5.334. Okay, you can also do individually also, that is your call. Multiply these two to get the present value. Comfortable, huh? But hang on. For cash flow statement, from PAT we do how many adjustments? 5 adjustments. One is depreciation. Did you already consider depreciation? Yes. And then OO for opportunity cost. Since opportunity cost comes every year, commission you used to earn every year, that was also considered. Next is what? Additional investment. Additional investment will come every year. Huh? So in this problem, if additional investment was given, will you consider in this table or this table? Second table, because it will not come every year. Be careful about that. Then working capital. Working capital will come every year only in 2 columns. 2 times. Once at year 0, then at the end of the year. So if working capital was given in this problem, will you put it in this? Will you put it in this table or the second table directly? Second table directly, because it will not repeat every year. Okay. And then S for salvage value. Salvage value in this problem, is it not there or there? Can you update here? No. Why? It doesn't come every year. Which year it comes? End of 8th year. Have you considered it here or not yet? Now bring it in here. Which year salvage value comes? End of the project. Here end of the project is 8th year. Salvage value is an outflow or you will get. Salvage value means by selling the asset, how much money you will get. How much is your salvage value? Check the question. How much is the salvage value they told in the problem? 18,000. That is the salvage value. Outflow or inflow? Inflow. Now you will take PVAF or PVIF. This you will get only once. That too in which year? 8th year. So at 10%, 8th year ka PVIF they only given in the problem. At 10%, 8th year ka PVIF is 0.467. That's what I've copied here. Okay, so this is the future value. 18,000 you will get it after 8 years. So multiply discount factor and you will get the present value. These are your present value of cash inflow. This is your present value of cash outflow. Net off and you will get the NPV. Done, Asarji? Any problem, Asarji? What is the decision rule? Reject or accept? Since NPV is positive, you will accept. They also ask profitability index. How do you calculate profitability index? Present value of cash inflow, these two numbers, divided by present value of cash outflow, that number. That's what I've done here. You'll get profitability index. Since the index is greater than 1, decision rule again is what? Accept the project. You can give one decision rule. Since NPV is positive and profitability index is greater than 1, the machinery can be accepted. Like that, you can give a decision. Got it, sir? And this is one problem I've picked where you can do annual cash inflow as 8 columns or 1 column. And next, I've picked up one problem where every year ka cash inflow will change. In that problem, I'll put 1 columns or all the 8 columns. That is the next. Can we try that? Try that now? Okay. Great. Next. Okay, look at this one. Expense added, not after tax, right, na sir? What expense add, macha? I didn't understand your question. NAV CA, Naveen CA, na? Rephrase it, macha. Okay, in the meantime, we'll move forward. You rephrase it, I'll answer it for you. Okay, question number, this is also, I think, same. Some RTP, MTP question now bought into our study material itself. In this problem, almost study material has been, they have brought some good questions. We have many questions in ICA material only. So they are more than enough in my view. Okay, now look at this question and see what we can learn from this. XYZ is planning to introduce a new project with a life how many years? 8 years. Initial equipment cost 3.5 crore. Okay, initially you have to buy an equipment means, initially means here what? Year 0. Inflow or outflow? So 3.5 crore is year 0 ka outflow. But we also need an additional equipment. Stop there. Additional equipment means? Additional investment. Do you think it will come at year 0 or any year? Check. Additional equipment ka cost is 25 lakh. It will be purchased at the end of 3rd year. So that means this will come only in the third year as an inflow or an outflow. This is your additional investment. Okay. At the end of 8th year, original equipment will have no resale value. So we have two equipments now. So if you have two equipments, you will calculate depreciation on one or two equipments. Two equipments, that is one. So they are saying original equipment will not have resale value, means salvage value of original equipment is 0. But additional equipment can be sold for 250. So that means salvage value of additional equipment is there. But when will you, this is a what, outflow or inflow? Salvage value, inflow. When you will get, now or end of the project? What is the end of the project? 8 years. Working capital is also there. Working capital, you know, 40 lakhs. What you have to do? Tell me, two treatments. Year 0 mein you have to take it as a outflow. Year 8 mein inflow. Okay, ji? Alright, next. They only told working capital of 40 lakh will be needed and it will be released at the end of 8th year. Meaning you will recover at the end of 8th year. Even if they don't say this, will assume any which way, same. The project will be financed with equity capital. That's okay. Sales volume, value. Volume means number of units sold. For 8 years they've given. Is it same every year or changing every year? So like last problem, can we have one column here for cash flow estimation or 8 columns? Because since every year number of units is sold is different, every year ka sale will be different. If one data changes means we'll have to have all the separate columns. We can't do it common. Okay. This is number of units. What is the selling price per unit? 240. So if you multiply this with this, what are you going to get? Sale value. But keep in mind, here they have told year 4 and 5 270. 2,70,000 is not total sales for year 4 and year 5. For year 4 you have sold 2,70,000. For year 5 also you have sold 2 lakhs. Both the years you have sold 270. Here same. Year 6 also you have sold 180. Year 7 also 180. Year 8 also 180. And if you multiply by the selling price per unit, you will get the total sales value. Variable expense is 60%. They have given of sales revenue. Great. Here they told, or is it okay simultaneously we'll work it off? Yes. As and when we see. Okay, take your calculator. 72,000 into 240. Let's do a thing. Since the numbers are big, let's present all number in lakhs. 72,000 in lakhs will be 0.72. This will be 1.08. This will be 2.6. This will be 2.7. This will be 1.8. You can't present full number, but since we have 8 column, you may not have that much space in exam. So maybe better to present in thousands or lakhs or crores just to save space. So multiply. This is a unit sold multiplied by 240. Selling price per unit. How much is the sales? 0.72 into 240. How much pa? 172.8. Okay, then 1.08 into 240. 259.2. Okay, then 2.6 into 240. That is your 624 lakhs. From year 4 to year 5, 2.7. 2.7 into 240 is? 2.7 into 240 is, how much you said? 640. Year 4 also 648. Year 5 also 648. Like this column. Okay, now sorted out. That is your sales. And they told variable cost is what? 60%. So reduce. One expense we got variable cost. It is 60% of sale. If this is your sale, means 60% of that is variable expense. Pretty straightforward. We'll not worry about all numbers. But are we okay with how to calculate each year ka numbers? Why am I having all 8 columns here? Because every year ka income and expense same or different. If it is different, you need to maintain separate column. If it is same, then you can present like last problem. Okay, one we got. Sales we got. Variable cost we got. Next, what have they given? They have given fixed cost. They gave fixed cash operating cost. Sorry, depreciation is a cash or non-cash? Non-cash expenditure. That means in this, sir, if they don't tell the method, depreciation, we always go for which method? SL. So that means depreciation also will be a fixed cost. But is this fixed cost included in this fixed cash operating cost of 36 or not included? How can you conclude? Because they told in the problem fixed cash operating cost. Depreciation is not a cash expense. It is a non-cash. So this 36 lakh is excluding depreciation. Okay, Sarji? Okay. There's one more expense. They only gave 36 lakh. So what we have to do? For this 36 lakh, what you have to do? Reduce. Have we reduced it? Check. 36 lakh every year. So we have reduced. Done now. Now we can correspondingly calculate one more data, which is what? Depreciation. So here, I think I'll put a note for depreciation. Why? There are two machineries, and that too you purchase them on the same day or different dates. So it's better to have a working note for clarity purpose. I'll read that data again. First machinery, you bought it initially for how much value? Salvage value 0, they told. What is the life? 8 years. So calculate depreciation on this asset. 3.5 crore is the original cost minus salvage value they told is 0 divided by life 8 years. How much is that? 3.5 crore is nothing but 350 lakhs. 350 lakhs is nothing but 3.5 crore. So 350 minus 0 divided by 8, how much is that? So on original equipment, depreciation is 43.7. Yeah, 43.7. Clear? We have only original or also additional. But be careful. When did you buy that additional asset? You bought additional asset by paying 25 lakh when? It was purchased at the end of third. Means on this additional asset, depreciation will come. But from which year on? You purchased at the end of third year means this depreciation will only start on this asset. Depre will start from year 4. And life of the project is year 8. So year 4, year 5, year 6, year 7, year 8. That means the life of this machinery is only how many years? 5 years. Got it? They have not given. But you should take the life as 5 years. Got it? Cool. Yes. So now calculate depreciation on this asset. Original cost 25 lakh. Salvage value they told additional equipment can be sold for 2.5 lakh. Here given. Divided by life, you will take it as 8 or 5 years. Because you bought this asset only after 3 years. Total project ka life is 8 years. If you buy this asset after 3 years means life remaining is only 5. Calculate how much is this? 4.5 lakhs. So that means from year 4 onwards, additional asset ka depreciation will be 4.5. So that means read this, see if my statement is right. For first 3 years, total depreciation will be 43.75 because you don't have any additional asset. But from 4th year onwards, on original asset 43.75, on additional asset 4.5. So from 4th year onwards, total depre will become 48.2. Done now. Everybody good? So this data I'll have to bring it into my table. Can we capture? So for first 3 years, 43.75. From year 4 onwards, 48.2. First 3 years, 43.75. From year 4 to year 8, 48.2. Okay? Yes. Okay. I'll come to you, Naveen. Hang on. Let me finish this question. Online, if some of your doubt is not answered, I'll take it up. In the middle of problem, I would not like to revisit. I'll finish this and then take whatever it is. All right. Where were we? Okay. They're saying loss of any year can be set off for 2 years. So that means loss set off ka concept they've told. Is the information silent about set off or given? So they told loss of any year can be carried forward and set off for 2 years. So we'll see. We'll use this information later. Tax rate is how much? 30%. So after tax cost of capital is 12%. After tax cost of capital is nothing but your discount. In this problem, they're told discount factor is 12%. And they're saying straight line method of depre. Even if they don't mention, we will obviously go for. We will go for WDV method only if the question specifies. Otherwise, no. Okay. You need to calculate NPV of the project and give the decision making. At 12%, they've only given 8 years each year ka discount factor they've given. What is this? PVI. Okay, so let's calculate. So visualize. So again, all the income I've considered. Yes. All the expense also we have considered. So income minus expense gives you what? Profit before tax. First year, this is your income, this is your expense. First year, you got a loss. So first year, when you get a loss, if question is silent, what you'll do? About loss, if the question is silent, what you'll do? You'll take this number and multiply tax rate and take the tax benefit in first year. Here, question is silent or they told you can carry forward for 2 years. If you can carry forward the loss for 2 years, then year of loss, you'll make the tax to be 0. Next year, what you'll do? Will you pay the tax on 23.93? No. Next year, profit before tax is 23.93 means first adjust previous year ka loss. That's what I've written here. 23.93 minus 10.63. On this, you pay the tax at 30%. Calculate this for me. These two you net off and calculate 30%. Confirm if you're getting 3.99. Yes. That is a tax for second. Clear, Sarji? Yes. Next year onwards, normal. Only first year mein loss came. Rest year mein profit is there. Even if 4th year, if loss comes, same thing. What you will do? If by chance 4th year mein loss comes, that means that year you will make loss to be, tax to be 0 and then adjust it in the next. Like same fund. But usually they give it only in the first year. That's a usual way they ask. From PBT, if you reduce tax, you will get profit after tax. Now, if you're doing all the 8 years ka column, that means I can do all the adjustment within the same table. What are those adjustments? 5 adjustments. Tell me what are those? Add back depreciation. Whatever you have reduced, add back. That is first. Same copy paste we have to do. Then opportunity cost. O was. O for opportunity cost, not there. W, working capital. Yeah, there. I've started with year 1 now. So working capital 2 adjustments. What are those? If you want, you can also have year 0 column here itself. That is also acceptable. That presentation also. Okay, you can do it if you want. Year 0, I've taken it separately here. Presentation is absolutely whichever way you want, you can modify. So working capital ka treatment, once again, you tell me what we have to do. Year 0, you have to take it as a outflow. End of the project, inflow. How much is working capital in this problem? 40 lakh. At year 0, you have to take 40 lakh as an outflow. At the end of 8th year, you have to take it as a inflow. So 8th year, have they taken it as positive check? Working capital. Working capital, 40 lakh positive. Okay, sir. Yes. It will not come every year, only at year 0 and end of the project. O over W over. Then A. A is there. You purchased additional equipment by paying how much? 25 lakh. Which year? 3rd year ending. So this is your 3rd year ending. 3rd year ending mein here additional investment 25 lakh. So additional investment means you are getting the money or spending the money. So inflow or outflow? Outflow. So negative. O over W over A over. Next. Salvage value. Salvage value erika? Yes. Which asset ka? Additional asset has a salvage value of 2.5. Salvage value will come every year or once? Which year? End of the project. Which here in this problem is 8th year. So 2.5 lakh taken as positive number in year 8. Year 8. Salvage value 2.5 lakhs. Okay, people. So all consider no subsidy, no STCG and all over. So do this, you will get what? Every year ka cash in. Net cash flows. Cash flow can be positive, negative, really doesn't matter. Every year ka cash flows you have got. Okay. But all these are on present value terms or future value terms. Like this cash flow 33.12 you will get at the end of first year. This 63.69 you will get at the end of second year. Now you can stop this table here and then prepare NPV. Or for NPV, what do you need? You tell me. You need present value of cash inflow and present value of cash outflow. This is future value of cash inflow. No, here only multiply discount factor. What are you going to get? Present value of cash inflow. So that more or less you can finish the problem here only. If you want, you can have a separate table for NPV. Absolutely your call. But I prefer that you do it here to save some time. Discount factor ka we have to calculate discount factor or they only give discount factor for each year. They only given copy that exact number. This is your future value. This is your discount factor. Multiply and you will get what? Present. But all these are what? Present value of cash inflow. Now we have to take present value of cash outflow. There are 2. Can you remind me which are? 2 are there. What are those? 1, you purchased an initial equipment by investing how much? And then there is also working capital. You will have to consider how much? 40 lakhs. So I would say if there are more than one component, always prepare a working note. So if there is no working capital, then you don't need to have any working note for year 0 ka outflow. But if there is any working capital, then it's always better to, in my view, to present separate working note for year 0 outflow. What is year 0 ka outflow? 1, you purchased an asset for 3.5 crore or 350 lakhs. Then there is also working capital for 40 lakhs. So totally what is year 0 ka outflow? All numbers are in lakhs, so 390 lakhs. Since both happened at year 0, they are already on what platform? You can call it as year 0 outflow. You can also call it as present value of cash outflow. So this is your present value of cash inflow each year ka. If you sum it up, you will get, I've written here, total present value of cash inflow is 551.123. Addition of all this. Okay. That's the present value of cash inflow. What is the present value of cash outflow? 390. Inflow ka present value is 551.123. Just addition of this. Outflow ka present value is 390. So is your NPV negative or positive? NPV is positive means reject or accept. You can change your presentation according to your needs. Okay, sir. I've just given this. In my view, all these can save some time. So I have followed this. Okay, you're free. Maybe opportunity cost. No, one problem is there. I think I mentioned opportunity cost should always be taken on what basis? After tax basis. I mean, I think someone's doubt is what if it is before tax and all. Okay. I think there is one problem where this will come. Maybe can you remind me after this problem is over? If that problem doesn't come, I'll build a small scenario and we'll cover. I think one problem is there. NAVCA, Naveen CA, Naveen, we'll call it as Naveen. Okay, Naveen, we will wait for maybe another hour. Maybe your doubt is covered in one of the problems. If it doesn't, then you also post the message one. You guys also remind me once. So 2 problems over. Next, 11:45. Okay, we'll 1 minute. This is a little later. Okay. All right. We'll take up this question. This was RTP May 2019 question. Now it's bought into our recent MTP or it's bought into study material only somewhere. Okay. Lengthy question, but easy question. So let's see. Okay. Let's review this quickly. BT, so far, okay, everybody? In terms of understanding, are we fine? And 1 or 2 mistakes, if it happens in bigger problem, learn to forgive yourself. It's okay. It's expected. But see, now I did the last problem, right? So you said yes. So when you try to probably put it up, right, you'll have to solve it in 20 minutes or max 25 minutes, depending on the mark. So when that comes into picture, so if someone says do the problem, then you'll be like, aram se you'll think about your girlfriend or boyfriend, your life in general, oh yeah, aram se you will solve. So it will happen. But the moment time comes into picture, it brings unnecessary pressure. That time, now suppose you did estimation of cash flow, for that only you took off 18 minutes. Then you will be like, oh, suddenly book will start. Then due to that nervousness or time shortage, some mistakes can happen and it is fine. Okay, if something happens like that, it's all right. There will be marks given as a step working notes. So focus on as much as possible on the working notes. Okay, so it is okay. Don't freak out just because you got one problem wrong. Right? Few people we have seen out of nervousness. See, all this may sound very simple at the outset. Okay, it can cost you one attempt. Out of nervousness, I've heard some of the students say they did some steps. Okay, they got to know that they did a mistake. You know, when they do a mistake, what they will do? You know what they told they did? They scratched off the whole solution. Sir, one mistake was there here. All these were right. But nervousness, man, or whatever reason, just they struck off. It's because some of them will think, I'll redo it. Even if you think you'll redo it, no problem. Leave whatever you have done, leave it as it is. Once you have completed that one problem once again, then only you strike off the old one. Till then, don't. Because once you strike off, nobody will evaluate. Doesn't matter whether it is 90% correct or 100% correct or 0% correct. Once you strike off, it is gone. Nobody will evaluate that. So don't do that. Small mistakes can cost you. Okay. And you can't even expect the invigilator there and say, show mercy, gets here. All that will not work here. Okay. So that's what they say. CA is more about smart work. How you handle the pressure, how you handle your syllabus, how you handle yourself. That kind of accelerates how quickly you become a chartered accountant. So that is very, very important. How you keep yourself calm. So always I would suggest write some mock papers. Put yourself through that little environment. Go to some different place and write a mock paper for 2.5-3 hours, the exam duration, to see how you feel, how much time you are taking for each question. Get a pulse of it. So once you go to the examination, you feel that if you have done already 1 or 2 mock papers, then you know that this is how an examination question will come. 1 or 2 adjustments are new and you already know how you tackled it. So that is important. And don't freak out. Even if some students always reach out to me, sir, I've already taken 4 attempts. Is it worth to continue and all that? People in life, I consider, right? All these are not mistakes. All these are experience. Yes, we would love to crack it in 1 attempt. But there is a learning exercise in everything. That's the way I approach, right? What is the learning is, see, for a person who cleared everything in first attempt, right? Okay, suppose a person scored a rank. Everything first attempt, topper, cleared. Now when they go to a corporate, They only know how to study. Corporate is a different ballgame. When you do a mistake, people will all be like, yo, kanda, nah. Right? When you do, right, people are like, they will give you a slap in a different way. Right? There is a diplomatically, they will give you a chata R1. Right? That time when they handle the failure, first time when they handle the failure, maybe at corporate level, right? Too much to take in. We've seen so many people going into depression, quitting the job. Why? Because their manager told something. How can you tell like this in front of everybody? Because they've never handled that failure till now. Right? But if we have gone through some 3-4 attempts, we know how we have become, our skin has become thick, and it will absolutely have no impact to us. That is also good feeling, sir. You need to know how to handle the failures, because in life, everything will not be very smooth journey, right? It's like our life is like ECG, it should not be like flat line on ECG means you are gone. ECG machine should always show like this, then only life is happening, right? So our life will go like this. So if you are going through certain experiences like that, few attempts have passed, don't curse yourself. Think about what mistakes you did and see how you can correct them. That is also good. If you have faced initial failures, then you know already the time value of money. In future, you will not commit those mistakes. You will correct it. In corporate, you know that I should not, because you already know that one step you are already behind. So take it as a learning experience. So don't give up. I would still say one more attempt. Doesn't matter you are in 4th attempt, 6th attempt, 8th attempt, whatever attempt. In my view, if you are still not giving up, if you're still writing, that degree has to come. 1 or 2 attempts here and there can happen, but it will still come. But still, all the best, and I'm proud of you. Okay, come back to question number. You passed 5th attempt, Amacha. Awesome, Amacha. Good for you. See, that is what I love. Your failures also openly you should showcase. That's an amazing talent. Usually people will showcase their bigger things, their success. Showcasing the failure shows how strong mentality you as a person you have. Respect, Macha. Good da, Macha. And he has put also there, NAV CA. So he's already CA in his mind. Proud of you, Macha. Super. Okay. Now come to the pathology. Question. What pathology? Question. Okay. Question number 39 ka some pathology question we'll see. BT Pathology is one company. They are using one X-ray machinery which reached the end of useful life. They already have an X-ray machinery. It's almost come to an end. Now, new X-ray machines are of two brands with the same features are available for purchase. Now, this one they want to sell off and probably buy a new asset. Now, they are thinking either we can buy brand XYZ ka new X-ray machinery or we can buy ABC ka. So, we have 2 assets which we can buy. XYZ will cost 6 lakh. ABC will cost 4.5 lakh. XY ka life is 15, ABC ka life is 10. Okay, sir. Whenever life is unequal, life comes, we have to calculate EAC. Keep in mind, EAC can be worked out on benefit angle or cost angle. From benefit angle means you will select the highest. From cost angle means lowest. Fine. So, if you just check, they have not given benefit. They have only given maintenance cost. For year 1 to 5, maintenance cost how much? 20. 6 to 10, 28. 11 to 5, 30. As the asset becomes older, you have to incur more and more maintenance cost. No? So, maintenance cost will go on increase. Depre rate is 4%. That's a data for XYZ. ABC ka you will buy for how much? 4.5. Life is only 10 years. So, first 5 years ka maintenance 31. Next 5 years ka maintenance. After that, nothing. Depre rate is 6%. Okay. Residual value of both the machinery. Read this line. This is the only actually highlight of this question. Okay. Other things are all pretty straightforward. Residual value of both the machinery shall be dropped by 1/3 of the purchase price. 1/3 of what price? Purchase price in the first year. And thereafter it should be depreciated at the rate below. Sir, why will residual value drop? Why? It will drop in first year. That I agree. They only told. Yes, it will drop in first year. We got that. How much also it will drop? We know. How much is that? 1/3. 1/3 of what? Purchase price. Purchase price is 6 lakh. 6 lakh ka 1/3 is how much? 2 lakh for XYZ. 4.5 lakh ka 1/3 is 1.5 lakh. Okay, that's the droppage value. It happened in the first year. My question is, why will residual value drop? Sir, if you use the asset more and more, right? If you use the asset, then value will be same or value will drop? Sir, due to usage, you account something in books. What is that? Depreciation. Means indirectly what they say. First year ka depreciation is 1/3. From second year onwards, you have to calculate at the rate mentioned above, which is what? 4 and 6. That's what they are trying to say. First year ka depreciation is 1/3 for both the asset. Thereafterwards, from year 2 to year 15, you have to calculate at what rate? 4% for this asset, 6% for that asset. Got it on. That's all is the highlight of this question. Can we work off this simultaneously? So calculate depreciation for first asset XYZ. First year how much? 6 lakh ka 1/3. How much is 6 lakh ka 1/3? 2 lakh. Okay. Thereafterwards, sir, what is the total life of this asset? 15 years. In that 1 year depre already calculated means how many years remains? 14 years. You have to calculate depreciation at what rate? 4%. So what is the value of the asset? 6 lakh. So calculate 6 lakh ka 4% for how many years? 14 years. Multiply. 6 lakh ka 4% into 14 years. How much is that? 3 lakh 36,000. Everyone okay with this? So first year how much depre, sir? 2 lakh. Then next 14 years, how much depre? 336. Add these two, how much is that? Add these two, how much is that? 5 lakh? 5 lakh? 36,000. You bought the asset for 6 lakh, you depreciated it for 536 means how much remains? 60,000. That indirectly they're telling is nothing but your salvage value. That is nothing but your, indirectly they're saying you can sell this asset for 64,000. Done na, Sarji? Everybody good? So basically, you'll have to calculate salvage value in this problem, which was not given through this mode. Okay. Pakka, everybody? So similarly, calculate salvage value for next brand. Let's see how well you got it. Let's redo it over here. How much did you originally buy it for? 4,50,000. First year, how much the salvage value will drop by? And the first year, it will drop by 1/3. So 4,50,000 ka 1/3. How much is that? 1,50,000. Thereafterwards, you have to depreciate. What is the life of this asset, sir? 10 years. First year you got it. So how much life remains? 9 years. So now calculate. 4,50,000 is the value of the asset. You have to depreciate at the rate given above. What is the rate given for this asset? 6%. 6% every year. Will you depreciate it for 10 years or 9 years? First year you already got it. For 9 years, how much is it? 2,43,000. So minus this and finally tell me what is the salvage value. 57,000. So second machinery ka salvage value is 57,000. Got it? This is another major highlight of this question. Calculation of salvage value. Okay. Wait or comfortable? Everybody. Okay, this is done. Okay, now they've given some extra fitting. Check. Alternatively, brand ABC, the second asset, can also be taken on rent and returned back to the owner on following terms. So on this ABC asset, no, either you can buy or you can take it on rent. That means we, as the finance manager, we have 3 decisions over here. What are those? Either buy XYZ or buy ABC or rent ABC. Now we have to choose one among the 3. Okay, 2 purchase option or 1 renting option, whichever is the beneficial for the company. If you are taking on rent, this is the terms and condition. Annual rent shall be paid importantly at the beginning, ending Allah, beginning. So this is keyword. Why? Present value calculation will get impacted. Yes, no? If you incur it at the end of the year, one discount factor. If you incur it at the year beginning, then it will be another discount factor. So hence this payment is important. Here annual rent you have to pay at beginning of each year. First year how much will you pay? 1,02,000. Then for next 4 years you will pay how much? 1,02,500. Then for final years you will pay 1,09,950. Now 1 second. Okay, or leave that. One by one maybe we'll do it. First we'll work out for XYZ, ABC, and then we'll come for rental option. Okay. First XYZ. We read the problem. That's what we need. This one I'll come to it in a bit. Leave that. You need to advise people. We need to give an advice. Okay. Advise XY X-ray machinery, assuming that the machinery shall be continuously used for a period of 2 years. Company has a requirement of this machinery for how many years? 20 years. Okay. So they're saying for 20 years, project will run. So we need to buy the asset. But this asset can only last for 15 years. After that, what we will do? Once again, we will buy or once again, we will rent. Whatever. Okay. Now, first we will go for the first XYZ option. Check. Anyway, advice is always based on what? NPV. Here, life is same or different? So directly NPV or based on EAC? EAC. But have they given any benefit here or only cost? This is your purchase cost. This is your maintenance cost. Only one benefit is given, which is what? Salvage value. Rest all, whatever sales you generate from this machinery and all, given or not given? Not given. That means here we will work out EAC from the benefit angle or cost. Cost. Okay, sir. So what do we need? You have already worked this. Tell me, you need a present value of cash outflow divided by what? PV? AF. That's how you get EAC from cost angle. So can we find out? So all these outflow, we need to find out present value one by one. First, how much is the purchase cost? 6 lakh. When will this outflow happen? Year 0. So first calculation at year 0. Here only it is. It's a very simple calculation, to be honest. Year 0, how much outflow? 6. That's it. No. From year 1 to 5, how much cost you will incur every year? Maintenance cost you will incur every year is 20. Since it is same every year, see, you can have like 15 columns here. Or you can use shortcut method. From year 1 to year 5, is the number changing or same every year? That means we can use PV. AF. Have they given discount factor? Yeah, somewhere here they have given. Cost of capital is how much? 12%. Now at 12%, give me 5 years ka PV AF. 1 divided by 1.12, press equals to button 5 times and GT button. How much is it? So 20,000 is your maintenance cost from year 1 to year 5 and PV AF is 3.60. Comfortable. At year 0, discount factor is always 1. Multiply, you will get the present value. So far, any problem? Everybody comfortable? So one question is, sir, why depreciation rate you applied on cost of the machinery? Sir, when they give you percentage, right? When you give percentage, have they told anywhere in this problem WDV? No, when they don't, we always take it on what? SLM basis only. So the rate percentage we always maintain, apply it on the original cost. Only if they say WDV, then your thinking is right. Okay. Okay, macha. Thinking good. All right. Where were we? Okay, here. Machinery XYZ ka first 5 years maintenance 20. Next, from year 6 to year 10, every year maintenance cost is how much? Sir, maintenance now cost will not come once. It will come every year. So all these data are every year number. Year 6 to 10, the number is 28,000. Is it changing or same? So we can use PVAF. But how to find out 6 to 10 ka PVAF? That's another highlight of this question. How to find out year 6 to year 10 ka PVAF using a calculator? I can show you two methods. Okay, whichever works for you, you can do. First, find year 1 to year 10 ka PVAF. How much is that? Year 1 to year 10 ka PVAF. Get me that? Year 1 to year 10 at 10%. 1 divided by 1.12, press equals to button 10 times and GT button. How much is that? 5.65? This is 10 years. We want 10 years or from 6 to 10? We want it from 6 to 10, but this is from 1 to 10. From year 1 to year 5, we need it or we don't want? So minus that. Find year 1 to year 5 ka PVAF. 1 divided by 1.12, press equals to button 5 times and GT button. Year 1 to year 5 ka PVAF. 3.605. This if you do means minus if you do, you'll automatically get year 6 to 10 ka discount factor. This year 1 to year 5 ka discount factor is included here. We don't want it. So exclude it. Minus it. How much is that? 2.045. That is one way to calculate. Okay, sir. This is little time consuming. Can we directly try the calculator method? If you want to do directly calculator method, take your calculator, everybody. Do 1 divided by 1.12. Press equals to button 5 times first. 1 divided by 1. We need it from which year to which year ka PVAF? 6 to 10. No. So 1 year before that is year 5. No. First 1 divided by 1.12 you do. Press equals to button 5 times. Everybody done? What is the number your calculator is showing? 1 divided by 1.12. 1, 2, 3, 4, 5. Anju showing 0.5674. Correct? No? From next onwards, press equals to button and M plus button. Equals to button and M plus button. Okay? Equals to M plus. Year 6. Then again, year 7 equals to button M plus button. Year 7 equals to M plus button. Year 8 equals to M plus button. Year 9 equals to button M plus button. Year 10 over 5 times equals to button and correspondingly M plus button. Pressed. Then press MRC button. There is an MRC button in your calculator. Press that. How much are you getting? Right? Mine is showing different ones. 1 divided by 1.12. 1, 2, 3, 4, 5. Okay, equals to M plus. Right? This calculator doesn't. Oh, that clear memory is there here. Huh? Okay, you'll have to some clear memory is there. How much? It should be showing 2.045. Are you getting? So this calculator, maybe I did not clear the memory. But did you understand? Are we comfortable? This is your calculator method. Once more or repeat about it. First do what? If you want year 6 to year 10 ka PVAF. First do what? Year 1 to year 5 ka. 1 divided by 1.12. Only press equals to button 5 times. From 6th year onwards, you press equals to and M plus button simultaneously. Year 6, year 7, year 8, year 9, year 10. So next 5 times equals to M plus button, equals to M plus button. Lastly, press MRC button. You should be getting 2.045. First clear the memory and then do it, because some calculator may that memory will be restored, so it will add up. So okay na Sarji? So that is your year 6 to 10. But this asset only will go for 10th year, or even 11 to 15 is also there. 11 to 15, 39,000. Now you calculate, let's see. 11 to 15, how will you calculate? First to do 1 divided by 1.12. 1 divided by 1.12. Press equals to button how many times? 10 times. From 11th year onwards, press equals to and M plus button 5 times. How much are you getting? 1.161 here it says. Are you getting the same number? Okay. Any difficulty anybody in this calculation? No. So this is your cash flow. This is your discount factor and multiply. That's it. Or one more is there. One last component is there. Purchase cost over, maintenance cost is over. Then there is one more called salvage value. How much is salvage value of first asset? 64,000. Now here people, they have changed the sign. You can also do it other way around. Here if you check, majority of the is what? Cost. There is only one benefit. Hence cost they are presented as a positive number and benefit they are presented as a negative. If you want, you can do the normal sign presentation. All the cost you can show negative. Salvage value you can make it as positive. It really doesn't matter. Okay people, that's fine, because here majorly it is a cost, so hence they have given it as a positive number. This is a salvage value. Salvage value you will get every year or once. Not to when? End of the project. What is the end of life of first asset? 15. So 15th year ka you have to find out the PVAF or PVIF. You will get only one. So at 12%, 15th year ka PVIF is 0.183. Multiply and you will get the present value. Okay. Adding all this, what are you going to get? GT is grand total button. If your calculator does not have it, buy one. That is helpful. So buy it. GT button, correct. There is a button called here calculator. I'm showing. I don't know whether it's visible for you. Here, GT. How can I above that? Yeah, it's a button. Okay. All these if you add, you will get what? Total present value of cash outflow. Add it. How much are you getting? 7,62,927. So, but we know it's an unequal life. So we can decide based on this or EAC. So what you will do for EAC? Present value of cash outflow divided by what? PVAF. At what rate? 12% for life. What is the life of this project or life of this machinery? 15 years. Find out. 762,927 divided by PVAF at 12% for 15 years. At 12%, find out PVAF for 15 years. How much is that? 6.18? 6.810. Okay. Divide these two. What is the EAC you're getting? 1,12,000? 030. Okay. So 1,12,030 is the EAC we have got. That's what roughly they're saying here. Okay, na Sarji? Now same EAC we have to find out for next asset while buying and next asset while leasing. Can we try? Okay. One more we will try for now. This asset. Now check. ABC ka. ABC ka salvage value we have already found. How much is second machinery ka salvage value? 57. Now guide me. Maybe let's see. I'll quickly write it here. Tell me ABC ka what I have to do. Year, cash flow, discount factor and present value of cash flows. Year 0. Tell me sir, what I have to do. You're buying the asset at year 0 for how much value? 4.5 lakh. Year 0, 4.5. Since every here they have given majorly cost I'm presenting as a positive number. Salvage value I'll go for negative. Is it mandatory or you can follow normal signs? Normal sign is also okay. Discount factor at what rate? 12%. At year 0, discount factor is always 1. Okay, this is done. Then they're saying for year 1 to 5, 6 to 10, maintenance cost is 31,000 and 53,000. Now this is from year 1 to year 5. And this is from year 6 to year 10. Give me the discount factor, people. Give me the discount factor. 3.605. So multiply. These took a multiplication. 31,000 into this number is how much? 1,08,000. You know, year 6 to year 10 ka discount factor. What you will do? First, what you will do? 1 divided by 1.12. Press equals to button 5 times. From 6th year onwards, equals to and correspondingly m plus. First, clear the memory. MRC button you press 2-3 times and then do this calculation. How much are you getting? How much are you getting? Year 6 to year 10 ka discount factor. Previously, with this number is different. Okay, 1 lakh. 1,11,750. No problem. Numbers, let's not worry about that. So let's focus more towards our normal listing. So what is this? Rent agreement will take. Hang on. Let me go. I've not got to the rent. There's only purchase option. We'll go for the rent next. First, let's get this done. Next, tell me this year 6 to year 10 ka. 2.045. So multiply. How much are you getting? 1 lakh. 1,08,380. 385. That's it, or one more? Last, which is salvage value. What is the salvage value of that second brand? 57,000. So this is an inflow. All the cost I'm showing you here as positive means benefit I have to show it as a negative. 57,000 is a salvage value. Negative which year? 10th year. So you will get PVAF or PVIF. So give me 12% ka PVIF for 10th year. How much is that? 3 to 1. Multiply. How much is the present value? 18. 297. So this is negative. So tell me the present value of cash outflow. Sum up all this. $6,50,000. 6,51,838. So can we directly do it or EAC? Why EAC? Previous ka machinery ka life 15 years. This ka life 10 years. So that means we have to find again, when there is unequal life, we have to answer based on EAC. How do you find EAC from cost angle here? Present value of cash outflow divided by PVAF at what rate? 12%. Here for 15 years or 10 years? Sir, this machinery ka life is only 10 years. Previously we took 15. Why 15? Previously we took 15. Why? Because first asset ka life is 15 years. Hence we took PVAF for 15 years. Second asset ka life is only 10 years. Hence PVAF for 10 years. So calculate this for me. 651,838 is present value of cash outflow divided by 12% ka PVAF for 10 years. How much? 5.650. So what is EAC, people? 1,15,000. 365. 370. Okay, done. Let's not fight over 5 rupees. Okay, done. Sorted. This is your EAC for the second asset. But both we have worked out under which? Okay, thank you. Thank you, Pragya. All right. Next, what is that? So these are the EAC for to purchase option. Is only purchase option available or even lease option is available? So can we work out now for the lease one? Okay, lease one. Let's work out. But about lease, we need to be little careful. You can lease only what? First asset or only second asset? Second asset, which is what? ABC. Now, year, cash flow, discount factor, and present value of cash flow. Lease, we need to be careful because lease rentals, no, you are not paying at the end of the year. They told lease you have to pay at the beginning of the year. And that too, lease rental is same every year or changing? For first year, what is the lease rental? 1,02,000. This 1,02,000 you will pay it at first year ending or first year beginning? Sir, first year beginning only we call it as what? Year 0. Correct? No. That means I'll have to write here year 0. How much cash flow you'll have? What's your first lend? 1,02,000. Okay. Next 5 years lease rental. When you have to pay? First you will pay the lease rental at year 0. The payment. First you will pay at year 0. Then at year 1 beginning. Then at year 2 beginning. In fact, you will pay first lease rental at year 1 beginning, then you will pay it at year 1 ending. Year 1 ending is nothing but year 2 ka beginning. Yes, no? I mean, the payment, if you want to express, it will be year 0, year 1, year 2, year 3, year 4, like this. Yes. Okay, Ji. So next 5, though they are saying next, what they said, next 4 years, the lease rental is how much? 1 lakh, 1 to 4 mein, how much is that? 1 lakh 2,000? Yes, Aji. Everybody good? How many years lease rental covered now? 5 years covered. Okay, next 5 years. What is the next 5 years? Final 5 years lease rental is how much? 1,09,950. This will be what? 5, 6, 7, 8, 9. Understood? If you want, once again, I'm writing here. First payment value you will make year 0. Then year 1, year 2, year 3, then year 4, then year 5, then year 6, then year 7. How many payments? If you take 10 years lease means how many times you will pay lease rental? 10 times. So count 1 over, 2 over, 3, 4, 5, 6, 7, 8 over. Then what? 9th payment and last 10th payment. So the 10th payment will come when? 10th year beginning. 10th year beginning is nothing but your 9th year ending. So hence we'll have to stop our calculation at 9th year. Somebody asked that question, why 9? Understood? Huh? So whenever payment is at year beginning, one number you reduce, in fact, if you wanted simple calculation. Year 1 will become year 0. Year 10 will become year 9. Year 7 will become year 6. Like that. If you wanted a shortcut. Okay, people. But discount factor is still same. How much is the discount factor? 12%. At year 0, discount factor is always 1. Understood now, everyone? So salvage value, hey, lease option, macha. When you take an asset on lease, you will sell it off. You can sell your asset. When you are a legal owner, you can sell the asset and get a salvage value. Here, are you the legal owner or you are a tenant? No, we are the tenant of this building. We can sell off this building. Broomstick only the landlord will come. Right? No, we cannot. So salvage value, will you consider here or not consider? Not consider. So 12% ka discount factor you give me. Year 0 same. Then at 12%, 1 to 4 ka discount factor you give me. Year 1 to year 4 ka discount factor. How much is that? Quickly. Huh? 3.307. 3.037. Okay. Multiply these two and tell me what is the number. This is 1,02,000. These two ka multiplication. These two ka 320. 328. Okay. The year 5 to year 9. What you will do? First, 1 divided by 1.12, you will press 4 times. From 5th year onwards, equals to button and M plus button. Year 5, year 6, year 7, year 8, year 9. 5 times equals to button, M plus button, then MRC button. 2.290. Okay, multiply these two. How much is that number? 780. 251. 786. Okay. Salvage value not there. All are cost. Add this. You will get the present value of cash outflow. Summation is how much? They are saying you add, then we'll confirm. 114. Okay. This is your present value of cash outflow. Can we take a decision based on this or EAC? Yes. EAC. So how do you get EAC? Present value of cash outflow divided by PVAF at what rate? 12%. Now, 1 second. For 9 years, Allah. You took the lease for 9 years or 10 years? Payment you are making at year beginning, but the total lease term is 10 years. Okay, so for how many years? For 10 years. Okay, so this you need to be careful. First check 665114. Is that the same number they got? More or less same. It's okay. And now calculate PVAF at 12% for 10 years. The total lease term is 10 years. So hence 10 years you have to take. Only lease payment you are making at the year beginning, but the lease term is still 10 years. So 665,114 divided by PVAF at 12% for 10 years. How much is that number? 5.650. So what is your EAC? 7? So lease ka EAC is 117. Purchase same asset ka purchase the EAC is 115. Another asset ka EAC is 1112. Which is the lowest? 112, 115, 117. Which is the, we'll select the one with the highest or the lowest? We are working with a cost angle. So you will select the lowest. Which is the lowest? First asset ka. First asset is what? XYZ. So finally, what is the decision? Go for XYZ ka purchase. Because EAC is the lowest. Done na. Once more, any part or got it. I've done it quickly, okay? But you can refer to the same solution. Solution is presented neatly over here. Okay, this one has one more option. In fact, they had one more line which we did not read because it was not relevant. Read this line. Now, this you have to give this question ka solution in two parts. First part we are done. Second part they are saying which option is most economical if machine is likely to be used only for a period of. Now the first decision was if you are planning to use the asset for 20 years, what is the decision? Which one will you go for? Now they are saying what is the requirement of the company? They need the machinery only for 5 years. Now what will happen? Sir, if you need the machinery only for 5 years means the first machinery will come for 15 years. But will you keep it? It can come for 15 years, but will the company keep it for 15 years or sell it in 5 years only? Company needs it. Company ka requirement is only 5 years. That means at the end of 5th year only they will sell the asset. Correct? Now you'll have to keep the same data or rework? Rework. Salvage value will remain same or rework once again? Sir, here depreciation was for 15 years. Now 15 years or 5 years. Calculate salvage value in similar terms. Let's see. How do you calculate salvage value? First original cost. How much is the original cost for first asset? 6 lakh. First year they said salvage value will drop by how much? 1/3. Calculate 6 lakh ka 1/3. Okay. There afterwards you have to depreciate at what rate? What is the depreciation rate of XYZ? 4%. For how many years? 1 year over. Now we are planning to use the asset only for 5 years. Now you will do what? 6 lakh into 4% for how many years? 4 years. Understood everybody? So calculate. 6 lakh minus 2 lakh. What will be this depreciation? 2496. So minus you do. What is the salvage value? 3 lakh? 3 lakh 4,000 will be the first machinery ka salvage value. Hope everybody is clear with this. Second asset ka what will be the salvage value? How much did you buy the asset for? 4 lakh 50,000. Then it will drop by how much? 1 lakh 1/3 basically. And there afterwards you have to depreciate at rate given above. What is the rate given above for second asset? 6%. 6%. Now you will depreciate for how many years? You will depreciate only for 4 years. Why 4 years? You're planning to use the asset only for 5 years. First year already done means remaining is only 4. Calculate this and tell me final number. 1 lakh? 1 lakh 42,000 in that case. 1 lakh 92, no? Okay. 3 lakh 4 and 192. I'll also check here. 304 and 192. Yes, sir, people. Now we'll have to work out the EAC. Here EAC required or not required? Because now you are planning to anyway use the asset only for 5 years. First asset, if you want to use, you can use it for how many years? 15 years. Second asset, if you want to use, you can use it for 10 years. Or second asset, if you want to take it on lease, you can take it on lease up till 10th year. But now here we are not going for 15, 10 or 10. We are going for which years? 5 years. That means every option is there on which platform? 5 years platform. So life is unequal or same? Now EAC not required. Even if you calculate EAC, every problem you will write present value of cash outflow divided by PV AF at 12% for 5 years. Even if you do it also no problem, but not required because all the platform is same. EAC is required only when it's unequal line. Here you are assessing the data only for all the option under 5 years platform. So everything is same. Now should I have to do this or you can manage this? You can manage this. Just give me a walkthrough. What you will do for XYZ. First, what you will take? Just tell me the cash flow column. Year 0 you will take 6 lakh. Maintenance cost you will take for 15 years or only 5 years. So 6 lakh you will take and 20,000 you will take. And what about salvage values? Salvage value you will take 304. Take a check. Second, where is that? This 5 years. 6 lakh outflow, 5 years maintenance, and this is the salvage value. Discount factor is 12%. Okay, na sir? Now, what about second asset? Tell me what and all will come relating to second asset when you buy and cash flow column. Cash outflow 4.5 lakh. Maintenance cost ka year outflow 31,000. Full will come or only 31,000? Only 5 years ka maintenance. So 4.5 lakh, 31,000, and then salvage value. How much? 192. Considered a check. 450 purchase price. 31,000 5 years maintenance. 192 salvage. Everything. Okay, sir. A lease, we need to be a little careful over here. Lease, first you tell me the cash flow. Maybe I'll put it up here for lease. I'll read the data. You tell me. Lease, when are you paying? Year beginning, you'll have to pay. If you want here only quickly, I'll write year of cash flow, discount factor, and present value of cash flows. I'll only fill up the year cash flow column. Year column, I will write year 0. Why? First lease rental you have to pay it at year 1 beginning. Year 1 beginning only we call it as year 0. How much you will pay? 1,02,000. This is one cash flow. Got it? Here anyway outflow is there. I'm presenting all the numbers in positive. If you want, you can change the sign it to be negative also. It's fine. Now you will lease it for 10 years or only 5 years. One payment done. Balance you will have to pay how many 4 payments? 4 payments. So you will write 1 to 5 or 1 to 4. So payments here will happen at what and all dates you tell me? Year 0, year 1 beginning, or rather year 0, year 1, year 2, year 3, year 4. Those are the 5 payments you will make. Agreed? So 1 to 4, how much payment will you make? 1,02,500. Understood, everyone? After this, will you make any payment or you lease it only for 5 years? If a company is saying we need requirement is only 5 years, means we'll lease it for 5 years. But hang on, read the requirement there. Last one. Rental agreement. Okay, first of all, the second asset can be taken on rent and returned back to the owner on following terms. First, you have to pay lease rental at the beginning of the year. First lease rental, how much? 1,02,000. Annual lease rental for subsequent 4 years is 1,02,500. Then for the final 5 years, lease rental is this. Rental agreement can be terminated by BT Labs by the payment of 1 lakh as penalty. The penalty would be reduced by 10,000 each year by the period of rental agreement. What they are trying to say indirectly is, if you want to take this brand ABC on rental, no, you have to take it for 10 years. But you have an option to cancel the lease before 10 years. If you cancel the lease before 10 years, you have to pay a penalty. 1 lakh penalty. Okay. And this is the first part of the question. There's also second part of the equation. Did we understand this? Okay. So if you want to take this asset on lease, you have to take it for 10 years. But after 5 years, you can cancel this lease before 10 years by paying a penalty. How much penalty? 1 lakh. First part of the equation. Now they are saying this penalty would be reduced by 10,000 each year for the period of rental agreement. So if you cancel the lease after 1 year, will you pay 1 lakh penalty? No. For every year, penalty will reduce by 10,000. 1 year you execute, you paid lease rental. No, now you will not pay 1 lakh penalty. You will pay 1 lakh minus 10,000, 90,000 penalty. Suppose you cancel the lease in second year, then 1 lakh minus 10,000 for first year, minus 10,000 for second year. So each year you continue the lease, penalty will go on reducing. For 10 years, if you continue the lease, means no penalty. But here the requirement of the asset for the company is only how many years? Means 5 years you will continue the asset, lease the asset, and then you will cancel. Means how much penalty will you pay? Will you pay penalty of 1 lakh? No. Each year of lease rental, due to that, penalty will reduce by 10,000. How much penalty you have to pay? 50,000 penalty you will have to pay here. Understood? Everybody good? This is another highlight of this question. This penalty you will pay in the year of cancellation. When will you cancel? 5th year beginning or 5th year ending. So this penalty you will pay it at 5th year ending. Be careful there. So that means cash flow, lease rental you will pay it at beginning. But the penalty will you pay at 4th year or 5th year? 5th year ending. How much penalty? 1 lakh penalty or 50,000 penalty? This is the cash flow. That's it. Okay, na Sarji? That's what they must have taken check. 102, 10500, 102, 102, 500 and 50. 102, 102, 550. Work out. And this is okay. Now, present value calculation you can take care. This is the highlight of this particular question. So much lengthy, doubtful. I feel maybe they'll only ask one. If they ask both, it should be minimum 10 marks. Maybe 14. I say give it for 50 marks only. This one question, give it for 50 marks and be done. Huh? But yeah, I think it should come for at least 10 marks minimum. If both the option if they ask. Doubtful, but you never know ICI. Sometimes they will, they will test. Okay, Sarji. This is about this question. No? Now, 2 more questions I want to do. Then we will take Sapad break. Can we? Okay, but there is one small concept under both those questions. I will tell you that concept and then go for the next. Are we okay? Frame of mind is fine. Online also all good so far. Done, people. I'll just tell you a quick overview and then I will dive into the number. Sir, so far in all the problems we did, depreciation was under SLM method. What if depreciation is under WDV method? First concept, sir, should we take depreciation as per accounts or tax? Should we take for our FM ka, all our whatever analysis we are doing, should we take accounts ka depri or tax ka depri? Why? Because one, you know that accounts depri, tax depri is not same. Because in accounts, depreciation is as per accounting standard 10. AS10 you have studied PP. PP clearly says we account the depreciation based on pattern of economic benefits. There is no method, there is no depreciation rate. AS10 clearly says you find your own rate, you find your own life, you do your own thing. Standard is not giving any guidance. But if you check Income Tax Act, for each asset they have specified depreciation rate. Accounts ka depri, tax ka depri is not same. That's the reason one whole standard called AS22 is introduced, if you remember, in accounts. Accounting for taxes on income, deferred tax asset, deferred tax liability. We created because of this only. To plug this accounts ka differences and tax ka difference. Yes, sir. So these two depri will not be same. That is point number 1. So the next question will arise, should we take depreciation as per accounts for our cash flow estimation or should we take tax ka depri? Now very simple. Depreciation is a non-cash expenditure. So is there any cash outflow? Due to depreciation, is there any cash outflow or cash inflow or no cash impact? No cash impact. But still we consider depreciation. Why? Because when you want to pay tax to the government, tax is an outflow, right? So if you want to calculate the correct amount of tax payable to the government, you have to reduce all the expenses. So to calculate tax, will you take accounts ka depri or tax ka depri? So that means whatever depreciation that we here require, no, it is not as per the accounts. We want it as per the tax. So for our cash flow estimation, we have to take what depreciation? Depreciation as per tax. That is the point number 1. Okay, sir. So second point that you need to keep in mind is, till now all the problem was on what basis? SLM basis of depreciation. So what if the depreciation as per tax is on which method? WDV method. If you remember Income Tax Act, you have studied Income Tax Act ka depreciation under WDV is not based on asset basis, it is on a block basis. You charge depreciation on a block. Block is a group of asset. If you're following WDV method, you don't charge the depreciation on individual asset basis, you charge it on a group of asset basis. So Income Tax Act says as long as the block is there, depreciation also will arise. If block ceases to exist, if block comes to an end, then you will charge depri or no depri. Like just to give you an illustration, block means group of asset. Like let's say we have plant and machinery 1, we have plant and machinery 2, PM1, PM2. We have plant and machinery 1, we have plant and machinery 2. One we use it in the morning shift, one we use it in the night shift. Both are similar asset. That means what? These are separate group or one group? This becomes one group or one block. Like this. Like this, whichever assets are similar, we group them and that becomes what? Block. Okay, sir. As long as this group or as long as this block as long as this group or as long as this block has even at least one asset, depreciation will continue. If at least one asset is there in the block, means we will go on charging the depreciation. Suppose both asset I sold off. In the current year, both asset I sold off. That means now if one asset, any one asset at least is there in the group, or both assets sold off. If both assets are sold off or scrapped off, block is still there or block has come to an end? Block has come to an end. If block has come to an end, means tax says you should not charge depreciation. That is point number 1. All these are tax laws, not FM card. Income Tax Act says all this. Yes, Saji? Everybody good? So when a block comes to an end, when block ends, right, that is where you need to calculate short-term capital gain, short-term capital loss. That's where STCG, STCL comes into picture. Understood, everybody? Okay. Now, how do we calculate STCG, STCL? That you already know. How do you calculate? Previously we did. Tell me recap of that. What is that? You will take sale value. You will compare the book value as per accounts or now as per tax. You will take the book value of the asset as per the tax. Because accounts ka book value, tax ka book value will not be same. Because both the records ka depreciation is not same. So take the book value as per tax, compare it with the sale value. Accordingly, you will get short-term capital gain or short-term capital loss. Understood, everybody? This is another background. I'll just give you a minute, process that. Over. Hungry, angry. No. By the way, I like the climate of Coimbatore. It stays like this only throughout. Not too hot, it's not too cold. It's pretty much okay. Then March, April, May, indirectly she's saying don't come. Don't come throughout only, better. She's saying, yeah. Here it's always better, I think. When I was walking also, I prefer to walk, so it was okay. I felt like it was more like Bangalore weather only. So didn't feel much. I was in Chennai last week. Though it was little windy, I was still sweating. Maybe that humidity factor. It's still in the coastal area, no? That probably. I think the weather is not as close to as Chennai, I believe. Here, Coimbatore is probably much better. It's probably closer to Bangalore is what I felt. It will be good. Okay, so that means next marathon, accordingly I'll plan. Done, Sirji. So are we comfortable with overall this so far? Now, another point here is, what you need to keep in mind is, next problem specifically is something called replacement decision. Called what, sir? Replacement decision. In replacement decisions, what you're doing is, old one you are selling, new one you want to buy. Come Coimbatore. I will come, macha. Already there, no, macha. Where will I come, da? What, you want me to come to your place? Okay. Replacement decision, what you are doing is, old asset you are selling, new asset you are planning to buy. So we have to take a decision whether to replace or not. Should we continue to use the old asset, or should we sell the old asset and buy a new one? That wala problem. That decision we call it as what? Replacement decision. Next problem is on that. Okay, sir. Now, whenever they ask you replacement decision, what they will do is, they will give you old asset ka income and expense. They will give you new asset ka income and expenditure. One way to approach this is, old asset ka you take income minus expense. What are you going to get? Profit before tax. Then depreciation and OAS adjustment you do, you will get what? Cash flow. Using cash flow, find out NPV. Similarly, same exercise you do it and find out the NPV of new asset. Compare old asset ka NPV with new asset ka NPV and select that asset which has highest NPV. That is one approach. Okay, sir. Lengthy approach. Okay. However, ICA ka suggested answer is framed as, they, in the replacement decision, they use something called incremental approach. And I suggest in exam, do this only, because most of your suggested answers will have this only. Okay. What is this incremental approach? Is very simple. You compare old asset ka data with the new asset ka data. So basically you will get here, like, let's say PAT of old asset is 1 lakh. PAT of new asset is, let's say, 3 lakh. Done now. Now compare. Compared to the old asset, is new asset giving extra PAT? Compared to the old, is new asset giving extra PAT? How much extra? 2 lakh. That extra only we call it as what? Increment. So basically every data, whatever you worked out, no, don't take for old and new. Take only on a extra basis. So we don't want sales. We want extra sales. We don't want expense. We want extra expense. We don't want PAT. We want extra PAT. We don't want depre. We want extra depre. We don't want OVAS. We want extra OVAS. Compare and take only the extra. If you take all the data of extra and find out find out NPV, what will that NPV be? If you take only extra data and find out NPV, that will be incremental NPV. If this incremental NPV is positive, means accept the decision, meaning sell the old asset and buy the new asset. If this incremental as NPV is negative, means reject the decision, meaning don't buy the new asset, continue to use the old asset. This is the approach we will be doing. Yes, sir. Okay, I suggest you solve like this. Okay, give me a quick walkthrough of this. What are we doing over here? First of all, what is this now? Replacement decision. What happens in replacement decision? Old asset we'll have to sell and buy a new. So now we are making a decision whether to continue to use the old asset or sell the old one and buy the new. So we do this under which approach? Incremental approach. In incremental approach, what do we need? Every data on an extra basis. Whatever cash flow you're working on, we don't want cash flow now. We want incremental cash flows. Take incremental cash flows and work out to the incremental NPV. If that incremental means compared to the old, the new one is giving how much extra. So if you are getting incremental NPV positive, that means new asset is giving more NPV compared to the old. So if incremental NPV is positive, accept the decision of buying a new asset. Otherwise, don't buy the new asset, continue to use the old asset. That's a point. Okay, sir. How to apply? I'll show it to you. But here in this extra data, one becomes a culprit called depreciation. One major working out becomes depreciation. Okay. But here in this problem, they will say an asset, no, we have to charge depreciation not on a straight line basis, but on a WD. If it is straight line, means it's very easy. You know how to calculate straight line method ka depre, no? Compare and it's very easy. But under WDV method, you don't calculate depreciation on one asset. It is based on the block. So you have to calculate existing block ka depre, compare it with a new block ka depre, then you will get incremental ka depre. So you'll have to put up an extra working note relating to depreciation. That is one of the highlight here. If you can sort that out and take care of this STCG, STCL part, these two, other things will automatically, the format will take care of it. Yes, sir, Sarji. I'll walk you through the numbers. Can we try? Maybe if you want, we can go a little slow with respect to this problem. I don't know how many of you we have done. We have done at least 3 questions on this in regular class. But just saying, now I don't know how many of you remember or I don't know what it is. So let's maybe keep this as a new concept and try out. Check this. So far, okay, no? Or any more processing time is required in any of this? All okay? She's saying, proceed, enough, da, hungry, da, day. Okay. She did not even wait 2 seconds. So that was like frustration coming out. Yes, no, ma? Yeah, no worries. I can understand. HMR, the company, is considering replacing a manually operated old machinery with a fully automatic new machine. Old one they want to replace with new one. So whenever old and new comes into picture, most probably it will be a incremental approach. If you want to check here, this is old machinery ka sales or PBT, new machinery ka. So old new ka data they have given. We will use any of this or incremental. We will take incremental and do the data. Okay. All right. Come back to the question. Each line is important. Careful. Or maybe once again I'll tell you. Depreciation. You have to consider as per account or as per tax. And we need book value as per accounts or book value as per tax. As per tax. Done, Sarji. Keep these 2 points in mind and then read the next points further. Old machinery has been fully depreciated for what purpose? Sir, if it is fully depreciated for tax purpose means what is the book value or WDV as per tax? 0. It is fully depreciated. Correct? So the book value as per tax is 0. Keep that in mind. But it has a book value of 240 on 31st March. I did not understand that. What does that mean? Sir, they said it's been fully depreciated as per tax means as per tax book value is 0. And here, whatever book value 240 they have given, this is as per accounts. Done now. I mean, this 40 relevant for us or irrelevant? We don't want as per accounts. We want as per tax. So as per tax, the book value is 0. All right. The machine has begun causing some problem. Our existing machinery or old machinery is causing some problems with some breakdowns, and it cannot fetch more than 30,000 if sold in the market at present. Immediately, if you sell off that our existing machinery, it can fetch us only 30,000. Looks like a salvage value. But you will get the salvage value later or immediately? Sir, if you buy a new asset, what will you do with the old asset? Keep it or sell it immediately? Sell it immediately. So this 30 salvage value, if you go for replacement decision, you will get it immediately. If you don't replace, you will get it later. We'll see. It will have no realizable value after 10 years. So if you continue to use the asset for 10 more years, this asset, then will it have any salvage value or 0? Now if you sell it, you can get 30. After 10 years, if you use and sell, you will get 0. But the company has been offered 1 lakh for the old machinery as a trade-in on the new machinery as a price. So vendor, no, we want to buy a new asset, means we'll buy it from a particular vendor. That vendor is saying, if you buy new asset from me, I will take your old asset at what value? 1 lakh. Looks like a good deal, no? Because its market value is only how much? 30. But that vendor is ready to offer us 1 lakh. Okay. So, yeah, it's a trade-in on the new machinery, which has a price of how much? 400. So, new asset ka value is how much? 400, 4.5. But should we have to pay 4.5 or only 3.5 is enough? Though the new machinery ka cost is 4.5, if you buy the new asset, what are we going to do with the old one? Exchange it with a vendor. And what is the exchange value of the old asset? Vendor is ready to take it for. Means we have to pay only for the new asset how much? Balance 3.5 lakh cash. Okay. 1 lakh will be adjusted as towards the old asset. The expected life of the new machinery is also 10 years, and it has a salvage value how much? 35,000. Okay. Now remember, we don't want salvage value. Everything we want it on incremental basis. If you continue, carefully read this, if you continue to use the old asset for 10 years, how much salvage value you will get? 0. If you buy a new asset after 10 years, how much salvage value will you get? 35. Old asset ka salvage value 0. New asset ka salvage value 35. So incremental salvage value is 30. Every number has to be on an incremental basis. Keep that in mind. Okay. Moving further. Company follows straight line method of depreciation. Oh, sir, happy sir. Wait. Straight line method of depreciation, but for tax purpose, WDV method is followed. So this straight line method is as per what? You don't worry about that. We want all this data on a what basis? Tax basis. For tax basis, you are following which method? WDV method. And what's the rate of depreciation as per WDV? 7.5. And we know that WDV in tax, WDV method works on a block basis. So they're saying what over here? 7.5 is depreciation, considering that this is the only machinery in the block. That means in this group, how many assets is there? Only 1. Okay. Now 1 minute, hang on. In this group, only 1 asset we have. That is our old machinery. If you sell off the old machinery, what will happen? Block will come to an end. But hang on. When you sell an old asset, what you will do? New machinery you will buy, no? So block has come to an end or 1 asset is still there. So when you replace old with new, block will continue. Correct? Huh? But after 10 years, when you sell the new machinery for 35, what will happen? The block will come to an end. Understood? Huh? Currently, old asset is there in that block. Now, if you want to replace this asset, means old asset you will sell, but new asset you will buy. That means in this block, new asset is there. That means block has come to an end or block is continuing? Block is continuing. This new asset, you will use it forever or only 10 years? 10 years. After 10 years, you will sell this new asset for how much value? 30. Now, any more asset are you buying or no data? That means after 10 years, when you sell this new asset also, block will come to an end. When block comes to an end, you may have to calculate short-term capital gain, short-term capital loss. Good thing for you is in this problem, they told ignore. Okay, but we will still calculate so that in case they ask what to do, we can analyze. Yes, sir, people. If they say ignore capital gain tax, should we calculate STCG, STCL or will not do, will not bother? Will not bother. Some problem they will not say this. But this problem they are asking us to ignore. Next problem they are saying calculate. So in this problem also we'll calculate, next problem also we'll calculate. So we are comfortable in 2 problems. Done, Sarji? Okay, now come back. Next data. What is the next data? Okay, given below are sales and cost of old and new. So from sales, they've reduced labor cost, material cost, overhead cost, fixed cost, depreciation, PBT they've got. So that means good. No, we have to calculate PBT, or they've only done. So should we have to start from sales, or directly we'll start from PBT? So should we have to start from sales, or we'll directly take PBT now? We want PBT or incremental PBT? I can't take that. Why? Sir, they told already one line in the problem. The old machinery has been fully depreciated for. It's fully depreciated means will you get any more depreciation or no more depreciation? But still they have told old machinery ka depreciation is 24. What does that mean? I mean this depreciation of 24 is not as per tax. It is as per accounts. Means can we consider this data or this is wrong? All others are okay, but depreciation data is okay, people. Everybody good? Yes. It is not wrong. It is just that it is as per accounts. How can I conclude, or how can we rather conclude? Because they told in the problem as per tax the old machinery is fully depreciated. If it's fully depreciated means depreciation value should be 0. But they have taken 24. That means this is clearly as per accounts. So this data is not right for our calculation. So hence we have to do some slight different calculations. Okay, leave that be. Done. Okay, let's start. Our next thing is just the basic data. That's all. Next, they have not given anything. They've just given the tax and PAT. That's okay. Leave that. What is analyze whether the old machinery should be replaced or not. What is the required rate of return? 10%. That is nothing but your discount factor. At 10% discount factor, they have only given each year ka discount factor is what? PV? IF. That's fine. Look at this one by one. First, depreciation. Straight line method, WDV method. WDV method. What we have to do is, we want depre or incremental depre. First, we'll have to calculate existing machinery ka what is depre, new machinery ka what is depre, and then compare and get what? Incremental depre, but not on an individual asset basis. WDV works under a block basis. So how do you do it? Carefully observe this. This is one of the important working note. First, you need to calculate depreciation base of the existing machinery. Point number 1. Here, look at what I'm saying. I'll show it to you working if you want once more. First, calculate what? Depreciation base of the existing machinery. Depreciation base means on what component are you charging depreciation? Or in simple terms, what is the book value of the existing machinery as per tax? Tell me. Don't look at the screen. Tell me. Book value of the existing machinery as per tax. 0. Why? It is fully depreciated. Okay, now. So that means the depreciation base of the existing machinery is 0. Because it is fully depreciated, they only told. Done, sir. Maybe in some problem it may be 10,000 also. If they give, we'll take it 10,000. But here it is fully depreciated, so it is 0. Now, this is depreciation based on what? Existing machinery. Now, what we have to do? Find out the depreciation base of the new machinery. Now, very simple. What is our existing WDV? 0. But after you buy a new asset, WDV will be same or it will increase. Take your calculator. Our old asset ka book value was how much? 0. Now, if you buy a new asset block value will be same or block value will increase? How much is the new value of the asset? 4.5. So 0 is the existing book value of the block. Existing block ka value is 0. If you buy a new asset, block ka value will increase. Yes, no. Or in simple terms, machinery ka existing value is what? 0. If you buy another asset for 4.5 lakh, value of the machinery will be same or it will increase? So add. Okay, na sir? Everybody good? That's all happened, or one old asset also you sold. So salvage value or the sale value of the old asset you reduce. How much will you reduce the sale value? 1 lakh. Why 1 lakh? Sir, market, if you're buying a new asset now means old asset also you will sell now. Market may if you sell, you will only get 30. But vendor is ready to offer how much? That means we will sell in the market or give it to vendor? Give it to vendor. Yes, sir, Sarji. So when you sell, block ka value will be same or it will reduce? And simply if you want it as formula, take the existing book value. If there is any sale value minus purchase value, you add. Okay. All this calculation is as per tax. Tell me once again, what is it? Existing book value. How much? 0. If you sell, minus. Purchase, add. So 0 is existing book value. How much did you purchase it for? 4.5. Did you sell any asset? Old asset you sold. How much? 1 lakh. So that means what is the new block ka value? This is the depreciation base for the new machine. Got it? Huh? Give you a minute. Tell me, confirm me, are you okay with this? Yes. Existing block ka what is the base? 0. New block ka what is the base? New block ka what is the base? 3.5. Final value. Okay. Everybody good? So we want this or incremental. New ka 350, old ka 0. So what is incremental? 350 minus 0. So the incremental depreciation base is 350. On incremental depreciation base, if you calculate depreciation, you will get what? Incremental depreciation. That is what we need for our decision. This is a working mode. Yes, sir, people. So if you want to summarize, first we have to find what? Existing machinery ka base, then new machinery ka base, compare and find out incremental depreciation base. On this incremental depreciation base, if you calculate depreciation, you will get incremental depreciation. And that rate is given. What is the rate of depreciation? 7.5%. But under WDV method. Now you know how to calculate. Using this 350, 7.5% depreciation you need to calculate. Calculate. First year. So opening balance will be 350. What is depreciation? 7.5%. Calculate for first year. 3,50,000 ka 7.5%. Sir, how 7.5%? They have told in the problem. Depreciation rate is 7.5%. WDV method mentioned in the problem. So how much is that? 26,250. That means this is opening balance. This is depre means what will be the closing balance? This minus this will be the closing. Done now. First year ka closing will become second year ka opening. Under WDV method, now second year ka depreciation, will you calculate on 350 or 323? 323 ka 7.5% if you do, you will get 24. These two ka minus closing balance. Like this, calculate for how many years? 10 years. Why 10 years? The life is 10 years. That's the reason. Understood? It may look lengthy. See, here to here we have done. It may look lengthy, difficult or easy. Comfortable? Okay. That means I can't do one column approach. I have to have 10 columns. Why? Sir, if all the income, all the expenses same means I can follow one column approach and then calculate NPV separate table. But here is depreciation expense same every year or changing every year? I mean, one thing though is assured. Whenever it is WDV depreciation, one column approach will not hold good. If the project ka life is 10 years means you need to put cash flow for 10 years because every year ka depreciation will change. Got it? Huh? Everybody good? This is depre. We want only depre or we want cash flow? How do you estimate cash flow? Tell me once again, what is that? Sales minus all the expenses. You will get PBT. PBT minus tax, PAT. Then PAT may say depreciation and OAS. Yes or no? Now, this is depreciation. What about others? Others also we'll have to compare. Either one way you can do is you can start from here. Okay. So, old ka machinery ka sales is how much? 810. New ka 810. Any incremental or 0? So like each component you can compare or you can use shortcut. What is our shortcut? Simple. See, every data here you can use. Yes, no. Except one data, which is what? Depreciation. Why we can't use depreciation? Because this is not as per tax. This is as per account. Hence what I'll do is, what is profit before tax they've given? See, from income they've reduced all the expenses and got profit before tax right now. All these data are acceptable except what? Depreciation. After deducting depreciation, they got PBT this much. But this number we can't accept. Hence, what to do? Add back depreciation. Just the depreciation, whatever they've reduced, add back. These two you add. These two numbers you add. 3,48,750. Or maybe I'll write it here only. 3,48,750. These two you add. 4,20,750. That means I will only start my incremental data from here. What is this? This is your PBT. Now I will get incremental PBT. What is incremental PBT? These two you compare. Old ka is 3,48,750. This is 348 old asset ka. 428 new ka. So compared to the old, new one is giving extra how much PBT? So I'll directly start with this. If you want, you can start from the top also. That also you can do. But I think this is easy. That means I'll put, this is working note number 2. What is working note number 2 here? Incremental PBT. So check, that's what I've done it here. Earnings before tax. we know that we are doing under incremental approach. So every time we need not write incremental, because by default we know that we are solving this question under incremental. If you want every note, you can also write incremental, PBT and all that, or you can leave it at that. So same thing I've done here. Whatever profit they have given, what profit they have given in the problem, people? They have given profit before tax. But depreciation they have reduced, which is not acceptable because that is as per accounts. Hence, add back depreciation, you will get earnings before depreciation. We will take these two number or incremental. Compare these two. Incremental profit before depreciation is how much? Before charging depreciation, extra profit is 80,000. Are we good? Can I see? Is this number changing every year or same every year? This is same every year, but still the problem, the culprit is depreciation. Because of that, we have to have how many columns? 10 columns. So next working note is what? Estimation of cash flow. I'll start from sales or I'll start from profit before depreciation. Profit or incremental profit depreciation? Incremental profit before depreciation is 80,000 every year from year 1 to year 10. Got it? And then what do you have to do? Reduce the depreciation. Reduce depreciation. One they have given or one we calculated. What is we calculated here? This number from 26,250 to year 1 to year 10. All this depreciation copy paste. Yes, Saji. This is depre or incremental depre. So that we have copied in this table. Okay now. So right. So that means all the expense has been considered. From income, if you reduce all expense, what are you going to get? Profit before tax. Here every number is on what basis? Incremental basis. So from profit before tax, if you reduce tax, what are you going to get? Profit after tax. Give you a minute. Ask me if you have any doubt till here. Good, sir? Okay. PAT we have found out. On a what basis? Incremental basis. Then 5 adjustments. What are those 5 adjustments? Depre or incremental depre? Add back incremental depre, add back incremental OAS. So whatever depreciation you have reduced here, add back. Then OAS. Oh, opportunity cost. We read the data. There or not there? Not there. Leave that. Then W. Working capital. There or not there? Leave that. Additional investment or capital. There or not there? Not there. Salvage value or incremental salvage value? Incremental salvage. Sir, if you continue to use the old asset for 10 years, salvage value is 0. But if you buy a new asset and use it for 10 years and then sell it, you will get how much? 35. So old asset ka salvage value after 10 years is 0. New asset ka salvage value after 10 years, they told in the problem, is 35. So how much extra? Incremental salvage value is 35,000. You will get it every year or once? Which year? End of the project. Here project will end on 10th year. So incremental salvage value 35 minus 0. This 35 is new. 0 is for the old asset. So incremental salvage value is 35. Done now? Yes. That's it. So do this, you will get the cash flow. All these are on present value terms or future value. Multiply discount factor. You will get the present value. All these are what? Present value of cash inflows. Sum them up. You will get the total present value of cash inflow. This number. Okay. But we want NPV. How do you get NPV? This is the present value of cash inflow. How do you get NPV? Minus present value of cash out. We want present value of cash outflow or present value of incremental cash outflow. Present value of incremental cash outflow. For new asset, how much are you paying? 4.5. When you buy a new asset, old one you will keep it or give away? And old one will be taken for how much value? 1 lakh. So how much cash outflow will happen if you buy a new asset? 3 lakh. That is the incremental cash outflow. This is inflow ka present value. This is outflow ka present value. When you net off, you will get how much NPV? 44. NPV or incremental NPV? That means compared to the old, new machinery is giving an extra NPV of 44,000. Means reject the decision or accept? Accepting what decision? Replacement. Sell the old asset and buy the new one. That's all as a drop. Got it up, people? Lengthy but doable. Easy only. Yes, time, just focus on that. Now in the same problem, STCG also I'll explain. I've written it here and cancelled, okay? I'll explain that, but this is a solution. Okay now? And now, let's talk about short-term capital gain, short-term capital loss. So if you buy off new asset, currently we have only one asset in the block. Which is that asset? Old asset. Now old asset you will sell and buy a what? New asset. So block has come to an end or new asset is there? Since one asset, that is new asset, is there in the block will continue. But new asset will come forever or 10 years?
10 years.
After 10 years, what you will do? New asset you will sell. When you sell a new asset, there was only one asset in that block, that is new asset. After 10 years, when you sell that new asset, block will continue or block will come to an end? When block comes to an end, you need to calculate capital gain tax. In this problem, they have asked us to ignore. But if that not told, then we had to calculate. How to calculate? Tell me, STCG. First, you will take what? Book value of the asset. At when? At 10th year ending. Should we have to calculate this or already done? Already done. What is the closing balance of the asset at the end of 10th year? 1,60,504. 160,504. Okay, now this is the book value. But did you sell this new asset for that much value, or what is the salvage value? The salvage value at year 10 ending is you sold this new asset only for 35,000, they told in the problem. So happy face or sad face? Sir, value as per tax record. The book value as per tax record of the new asset is 160, but you sold it only for 35. So this is what? Short-term capital loss. How much? 1,25,504. On loss, will you pay tax or tax benefit? So you will get a tax benefit. Okay, assuming short-term capital gain or loss is at 30%. They have not told. If it is at 30%, how much benefit you will get? Calculate this ka 30%. Sorry? 37,651. What you will take this number? Are you paying this tax or it's a tax benefit? That means you will take this as a inflow. Which year? Okay, so check. That's what I've written here. At the 10th year, you will take a benefit of how much we got? 37,651. Okay. This I've struck off. Why? Question asks us to ignore. If they had not asked, then we would have brought in this as a positive number. Which year? 10th year ending. That's it. This will again come in the next problem. That is the last problem I'm planning to do. Another 20 minutes. Are we okay with this?
Yes.
Any working note you want me to show for you to review, or can we go for that last question? Done, Sirji. Yes, if it is not incremental, then you will take 4.5. Correct. But don't do it under normal approach. Always do it under incremental, because see, if you do it under a normal approach, no, decision will be same, but each value will be different. He is saying I'll do old separately, new separately. 2 times I'll calculate NPV. Answer is right? But decision is also right, but numbers will be different. Evaluator may not be FM teacher. They will not understand what you did. They'll just compare. Not matching. 0. We don't want to take that chance. As much as possible, let our answers be close to ICA. Okay. First of all, in my view, this is also wrong. This STCG calculation is wrong. Okay, I think I should not have said that. Okay, fine. Since I've said now, I'll have to say. Actually, my interpretation, again, you can check with your tax faculty. My interpretation of taxes, what tax law says, when the block comes to an end, that year you should not charge depreciation. As per the tax law, when the year block comes to an end, that year you should not charge depreciation. Here, block will come to an end in which year? That means 10th year, ideally you should calculate depre, or you should not? You should not. So, how do you calculate how do you calculate STCGs? You will compare book value not at the end of the year, but at the year beginning. You will take 10th year beginning ka book value, compare it with the sale value, then accordingly you will get short-term capital gain or loss. But currently our ICA material still is using this. They have not corrected, so I can't comment. So for marks, we'll have to do like this. In FMA, do this only, don't use tax ka funda. If you compare this with tax, it will not match if you remember tax, right? But for FM, you keep this one till they correct it. If they correct it, it's okay, but till now, as I have seen, no. Okay, now, so you'll follow these steps only. Fine, Sarji? All right. What is that next question? Or enough? Mind is hard to saying enough, sir. Mind is saying one more, sir. Maybe our whole body is saying class is only enough, sir. Yeah. Okay. 15 minutes can we bear with? Can we do one more question? Yeah, there's also 1 or 2 new points will come in this question. So I think it's better to know. This is MTP September 24 question. Probably now there in study material, I'm not sure, but still a good question in my view. Okay. Paramartha Limited, computer manufacturers ante. Owing to the recent developments in artificial intelligence, so they are planning to introduce AI in computer process. Okay, ji. This would result in estimated annual savings. Savings, it's what? Outflow or inflow? Inflow. In that to 1 year ka inflow or annual saving. So every year you will get this. Okay, na sir? Is it okay? As and when we see the data, can we push off the data and they'll give you a lot of inflows and a lot of outflows here. Directly can we tick in the solution? Okay. First benefit you will get is how much savings is that? 3.5 lakh production delay caused by inventory problem. If you introduced AI, they are saying that inventory problem will not occur and how much saving we can get? 3.5 lakh every year. What is a project life here they have given? How many years is this? 5 years. So this saving you will get it for 1 year or every year? Every year. Sir, if you get every year saving, we will use one column approach, no sir. See, check here. This is same, huh? This is same or changing every year? That means one column approach or 5 columns? 5 columns. So first saving, first benefit we got. What is that? Or maybe we'll read off and capture this whole data. First saving is 3.5 lakh every year. Another saving is what? Salary of 5 employee with an annual pay of 420. Sir, if you introduce AI into the system, manpower you can send to them. No, not required. Tata Macha you can say. So how much they were getting salary every year? 4 lakh 20. How many employees? 5. So 1 employee 420. For 5 employee how much? 20? 21 lakh a salary of employee you can save. This is another savings. Okay, 21 lakh. Next to reduction in lost sale 175. Some extra sales we can make because system is more efficient. No? So they are saying because of this AI you can make an extra sale of how much? 175. Okay. Gain due to timely billing 325. So everything is either a saving or a gain. So all these are what? Benefit. So check every 35, 3.5, 21, 175, 325. Now we will capture one by one. It's okay. This is your production delay saving, salary saving, say extra sale, billing saving. Estimation of cash flow wala problem. Okay, people. These are all benefit. Good. Okay. Next, what data they have given? The project would result in annual maintenance and operating cost as follows, which is paid in advance at the beginning. You'll have to make this payment at the year beginning. Keep that in mind. So how much is this maintenance cost? 180, 2 lakh, 120, 110, 130. Same every year or changing every year? So this is a benefit or outflow? Expense basically. These are all your incomes. These are all your expense. So this one plus or minus 180, 2 lakh, 120, 110, 130. Check, have you minus this? Same number as given in the question we have reduced. Okay, Naji? Income or expense? Hanji? Next, what is the next one? I'll talk about this. This has one more significance. I'll come to that in a bit. Furthermore, new system, we need 2 AI specialists. We need extra specialists to annual salary is how much for them? 6 lakh per person. And how many such people we need? 2 lakh. There are 1 ka annual salary is 6.5 lakh means 2 ka will be 13 lakh. Income or expense? So this will come if you introduce AI means this extra cost will incur. So all these are already incremental people. They've already given all this in an incremental basis. How much extra salary we have to pay? 13 lakh. 13 lakh considered here 13 lakh. Anji? Okay, next. What is the next one? No? The purchase price of the new system for installing AI into the computer would involve an outlay of 21 lakh 50,000 and installation cost is 1.5 lakh. Installation cost also we capitalize on, So what is the purchase cost of the new machinery? 23 lakhs. Okay. 75% of the total value of depreciation would be paid in the year of purchase. Would be paid in the year of purchase. 1 minute. Totally how much is a purchase cost? 23 lakh. In this 23 lakh, full amount you will pay immediately or 75%? 75% you will pay immediately means how much is that? 17.50 is the year 0 ka outflow. Do you agree with me? What about balance 25%? What is that amount? 17 lakh. This is 17.25. So that means balance 25 will be 5.75 lakh of balance 25%. What you will do? Balance would be paid at the end of first year. Okay. So this will come in year 1. Agreed, people? This is how you are agreed to settle. You are paying, you purchase the asset and settling the amount in installment. Okay, ji. If you want, you can have year 0 ka separate working, or if you want in your estimation problem only, you can bring in year 0. Just for one problem, I think here year 0 also I brought it here only. You can also do like this, or cut off year 0 and bring it separate. That presentation is also okay. Presentation is absolutely your call. So tell me what you will do in year 0, what you will do in year 1. Relating to this. Year 0, 17.25 plus or minus outflow. So minus 5.75 minus only, but which year? Year 1. You can interpret this as an additional investment or whatever. 17.25 and 5.75. Captured a check. Cash outflow 17.25, 5.75. 17.25 in first column, that is year 0. Then the other one in year 1 column. Okay, ji. Next, what else is there next to? This is the only asset in the block for income tax purpose. If there's only asset in the block, means when you sell this asset at the end of useful life, block will be there or block will come to an end. When block comes to an end, you have to calculate short-term capital gain ka tax or short-term capital loss ka benefit. Last problem we ignored because question said. Here, let's see. Useful life of this asset is how many years? 5 years. With a hurdle rate 12%. Hurdle rate means your discount factor. What is the discount factor? 12%. Depre at what rate? 40%. What basis? WDV basis. That means depreciation will be same every year or change every year? Change. Corporate tax rate is 25%. On your normal business income, you have to pay how much tax rate? 25%. On capital gain, you will pay what rate? 20%. Short-term capital gain, short-term capital loss will attract a tax rate of 20%, but the normal income tax you will pay it at 25%. You need to advise by calculating PI. PI as in profitability index, and ARR also they are asking us to calculate. We'll see that later. First, can we calculate profitability index? Okay. Now, people, depreciation on what basis? WDV basis. Have they told any existing asset here? No. So that means existing asset ka block value is what? 0. Not given. So what? So how much did you pay for new asset? 23. That means that incremental base only will be 23 lakh. So now calculate depreciation as a separate working note. What is the rate of depre? 40%. One separate working note, I have put it up here, check for depreciation. What is the opening balance of the asset? 23 lakh. Got it? Depreciation first year is what rate? 40%. 23 lakh of 40%. 9.2. From opening balance reduce depreciation, you will get closing. First year ka closing will become second year ka opening. Now on this calculate 40%, you will get this. Calculate this for 5 years. Normal WDV depreciation. Okay, na sir? I have not calculated incremental base and all because existing base and all is not given. Yes, sir. If that given, I would have got into account. Okay. Now this data we should ignore or it should come into our cash flow calculation. So it's also an expense, no? So this depreciation, see if we have captured here. I think we have captured all this. So we'll take this over. Depreciation from here. Captured? Yes, here. These are all the depreciation. I'm not taking everything. It's all this till here we have captured. Yes, sir, people. Any other expense income is there or that's all? From income, reduce all expense. What are you going to get? Profit before tax. Okay, this is year 0. No? You'll get the profit only at the end of first year. No? The profit will start from year 1 data. If you want year 0, you can cut off people and follow it as a separate calculation. Absolutely okay. Okay. Now tax at what rate? Now you will take 20 or 25. So on your these are your normal business income. On this you will calculate tax at what rate? 25%. Any losses there or normal problem? Normal problem. From PAT, from PBT, if you reduce tax, you will get profit after tax. Good. After PAT, you'll have to do 5 adjustments. What are those? Add back depreciation. Whatever depreciation we have deducted here, we'll add back. Okay, now. Then O for opportunity cost. There or not there? Working capital, there or there? Not there. Not there. A for additional investment, already captured here. 17.25 something we wrote, no? Here. 5.75, already captured. Yes, no? Right. When you bought the asset, at year 0, you paid 17.25. 75% you paid at year 0. End of the year, you paid 25%. That is captured. Then, salvage value. Salvage value, that is salvage value. Pa. Have they given or not given? Oh, in fact, here we didn't read. Yeah. 75% of the total value of depreciation will be paid in the year of purchase. Balance would be paid at the end of first year. New system will be sold for how much? 1,90,000. What is this 1,90,000? Salvage value. New asset will last for how many years? 5 years. I mean, this is a salvage value after 5 years. So, minus a positive. Outflow or inflow? So, which year? Year 5, have you taken salvage value 1,90,000? Done now. Any problem? No. Are we okay? Now, since this is the only asset in the block and capital gain tax also is given, we have to ignore capital gain or we have to pay? We have to calculate. Now, you guide me how to calculate. One more adjustment is there that I'll talk about it later. But first, tell me the STCG or STCL ka. What we'll do? Book value. Ideally, as per income tax, you have to take 5th year ka ending or 5th year beginning. But FM, our ICA material, what is taking? 5th year ending ka book value, how much? 1,78,000. Yes, sir, this is the book value. But did you sell it for 178 or 190? They only told in the problem salvage value is 190. Book value is 178, but salvage value or sale value at the end of 5th year expected is 190. Sad or happy face? 178 worth of asset, if you sell it for 190, then it is a gain. How much gain? On gain, you will get tax benefit or you will pay tax. This tax at 25% or 20%? They told in the problem clearly, capital gain attracts what tax rate? 20%. This gain ka 20% you calculate this. This, where you will consider this number? In estimation of cash flow working note. Which year? Last year, that is year 5. Inflow or outflow? Plus or minus? So, end of 5th year, because you will pay this tax only when you sell the asset. Sale of asset will happen at the end of the useful life, which is 5th year. So, 5th year, 2230.4 should come as a negative. Somewhere it is there, here, 2230. Okay. Everybody comfortable? Yes. Yes. But there's one more hidden adjustment over here. That's it. Other things are fine. What is that? So that maintenance, no? Maintenance. You should have asked one question you did not ask. The maintenance, when are you paying? Beginning. But if you just check this value, no? 180. Remember this value. 180, 2 lakh. Maybe only 2 years column is okay. 180 and 2 lakh. So ideally you tell me, or here only you tell me, ideally I should consider this 180 under year 1 column or year 0 column? Year 0 column. Why? We are paying all this at the year beginning. So at first year beginning, if you pay means that should come under which column? Year 0. This 2 lakh payment should come under year 1. Then here 2, year 3, year 4. Check, have we done that? Check here. Did we reduce that 180? First time when we reduced 180, we reduced under year 0 column or year 1 column? Means mistake, no? No, why, ma?
Profit and loss statement, it's a progress, so it should be on the year that is for which it belongs to.
Perfect. Sir,
but cash flow doesn't like that. Cash flow belongs to which year the cash went.
Perfect. Sir, you pay this, you're reducing this expense to calculate what? Tax. Tax you will pay at year beginning or year ending? Year ending. Right? Tax, see this one expense you can pay it at year beginning. But does it mean tax also you will pay it at year beginning or year ending? Year ending. So for tax purpose, first you need to consider all this expense on a year ending basis. Whether you pay it at year beginning, year mid or year end, doesn't matter. For tax purpose, you will always put the expenditure at the end of the year. Once you have paid the tax, so first logic, did you understand this? So I put this under year 1 column. Why am I put it under year 1 to year 5 column? Because you will pay tax to the government only at the end of the year. And to calculate the tax, we need income minus expenditure. Hence, for tax purpose, any expenditure, even if you paid at a year beginning, you will consider it at year ending. First one. Okay. Once you pay the tax, what we'll do is, whatever you have reduced, first add back. See, check, I've done that. Whatever we have reduced first, I have added. Clearer? Why? Because did the actual cash flow happen at year 1 ending or year 0 beginning? Now bring in the correct columns. Okay, because outflow started happening from year 1 or year 0 onwards. So then put it on the year 0, year 1, year 2, year 3. This is a drama. This is true for any expense. Tell me once more, what is that last point again? All this expense, when did you actually pay? End of the year. But sorry, actually you paid it at the year beginning. But can we consider it at year beginning? No, because all expense we should first consider for tax purpose. Tax you will pay only at the end of the year. Hence, even if you have paid the expense at year beginning, first consider them at year ending only. For what purpose? Calculation of tax purpose. Once the tax is paid, whatever expense you have reduced, that same expenditure you will add back in the same year. Whatever you have reduced, same you will add. Same like depreciation. And then what do you do? In whichever year the correct cash outflow happened, that year you consider. This outflow happened at year 1 or year 0? Bring it to year 0. This outflow happened at year when?
1.
Year took a beginning. That is nothing but year 1. So put it to the relevant column. That's all it is. So this is the actual outflow. This is for tax purpose. That's all. It's just drama. That's it. Another takeaway from this question. Okay, sir. Now, if you compare this with the solution, it may not match because I have taken 2 decimal. They have taken 4 decimals. So the final answer, if you say it's not matching, some round off error is there. That is only due to this decimal. They have taken 4. I have taken 2. Or in case you have that doubt. In case you are sitting with this question. Okay, people. This is about this problem. And now you know the profitability index. Now, how do you calculate profitability index? This is present value of cash inflow. This is present value of cash outflow. These two you divide and you will get the, I think I did NPV by mistake. Actually, they asked what? Profitability index. But you know how to calculate that, right? They've asked NPV also. Great, good for us then. So that is the answer. Since NPV is positive, reject or accept? Accept. Easy. Then they've also asked ARR. How to for ARR we want cash flow or PAT. And now don't calculate again. Here only it is there. PAT is there here only. But we want PAT or average PAT. This is 5 years ka PAT. How do you find average? Add all the profit divided by 5. You will get average PAT. Problem has already become lengthy. Don't take average investment. Take initial investment. How much did you invest? 21.5 for machinery, 1.5 lakh for installation. Totally how much? 23 lakh. Take initial investment better. You can take average investment also, but I think by here most of us will not get here only. Time wise, it will be already late. So if it's big problem and all, always prefer to take initial investment. That's okay. Even if you take average answer will change. If you take average investment, ARR will not be this. It will be different. But both are acceptable as per ICA standard. This is another takeaway of this question. Okay, one is that short-term capital gain wala. Another one is what if any expenditure is paid at year beginning. First, for tax purpose, consider them at year ending. After tax, add back. Then take them under the respective columns. That's it. So I think, yeah, these are some of the things I wanted to discuss with the investment decision wala topic. So thank you for your time and patience. So now we'll take a lunch break. It's almost 1:30. Can we resume back by 2:30? 1 hour is good enough. I think some of you have to go and come back. So 2:30 will start. So 2:30 to probably 6:30 maximum, maybe 7. Okay. Hello people. So let's continue our revision series. Now we'll be revising working capital management, another big ticket topic of our FM. Okay. Yes, we do expect some good amount of marks to turn up from this as well as investment decision, almost every attempt. Okay, so let's straight away dive in. The first aspect, how do you get working capital? Current assets minus current liability. If you do, that final net number only is what we call it as working capital. So basically in this particular topic, essentially we are managing current assets and current liability, or trying to get the balance of current assets and current liabilities right. That's essentially what we are doing in this chapter. Okay. Why we do this? We say working capital management is a trade-off, or it's a balancing act between liquidity and profitability. We are trying to achieve the profitability, but at the same time keeping liquidity in picture. Liquidity means business shutting down risk. We don't want to take too much risk, but at the same time, we don't want to compromise on our profit also. Somehow that between that liquidity and profitability, we are trying to get the balance right. More about this, we'll discuss in a bit. Okay. Again, usually we don't expect much theory questions to come up from this topic. It's mostly the numerical problems that essentially comes. Few things are there. Let's quickly run by. Okay. First, if you want to analyze working capital, you can analyze it or assess it from two angles. One from value angle, another from time angle. From value angle, if you are assessing working capital, we say it is gross working capital or net working capital. Net working capital calculation is same. If you do current assets minus current liability, that component only we call it as net working capital. Gross working capital means summation or total of only current assets. Only current assets ka summation or total if you do, that component we call it as gross working capital. This is from value angle, you can analyze the working capital. If you are analyzing the working capital from time angle, we say working capital are of two types. Permanent working capital, temporary working capital. Permanent working capital means, some organization will maintain always minimum amounts of cash for day-to-day expense. They may say, I will always like to maintain 1 lakh in my bank account. Minimum balance, how much they'll maintain? 1 lakh. That portion of cash, we call it as what? Permanent capital. Some organization maintain minimum levels of inventory as a buffer stock and all that. So that minimum levels of cash, minimum levels of inventory and all becomes what portion? Permanent portion of working capital. Other than this permanent, whatever remaining working capital is there, that becomes what? Temporary. If it's not permanent, obviously it becomes temporary working capital. All these are not that very important, so it's fine. All right. Okay. Now we said that working capital is essentially managing current assets and current liability because we want to get the it's a trade-off between liquidity and profitability. What does that statement mean? Let's assess this. Suppose people inventory level increases. Let's say closing stock level increased. Let's say I used to give the same example in class if you remember. Let's say there is a tomato dealer. Okay. Normally the tomato dealer stores how many kgs of tomatoes? 50 kgs. But one fine day from 50 kgs they decided we will store 200 kgs. From 50 directly the inventory level was increased to 200. Okay, so closing stock level increased. Tell me, is there any advantages due to this? Because of this, is there any advantage? So from 50 kgs, if you increase the stock level to 200 kgs, any advantage you see? Yeah. Earlier, you were able to sell only how many kgs? 50. Now we are able to sell 200 kgs. That means if you are having more levels of inventory, if you purchased more and if you are maintaining more levels of inventory, you can sell more and you can earn more. So advantages, you can keep up with the demand. Let's say earlier, some person came for 150 kgs cut. Someone came to this vendor and said, I want to buy 150 kgs of tomato. Can we sell 150 kgs of tomato to this person? No. Earlier, we had only how much? 50. So we'll have to let go of him. But now if you are maintaining 200 levels, can we sell this 150 kgs of tomato to that person? Yes. So that's what we mean by we can keep up with the demand. Meaning we'll be able to sell more, so we'll be able to earn more. So by maintaining higher levels of inventory, by purchasing more, your profitability will increase. Advantage. Is there any disadvantage due to the setup? Do you see any problem in the setup? Yes. Sir, what if the vendor is not able to sell? Earlier, he used to face only how many kgs of loss? 50 kgs. Now, if he is not able to sell, whatever, maybe that day there was a heavy rain. Nobody stepped out of the house. He's, let's say, vegetable vendor. He goes road to road and sells. But that day, due to heavy rain, he was not able to visit. Then what will happen? He'll suffer 50 kgs ka loss or 200 kgs? 200 kgs. Like this 3-4 days, if the small vendor suffers this loss, what will happen to his business? It'll shut down. That's your liquidity risk. So by maintaining higher levels of inventory, right, there are some advantages also. There are some disadvantages also. The disadvantages is that fund gets blocked. One other thing is earlier we used to invest to buy how many kgs of tomatoes? Only 50. Now we have to purchase how many kgs of tomato? 200. So in order to buy more, we need to invest more. No? So more funds get blocked because see, this fund will get released only when the vendor sells. So hence by maintaining higher levels of inventory, funds get blocked. And if the vendor is not able to sell, what will happen to business shutting down risk? It will be same or it will increase. That we call it as liquidity risk. So we can't blindly buy how much ever we want. We have to carefully manage them. That is all is your working capital management. Because by having higher levels of current assets and current liability, it affects liquidity also, it affects profitability also. Somehow we are trying to get the balance right. There's no magic formula. All this depends from company to company, situation to situation. But we have to manage it. That's what we are about essentially doing it in this particular topic. Are we good with this so far, people?
Yes.
Like this, each level of current assets, by increasing, decreasing, there are some advantages and disadvantages. If you want quickly, we can run through this. Not very important. Suppose earlier I used to give 30 days credit to the debtor. We used to make a lot of credit sales on how many days credit? 30 days. Now we have decided to give 90 days credit. We have decided to follow a liberal credit policy. What will happen to this policy? Tell me, because of this, what will happen? We'll be able to achieve higher sales, because we are giving more credit means more customers would want to buy from us. Rather, we will be able to sell more sales. Higher sales will lead to what? Higher profit. Advantage. Disadvantage. Earlier, we used to recover the money within how many days? 30. Now we have to wait for 90 days. That means fund is getting blocked for extra 60 days. That's our advantage. What about rather disadvantage? Another disadvantage, bad debt ka risk increases. So if more and more debtors goes bad, what will happen to my business? If some of the major customers goes bad due to this liberal credit policy, then our business shutting down risk also will increase. So liquidity risk also correspondingly increase. So there is an advantage of profitability increase, but there is also a disadvantage of liquidity or business shutting down risk also increase. So we need to carefully manage. Done, Sarji? Similarly, creditors. Let's say, what if creditor ka balance increases? How will creditor ka balance increase? One, we are purchasing more. Second one, we are not settling the amount on. We have to, let's say, settle the creditor within 30 days. Creditor gives us only how many days credit? 30 days. But we are settling on the 95th day. We are purposely delaying the payment. Is there any advantage due to this? Yeah, one of the advantages, earlier you had to pay money. Cash outflow would used to happen on which day? 30th day. Now cash outflow will happen on the 95th day. That means you will be able to use this extra cash for 65 days more. Because you're not paying the creditor, no? So you can use that cash for your own business management. That means it acts as a free source of finance. Because at 65 days, you can use that money for your own internal business purpose. So by delaying the payment to creditor, one of the major advantages, it acts as a free source of finance. What about disadvantage? What are some of the disadvantage of purposely delaying the payment? One, loss of reputation or goodwill. Creditor will not trust your words anymore, because you're going on telling tomorrow I will pay, tomorrow I'll pay, you're not even paying. One, loss of goodwill. Second one, creditor may say, okay, you only are playing games, I will also start playing games. Henceforth, they may say no more credit purchase for you. Pay cash, take the goods. He may stop the credit supply, or he may increase the price of the goods, or worst case, they may say, to hell with you, I'll stop the transaction with you altogether. So there are some advantages as well as some disadvantages. So you can't just blindly, yes, we would want to delay the payment to creditor, but forever, or you have to manage them carefully. That's all essentially we are doing in this topic called working capital management. Okay, Sarji? So current assets and current liability we'll have to manage. One by one, we'll go into the components. This is just an overview of this particular topic. Okay, now we'll go into the exam relevance. All these are not that very important for exam. A quick, at best, maybe 1 or 2 marks ka MCQ question at theory level might come. Okay, but we'll focus our time and energy in more towards the more exam worthy topics. Okay, we'll directly dive into some questions. So here what I'll do is I'll take each concept and correspondingly I will do of the questions, because there are many concepts. So we'll do one by one. Concept back to back questions simultaneously we'll do it. I think that approach might be better for this particular topic. First, operating cycle. Operating cycle. Sir, what is, if there is a trader, what is their main operation? If there is a, let's say there is a calculator dealer, what is their main business? Buy the calculators and sell the calculator. When you purchase the calculator, we have to pay money. When we sell the calculator, we will recover the money. All this will happen in one day, or it will take some time. It may take 50 days, 100 days, 200 days, 10 days, whatever. That time gap only we call it as what? Operating cycle. So basically operating cycle is a time gap, or it's a duration between the day you purchase the goods and produce the goods and pay money for it. If you are a manufacturer, you will purchase finished goods or raw material? Raw material. So operating cycle is basically a duration between the day you purchase the goods and pay money for it till the time you sell the goods and recover the money. So it's money to money ka gap. When you purchase, you will pay money. When you sell, you will get back that money. That duration, how much time it is saying, that duration only is what we call it as what? Operating cycle. You can also call it as working capital cycle also. Done, Sarji? How do you get operating cycle? There was a small formula. Anybody remembers how do you get operating cycle? R plus W plus F plus D minus C. Right? R for raw material holding period. W for work in progress holding period. F for finished goods holding period. D for debtors collection period. C for creditors ka payment period. By doing this, we automatically get something called operating cycle. I had proved to you this equation, how it works with a timeline. Let's not go into all that for the time being. Let's focus more towards our examination for now. Done, Sarji? Suppose you calculated operating cycle and you got, let's say, 90 days. You calculated operating cycle and you got it to be 90 days. What is the meaning of this? What is the meaning of this? If OC is 90 days, what is the meaning of this? Your fund, if you invest the money today, to buy the goods, if you invest the money today, you will recover that money when? 90 days. That means your funds are getting blocked for 90 days. If your OC as an operating cycle is 90 days, means indirectly your funds are getting blocked for 90 days. Now, can you tell your employees, money will get released only after 90 days. I will pay salary after 90 days. It will work. They will quit and go. Yes or no? That means if OC is 90 days, means how will you manage your rent to electricity, salary and other expense? You may have to take a short-term loan. Okay, na, Sarji? Okay, this is one. Okay. Now, 1 minute. There is one problem where we calculate operating cycle. Let's do that right away. It's a study material question. I think it's also come in some of the RTPs. So let's review this. Following information is forecasted by R for year ended 31st March. They have given balance as on 31st March 2022. Then they have given balance as on 31st March 2021. Why have they given 2 years ka data close? Perfect. Sir, 31st March 2021 ka balance will be previous year ka closing balance, which will become current year ka opening balance. This will be current year ka closing balance. Using this, we can find out the average. So they have given raw material ka basically opening stock of raw material, and they have given closing stock of raw material. Similarly, they have given opening and closing stock of WIP as well as finished goods through this data. Receivable as in debtor. Debtor ka opening closing given. Payables as in creditor ka opening closing they have given. Fine. How do you calculate operating cycle again? R. R as in raw material holding period. Raw material holding period means what? You know OC, you're going to get it as R plus W plus F plus D minus C. What does R mean here? Holding period. That's a meaning. Oh, but yeah, what is the interpretation of this R? Sir, if you buy the raw material today only you will start manufacturing, or you might store that raw material for some time. You might store that raw material for 5 days, 10 days, whatever. That is your R. How many days are you storing your raw material? Okay. W is work in progress holding period. Sir, if you are a car manufacturer, within 1 day can you manufacture car, or it may take some time? It may take some 3-4 days to manufacture, or maybe 10 days, we don't know. That is your work in progress. Till you started the production today, but when is it getting completed? Let's say process time is 10 days. That means at 10 days it is neither raw material nor it is finished goods. It's stuck somewhere between. That is your work in progress holding period. To process raw material into finished goods, how much time you take? Then F for finished goods ka storage period. The moment you produce the finished goods, immediately you will sell, or you may take some time to sell. It may take some time to sell. Let's say company feels we need about 25 days to sell our product. It takes about 25 days to market and sell our product. That means how many days we need to hold our finished goods? 25 days. That is your F. How many days are you storing your finished goods? D for debtors collection period. Now, most of the sale happens on a business mode through a credit basis. So suppose you're giving 40 days credit to your debtor. So that is your DD as in your debtors ka credit period or debtors ka collection period. C as in what? Creditors. When you purchase raw material or when you purchase finished goods, right? You may also get credit from your creditors. Let's say creditor gives 30 days credit. That is your C. Right? By doing all this plus minus, we're going to get a number that's called operating cycle. Now in this problem, we have to calculate OC only, but using this particular data. For that, they have given opening stock, closing stock of WIP, work in progress and finished goods, and debtor ka opening and closing, creditor ka opening closing. Fine. Next, what have they given? Annual purchase of raw material, and all the purchases are on credit basis. All these numbers are in lakhs. We have purchased 400 lakh of raw material. Annual cost of production, annual cost of goods sold, annual operating cost, annual sales they have given. Fine. You need to calculate operating cycle, OC. Tell me, sir, for operating cycle, we need R as in raw material holding period. Have they given raw material holding period in days or months, or have they given in value? They have given raw material ka opening stock and closing stock. We want raw material holding period in duration, days or weeks or years. Is that data given or missing? We need to find. First find out the average. What is the average number of this? Give me this average. Average stock of raw material is how much? How do you find average? Add these two, divide by 2. Quickly tell me how much is that? 55. These two ka average. 51 plus 35 divided by 2. 43. Okay, these two ka average. 65. These two ka average. 120. 123.5. These two ka average. 69.5. Are we comfortable? Okay. Raw material, people, you will purchase for what joy? To sell it or to consume it? See, raw material will get converted into finished goods. That means raw material business never sells. They gets consumed, and what will be manufactured out of it? Finished goods. Means we want annual raw material purchased or we want raw material consumed. First find out raw material consumed. How do you get raw material consumed? Annual raw material consumed. It's like a COGS. How do you get that? Opening stock plus purchases minus closing stock. How much is opening stock of raw material? 65. Okay, I think they've given the order in ulta, no? Yeah. Opening stock here is 45. Okay. Then purchases. How much purchase of raw material you made in the current year? 400. What is the closing stock? 65. So do this. How much is this? 380. Okay. Now you tell me this 380 ka number is for one day or whole year? This 380 is raw material consumed for the whole year. Some problem may they say take 360 days and all. Have they told in this problem check? They told take 1 year as 365 itself. Some problem may they say take 360. Here you have to take 365. So this 380 lakh is a number for how many days? 365 days. Agreed. But do you maintain 380 lakh of raw material on an average stock, or how much is your average stock that you maintain? Average raw material you maintain as how much stock? This is what duration, or this numbers in lakhs? 55 lakh is the average stock in value, no? So 55 lakh represents how many days ka stock? 380 lakh is a stock for one day or whole year? For whole year. But do you maintain 380 lakhs or on an average only 50? Or rather on an average only 55. 55 represents how many days ka stock? Can you tell me that? When you prorate this, x is equal to how much? 55 into 365 divided by 380. How much is that, sir? You can just say 55. Huh? 52.8. Can I round it off to 53? So on an average, a raw material holding period is what? 53 days. Like this R we have found, no? W, F, D and C also we need to figure it out. So in this problem, those data are not directly given. We need to proportionate it. Done, na, Sarji? Everybody good? Once more or okay? Oh, next, similarly, WIP ka. So WIP eventually will get converted into what? That means we have to use what for WIP? For proportionate purpose, we will use the cost of production. So now this is your A. Next, when you find out W, same drama. What is your annual cost of production? 450 lakh. This is for one day or whole year? So this is for 365 days. But do you maintain 450 lakh worth of production as the WIP ka stock, or how much do you maintain? On an average, you maintain 43 lakh worth of goods as WIP. That's processing time is how much? To produce finished goods worth 450 lakh, you take 365 days. Matlab this 450 is a number for how many days? 365 days. Similarly, 43 lakh worth of stock is for how many days? Proportionate that 30. Round off, it is 35. Okay, now. Similarly, find out the next one. What is the next one? ROW and F. Finished goods, eventually, what do? Sell. Right? What is the annual cost of goods sold? 525. 525 is for 1 day or whole year? All these are annual. That means this is a data for how many days? 365 days. But do you maintain finished goods 525 lakh worth of finished goods, or on average how much finished goods you maintain a stock? If you're maintaining 65 lakh worth of goods, that represents how many days ka stock? So 65 into 365 divided by 525. How much is that? 45 days. That is your F. R over W over F over. Then what's your D? D as in what? Debtors ka collection period. You tell me, relating to debtors, which number should we take here? Debtors will arise only when you sell. That to total sales or credit sales. Here annual sales and all of them are on credit. How much is that? 585. So this 585 is a number for how many days? Whole year. That is for 365 days. On an average, 585 lakh worth of debtor balance do you maintain, or what is your average debtor balance? Average debtor balance is 123.5. That represents how many days ka debtor? 77 days after round off. Agreed? Last is your C. How do you get C? C is for creditor. For creditor, you need raw material consumed or raw material purchased. From creditor, you purchase the raw material. Na? What is your annual purchase of raw material or on credit basis? So 400 lakh is a purchase for 1 day or whole year. That is for 365 days. But is your average creditor balance 400, or what was your average creditor balance? How did you find average? Opening plus closing divided by 2. Average creditor is 69.5. 69.5 represents how many days ka creditor? 63 days. Okay, now? And now calculate OC. How do you get OC? R plus W plus F plus D minus C. So do that. A raw material holding period is 53. 53 plus 35 plus 45 plus 77 minus 63. So how much are you getting? 147 days is your operating cycle. Clear, sir? That's a requirement. Any problem? No. Okay, next, what have they asked? Number of operating cycles in a year. First they asked operating cycle in days. Now they are asking how many cycles can you run in a year. So to run one cycle, how many days you need? To run one cycle, we need 147 days. How many days are there in a year? 365. There are 365 days in a year, and to run one cycle, we need 147 days. Means how many operating cycles can you run in a year? 365 divided by 147. How much is that? 2.48. Okay. Difference on consumed production ante. Raw material you will consume. Acha. First it will be in raw material data. After raw material it will move to which data? WIP. WIP eventually will become finished goods. So what you consume is raw material. What you sell is the finished goods. Raw material you will never sell. Raw material you use it for production. That usage only we call it as consumption. This raw material you use, this finished goods you sell. And for raw material to become finished goods, there is some timeline. In that duration, we call it as what? WIP. Basically in process wala stock. Are we comfortable with A and B requirement? Now they are asking how much is a working capital requirement. Very simple. Oh? Go back to the problem. How much is your annual operating cost? 325 lakhs. So if you want to know how much working capital you need to maintain, if you want, you can take it as formula. It is nothing but your annual operating cost. Right, like this. Annual operating cost divided by number of operating cycles in a year. This is the formula. Okay, if you want the logic of it, simple. What is your annual operating cost? To operate for the whole year, how much cost you are incurring? To operate in the whole year, you are incurring 325 lakhs. Agreed? This is for 1 day or whole year? Whole year. And whole year, how many cycles can you run? Whole year, how many cycles can you run? 2.48. That means for one cycle, how much money you need to maintain. 325 lakh is the expense for the whole year. And in the whole year, how many operating cycles can you run? 2.48. That means to run one cycle, how much money you need? 130? 131 lakhs. So on an average, you need to maintain how much money or how much working capital? 131 lakhs. Basically, your current asset should exceed current liability to what extent? 131 lakhs. If you don't have this much money, you need to take a loan from bank. So to manage your day-to-day business. That's all. This is one way of finding the working capital. There are multiple ways. This is one approach. Okay, now people. Those are the three requirements of this question. This also has come for 3 to 4 marks previously. First concept is this calculation of operating cycle, and from operating cycle calculating the working capital amount. Okay. We'll move on to the next concept then if you're clear. What is the next one? Here. All right. Next, we will move on to the next type of problem called estimation of working capital. This is one of the important concept from this particular questions. Usually around anywhere between 6 to 10 marks, examiner prefers to ask this kind of problem. Here we have to estimate the working capital. Estimation of working capital means how do you get working capital? Current assets minus current liability. Here what we have to do is each component of current assets we have to estimate. Each component of current liability we need to estimate. This will not be given to us. Every component of current asset, every component of current liability we need to estimate. Using that we will be able to estimate what? Working capital. That was a problem. Okay, sir. Fine. So we'll do, we have done, in fact, if you remember our regular class, we have at least done 8 to 9 questions on this alone. Okay, but here we'll not have so much time. I'll pick like 2-3 questions and we'll try to cover them. Okay, so now we'll go into that. I've written some points. First, I'll take you through that here. For if you remember in all our regular class, almost every problem we used to do it in this working note, in this fashion. Same format we used to maintain. It's not mandatory, but it's something which we followed for majority of our problems. So I'll be revising using the same. Okay, in estimation of working capital wala problems, first working note is to find out WIP, closing stock of WIP. Okay, how do you get this WIP? First I'll call it out. First you will take annual raw material consumed divided by either 365, 55 or 52 or 12 into work in progress holding period multiplied by DOC. Okay, I think you're looking at me differently. So probably let's go ahead here and finish first. Let's not go further. So work in progress means what? First of all, WIP means what? You have started the production, but have you completed or not yet? Not yet. So you have put in the raw material, you have inserted the raw material and you have started your production process, but is it complete or not yet? Not yet. That means for WIP, you will incur raw material cost also. You'll have to incur production cost also. Production cost could be labor, overheads, whatever. If you completed the production, then it is not WIP, it will become finished goods. So raw material is probably already inserted, already all comfortable. Matlab it's 100% done, but relating to the labor, maybe you need 10 hours of labor time. To produce the finished goods, you need how much labor time? 10 hours. Let's say only 2 hours of labor time is already only completed. Like to complete this marathon, I need another 4 hours. Have we completed or not yet? Not yet. So that means we are in which stage now? WIP. After 4 hours, we will become finished goods. At least I assume that, I presume that you will become finished goods. Yeah. So are we okay with this? So that is what is your WIP. For your WIP, you will incur raw material cost also. You will incur the production cost. This production cost, we call it as conversion cost. We call it as conversion cost. What they will do in the problem is, they will give you annual raw material consumed. They will give you raw material consumed for the whole year. Let us say raw material consumed for the whole year is 10 lakh. Let's assume. I mean, this 10 lakh is for how many days? If it is annual raw material consumed, means this 10 lakh is for whole year. That means how many days? 365 days. You will run your WIP process period will run for whole year. Huh? No. Let us say they tell in the problem, WIP ka process time is 40 days. It takes about how many days to process your raw material into finished goods? 40 days. So for 365 days, if this is the value, means for 40 days, how much is the value? Understood, everybody? Calculate X here. How do you get X? How do you get X? Sir, we never get our X's, sir. Okay, that's a different issue. In the subject is context of questions. Tell me, how do you get X? 10 lakh into 40 divided by 365. Now tell me the formula. What is this? What is this 10 lakh? Tell me. What is this 10 lakh? Annual raw material consumed. Now look at the formula. Annual raw material consumed. Divided by what? 365. Multiplied by what? What is this 40? Work in progress ka process period. Yes, so that's what I'm calling it as WIP holding period. Got it, everybody? Multiplied by DOC. DOC as in degree of completion. WIP means is it 100% complete or not fully? Sir, if it is 100% complete, is it WIP or finished goods? So you'll have to also multiply the DOC over here. Okay. Usually for raw material, DOC is 100%. Because before you start the production, raw material fully you need to put in. Then only you'll start the production, right? So normally we assume DOC for raw material is how much? 100%. If it is given in the problem that it is 50%, we will take it as 50%. If nothing is mentioned about degree of completion for material, we always take it as what? 100%. Are we good with this formula now? Everybody good? So now with respect to WIP, you'll only incur material cost or even other cost. You'll incur labor and overhead also. So same way you have to construct for that also. Now you construct, let's see. This is for material. Let's say for labor, construct, let's see. What you'll do? Here it was annual raw material consumed. So next will be what? Annual labor cost divided by 365. Because this annual means it is for 365 days. Will you do the process for 365 days or lesser days? So again tell me, reconstruct that formula. What will be for labor? Annual labor cost divided by 365 multiplied by WIP holding period multiplied by DOC. Okay, Sarji. Some problems they will give you the DOC of labor. If they give, take. If they don't give, for labor and overhead, which we call it as conversion cost. For every problem, if DOC is missing for conversion cost, we take it to be 50%. Just an assumption, normal assumption we make. Because if it is 100%, then it is not a WIP, it is finished goods. So if conversion cost ka DOC, if it is not given to you in the problem, we always take it as 50%. That's what I've written over here. For raw material DOC, we assume it to be 100. For others as in conversion cost, we assume it to be 50%. We do this only if what? Question is silent. If question gives specific DOC, we take that and do it. Okay, na Sarji? Now you tell me, to process the finished goods, we'll only incur material cost, labor cost, or even other cost. That we call it as overheads. You can take. Give me the formula for that. Let's see then. For overheads, what will be the formula? Tell me. Annual overhead cost divided by 365 multiplied by WIP holding period multiplied by DOC. Total this, you will get the closing stock of WIP. This is a first working note. We'll do this in a couple of problems, but are we okay so far? Everybody? Okay. Working note number 2 is to find out the debtor. Debtor balance. For this, we take the little bit of cost sheet help. We don't have to do cost sheet in proper format, but more or less the format will sync up with cost sheet. Okay, first, if you do annual raw material, so for always production, will you take raw material purchased or raw material consumed? Raw material consumed. So start with annual raw material consumed. Then what? To produce the goods, what and all direct cost you will incur? Material consumed, then wages and all your production overheads could be variable, fixed, whatever. There will be some overheads. So add the material consumed, the labors and overheads. You will get what? Adding this, we call it as, I don't want prime cost, gain cost and all, we can cut that, right? So adding this, we'll get the factory cost. From factory cost, what do? Add opening stock of WIP, reduce closing stock of WIP, you will get what? Cost of production. From cost of production, add admin expense, add opening stock of finished goods, reduce closing stock of finished goods. You will get COGS, cost of the goods sold. From COGS, if you add the selling expense, you will get the cost of sales. This is a cost sheet format you used to use. No? A little more detailed with prime cost and all you used to prepare. Fine, Aji. So same format, we're going to use it here also. Till here, any problem, anybody? Pure cost sheet one. Okay, Ji. And now, first take, you tell me, for a debtor, what do we need? To find out debtor, which number do we need? Sales. Specifically which sale? Credit sales. But hang on. What are we trying to do here? What problem is this? Estimation of working capital. Sir, previously only we calculated working capital or operating cycle. If operating cycle is 90 days, I asked you this statement. What did you say? If operating cycle is 90 days, what does that mean? If working capital cycle or operating cycle, if it is 90 days, means what is the meaning of that? Your funds are getting blocked for 90 days. Yes. If your OC is 90 days, means today if you invest the money, you will get back the money only after 90 days. Agreed? Now, yes, debtor is definitely linked with what? Credit sales. Debtor is definitely linked with the credit sale. But money will get blocked to the extent of sale value or cost value. I'm talking about money invested. Money invested will get blocked to the extent of sale value or cost value. Sir, if you want to sell the product, first we need to buy. If you want to sell the product, first we need to buy. You will purchase it at selling price or cost price. That means before selling, if you buy, you will buy it at what price? Cost price. Suppose you bought it at 90. You bought it at 90 and you're selling it for 120. Okay. So how much you have to invest? In order to sell the product to your debtor, first you have to invest how much money? 90. So how much money got blocked? 90. Later from your debtor, you will recover how much? 120. But how much of your money got blocked? 90. So hence debtor here, no, we will not calculate using sales. We calculate using cost of sales. Because sales will include profit, but our money got blocked to the extent of cost. That's the reason we don't take sale value to find out debtors. What do we use? Cost. And that to what? Which cost of sale? Total cost of sale or cost of credit sale? So by using cost sheet format, you will get annual cost of sale. But we don't want annual cost of sale. We want annual cost of credit sale. You have to use this as a basis to find out debtors. Done now? Everybody good? Okay. Now how do we use this? If you want, I'll just give you some numbers. Let us say this is 365 lakhs. How much? You calculated annual cash cost of credit sale. It comes to how much number? 365 lakh. I've assumed. Okay, Ji. I mean this 3, or maybe I'll take a smaller number. Okay. 100 lakhs I will take, or 10 lakhs I will take. Okay. So annual cash cost of credit sale is how much? 10 lakh. This 10 lakh is a value for one day or whole year? Whole year means how many days? So 10 lakh is a value for 365 days. Will any business give 365 days credit to their debtors or lesser? Let's say debtor ka credit period is 40 days. Debtor ka credit period is 40 days. For 365 days, if the value is 10 lakh, means for 40 days credit, how much is the value? Find out this for me. How do you get X? Now first tell me in formula, how do you get X? You'll do what? 10 lakh into 40 divided by 365. How much do you get this? 1 lakh 10,000? 1 lakh 9,589. Okay, Naji. This is how you calculate what? What is this X? So, debtors. So tell me this in formula. Don't look at the board. You tell me the formula now here. This ka formula you tell me. What is this 10 lakh? Annual cost of sale or cost of credit sale? Annual cost of credit sales divided by 365 multiplied by 40. What is this 40? Debtors ka collection. So that's all. That's how you get the debtor balance. Done, Naji? And again, why don't we use sales for debtors? Because we are estimating working capital. Working capital means funds getting blocked. Funds will get blocked to the extent of sale value or cost extent. Because before we sell the product, first we need to invest money and buy. So our money gets blocked to the extent of cost. Hence we use cost of credit sale to estimate the debtor over here. All these are proportionate. Comfortable, Aji? So that's all is about this. That's what I've written over here. Funds gets blocked to the extent of cost. Hence cost of credit sale is used to find out the value of debtor. Give you a minute. Okay, once recap this debtor ka statement for me. How do we get this? Direct material consumed, all the labors and other overhead costs. By adding all this, you're going to get the factory cost. From factory cost, you add opening stock of WIP and closing stock of WIP, you're going to get cost of production. To the cost of production, add administrative expense, add opening stock of finished goods, deduct closing stock of finished goods, you're going to get COGS. To COGS, if you add selling expense, you'll get the cost of sales. But we need cost of sale or cost of credit sales. Sometimes they'll mention in the problem. Only 80% of sale is on a credit basis. So if this value is, let's say 20 lakh, how do you get credit sale then? 20 lakh ka 80%, which will be 16 lakh. If nothing is mentioned, total cost of sale only will assume it as total cash cost of credit sale also. Now we use credit annual cash cost of credit sale as a basis, as a proportionate number to find what? Debtors. Using this particular formula. Done, Asarji? These two are then. Next we put up normally, if you remember, next we used to put up working note for your creditors. For creditors, you tell me what you have to use some number as a base and proportionate. For creditor, will you take raw material consumed or raw material purchased? Raw material purchased. But in the problem, they would be giving raw material consumed. How do you get raw material consumed? Tell me. How do you calculate raw material consumed? Opening stock plus purchases minus closing stock will get you raw material consumed. Now, if I give you raw material consumed, if I give you opening stock, if I give you closing stock, can't we find out purchases? How do you find purchases? Tell me. Reverse this equation. You take raw material consumed, add closing stock, deduct opening stock. That's what we've done here. For creditor, we need annual raw material purchased, but they would be giving raw material consumed. Take the annual raw material consumed, to that add closing stock of raw material, reduce opening stock of raw material. You will get annual raw material purchased. Okay, na, sir? Sir, how do we find closing stock of raw materials? Very simple. Let's say raw material consumed is 20 lakh. Let's say raw material consumed is 20 lakh. This will be given to you. For simplicity, I've assumed this to be 20 lakh. What is this? Read out that line once again for me. What is this? It is annual raw material consumed. I mean, this particular 20 lakh what I've assumed is for 1 day or 365 days. This is your annual raw material consumed, which is for 365 days. Will you maintain 365 days ka raw material as closing stock? No. You may maintain it for. Let's say question says raw material holding period is, let's say, 40 days. Raw material ka holding period is how much? 40 days. So for 365 days, if the value is 20 lakh, means for 40, this will be given to us in the problem. Huh? Raw material holding period, WIP holding period, finished goods holding period, all this will be given to us in the problem. So for 40 days, how much is the value? Calculate this. How do you get? If you want to tell me as formula, basically, how do you calculate this? It is nothing but 20 lakh into 40 divided by 365. By doing this, what are you going to get? Closing stock of raw material. Tell me this in formula, let's see. How do you get closing stock of raw material? 20 lakh. What is this raw material? 20 lakh. You take your annual raw material consumed. This is on an annual basis, meaning this is on what platform? 365 days. Will you maintain whole year ka stock as closing stock of raw material or lesser? So multiplied by what? Raw material ka holding period. This will be provided in the problem. Okay. Good. Sometimes in the question, they will give you the data in days. If they give you the data in days, your denominator will be what? 365. If they give you the same data in weeks, then instead of 365, you will divide by 52, because in a year there are 52 weeks. Suppose they give you the data in months, then you will divide by 12. So that will change problem to problem. So check how they have given the data, accordingly proportionate. If they have given the data in days, use 365. Weeks means use 52. Months means use 12. Done, sir? So by doing this, first what are you going to get? If you take annual raw material consumed, add closing stock, deduct opening stock, what are you going to get? Raw material purchased. Raw material purchased. Let's say this value is 35 lakhs. This is 35 lakhs. This again, what is this 35 lakh? Full form, you tell me. Annual raw material purchase. I mean, this 35 lakh is a value for 1 day or whole year?
Whole year.
How many days then? 365 days. Will your creditor give you whole year ka credit or lesser credit? Suppose creditor gives you only 15 days credit. So for 365 days, if the value is 35 lakh, means for 15 days, how much is the value? This and all will be given. Huh? How many days creditor gives will be mentioned in the problem. So proportionate, how much are you going to get?
1 lakh.
So basically X is equal to 35 lakhs into 15 divided by 365. Okay, I'm more interested in the formula. Tell me the formula here. Construct this formula for me. What is this 35 lakh? Raw material consumed or raw material purchased? Annual raw material purchased divided by 365 multiplied by 15. What is this 15? Creditors ka credit period. By doing that, you will be able to find creditors ka value. Okay, Naji? Comfortable, everybody? Sir, how do we find opening stock, sir? Because this is not related to current year. This is related to last year. All this data is for what? Current year. So you can find closing stock. How do you find opening stock, sir? Sir, in some problem, they will tell it's a new company. They'll tell it's a new company or a new project. If you are starting a project newly in the current year or the company only started new, it means opening stock will always be zero. Okay. If they say it's an existing company or if they don't comment anything, then we assume that if closing stock of raw material is 20 lakh means opening stock also will be 20 lakh, because we assume that every year ka production is this assumption we make it over here. So if it's an existing company, whatever is closing stock, same thing we make it as opening stock. But if it's a new project or a new company, then opening stock of raw material, work in progress, finished goods, every opening stock will be zero. So whenever in the problem, before you start working capital problems, always check whether it's a existing company or a new company and then proceed. All this will come in problems, just say. Okay, na Sarji? So far, what and all have we have estimated? We have estimated closing stock of raw material. We have estimated closing stock of WIP. Closing stock of finished goods also we can estimate in a bit detail. Then we have found out debtors and credit. Then there will be some prepaid expenses and outstanding expense that will vary from problem to problem. Consider that. These are your current assets. These are your current liability. From current assets minus current liability, if you do, automatically you will get what? Net working capital. Okay, people, there will also be something called safety margin. I'll talk about that in a bit in the problems. Leave this for the time being. Okay, sir. So this problems will be a little lengthy because we have to estimate each components, but they're pretty easy. There are multiple ways in which we proportion it. So I've taken 2-3 problems. So you'll get the idea over there. Wait, or can we dive into the questions? Questions? Okay, so let's start the questions then. Just 1 second. Okay. Study material question. 1 or 2 study material question I've taken. 1 or 2 RTP questions I've taken. Look at this. This is a study mat question. On 1st January, Managing Director of Naureen Limited wishes to know the amount of working capital. So we need to estimate the working capital. That's what they said here. Prepare working capital requirement ka forecast. Production during the last year was how much? 60,000. It is planned that this level of activity would be maintained during the present year also. So current year also we are expecting to produce how many units? 60,000 units. The expected ratio of the cost to selling prices as follows. So raw material is how much? 60%. That means indirectly they're telling what? Raw material constitutes 60% of the selling price, because this is a ratio of the cost to the selling price. So raw material constitutes 60% of the selling price. Wages constitutes 10% of selling price. Overhead constitutes 20. So 60 plus 10 plus 20 is 90. Na? Right? Maybe. Then balance 10% is your probably profit. Fine. Raw material are expected to remain in store on an average how many months? 2 months. So here the data is given in days or months. So everything will proportionate in months. Okay. Each unit is expected to be in process. In process stock only, what do we call it as? WIP. WIP ka process period is how much? 1 month. Okay. Raw material being fed into the pipeline immediately. So whatever raw material you require, immediately you will give. That means what is a DOC for raw material? 100%. Immediately fed into the pipeline means indirectly full raw material we've inserted right now. So DOC is 100. But what about labor and overhead cost? They accrued evenly during the year, but DOC given or not given? Can we take 100%? Sir, material also 100% complete. Labor and overhead also 100% complete means, is it WIP or finished goods? So, this labor and overhead ka DOC cost, if it is not mentioned, if DOC is not mentioned, we'll take it as what? 50%. Okay, Ji. Finished goods will stay in the warehouse for how many months? 3 months we store the finished goods ka closing stock on an average. That's what they've given. Credit allowed by creditor. Creditor gives us how much credit period? 2 months. Debtor, we give how many months credit? 3 months. Selling price per unit is 5. Okay, that means if once you know selling price, you can find raw material per unit, wages and overhead. Agreed? Because raw material is 60% of selling price. Wages is 10%. Overhead is 20. Find out that immediately. Let's see. Selling price is 5 means raw material will be 60% of that. 5 ka 60% will be 3. Wages will be 10% of the selling price. 5 ka 10% is 0.5. Overhead is 20% of selling price. 5 ka 20% is 1. Agreed, Aji? This is available. Done. No. Next, what they give? Okay, read this line. No. Wages and overheads are paid on first of each month for the previous month. Last month ka wages you pay last month only or next month? That means indirectly they're telling what? 1 month wages is outstanding. Because March month ka wages we pay it on 1st April. So on 31st March it is still outstanding. This is only for wages or also even for overheads. 1 month of these expenditure are outstanding. Outstanding expense is a current liability. No? So this should also be considered for working capital estimate problem. Company keeps how much cash balance? 20,000. Cash we don't have to estimate. They've only given the cash balance to be 20,000. Fine, sir. We need to calculate, estimate the working capital. Okay, walk me through the working notes now. First working note is what? Work in progress. Here WIP is there. Huh? Yeah, it is there. Some problem it will not be there. In that problem, working note number 1 you can cut off. Here it is there. Okay, guide me. WIP means we need raw material also, we need wage also, we need overhead also. But 100% of this is required or lesser? If 100% of all this is incurred means it is not WIP, it will become finished goods. Okay, first, how much is the raw material? Take your calculator. How many units have you produced in the current year? 60,000. What is the raw material cost per unit? 3. Multiply. What is your annual raw material consumed? For 1 unit, 3. For 60,000 units, how much? 1,80,000. Correct. That is what? 1,80,000 is for 1 day or whole year? Here data is given in days or months. Whole year means how many months? 12 months. Yes, sir. Will your process time, is your WIP ka process period a whole year or 1 month? They only told in the problem, right? WIP ka process period is 1 month. Agreed, Aji? Multiplied by DOC. For raw material, what is the DOC percentage? If they don't give, we'll take it as what? 100%. Calculate this for me. 1,80,000. 1,80,000 is a raw material consumed. How did I get 180 people? 60,000 units. And what is the raw material cost per unit? 3 rupees. So this is your annual raw material consumed. Annual raw material consumed means this is on what platform? Annual platform, which is how many months? 12 months. Is your process time, is your WIP ka process time what? 12 months or 1 month?
1 month.
So for 1 month, how much? Clear? But this is towards what? WIP related to the raw material. So raw material related WIP, what is the DOC we assume? 100% if data is not available. So calculate this for me. 5? 1 5. So 15,000 is the value. Agreed? So WIP means you'll only incur raw material cost or even wages and overhead cost. So let's calculate wages and overhead also similarly. Okay, how many units have you produced? Take your calculator. What is the wages cost per unit? For 1 unit, 0.5. For 60,000 units, how much? 30,000. That 30,000 is what? This is 60,000 is a production for whole year. No? This 60,000 is a production for whole year means this 30,000 is a cost for whole year. Whole year means how many months? 12 months. But is your WIP ka process period whole year or 1 month? 1 month. Multiplied by DOC. If DOC of conversion cost like labor on overhead not given means we'll take it as what? 50%. So do this. 1,250. That is towards what? Labor. Okay. That's it, or even overhead is also there. Overhead. Come back to the question. How many units? 60,000 units. What is the overhead cost per unit? 1 rupee. So multiply. Whole year ka production is 60,000 and overhead cost is 1 per unit. Means what is the overheads for the whole year? How much? 60,000 only. Yeah. 60,000 is the data for 1 day or whole year. How many months? 60,000 is on 12 month ka platform, but your WIP process period is only 1 month. Multiplied by DOC. What is the DOC percentage we take? 50%. Multiply, how much is that?
2,500.
2,500. Anything else is there or that's all? Add this, you will get the closing stock of WIP. How much is that? Adding all this, the number is 18,000. One problem is done. Closing stock of WIP. Clear? Next, working note number 2 is for your data. That's we use a cost sheet format. Tell me one by one, what are those? Annual raw material consumed. How much production have you made in the year? 60,000. What is the raw material cost per unit? 3 rupees. So multiply 60,000 into 3. How much? 1,80,000. Done now. Then labor cost. What is the labor cost per unit? Previously only we said 0.5. For 60,000 units, how much is the value? 30,000. So that is your total wages. What about overhead cost? Overhead cost per unit is 1 rupee and 60,000 units you produce for whole year. So total is how much? 3,000. Adding all this, you will get factory cost. Done, Aji? And then what? Add opening stock of WIP. 1 minute. Go back to the problem. Have they told anywhere it's a new company? No, they have not told anything. I mean, this is which company? For existing company, what is the assumption we make? Closing stock, opening stock are same. So how much is the closing stock of WIP you got? 18,750. Same thing, you'll also take it as what? Opening stock. Done, Aji? So from your factory cost, if you add opening stock of WIP, reduce closing stock of WIP, you will get the cost of production, which is this. Then add admin expense, not there. Then opening stock of finished goods, reduce closing stock of finished goods. 1 minute, hang on. Sir, this cost of production, why will you incur? This production cost you will incur to what? To produce raw material, to produce finished goods, or to produce raw material work in progress or finished goods? Cost of production. We will incur cost of production to produce what goods? Finished goods. Yes or no? So 2,60,000 is the cost of production for 1 day or whole year? So 2,70,000 is the data for 12 months. Correct? Huh? But whole year ka production, whatever goods you produced whole year, entire thing you will maintain as closing stock of finished goods. Huh? So check, they have told finished goods will remain in inventory for on an average how much? Somewhere they told. Finished goods will stay in warehouse for an average how many months? 3 months. For 3 months, how much is the stock? So basically 2,70,000. Where is that? Here. 2,70,000 is the cost of production for the whole year. Whole year you have produced inventory worth 2,70,000. So 270 is for 12 months. But on an average, you maintain closing stock of finished goods only for 3 months. For 3 months, how much is the stock? Proportionate? 67. Okay, Naji? Alright. Since it's an existing company, opening stock, closing stock, we make it same. So your COGS, cost of goods sold, also will be 270. In the current problem, have they given any selling expense? No. If they had given, we would have added. So by doing this, what are we going to get? Annual cost of sales. What is annual cost of sale? 2,70,000. But we want annual cost of sale or cost of credit sales? In this problem, have they told 90% of the sales will make it on credit, 70% will make on credit? Any info or no info? No information means what? We assume that all the sales are happened on a credit basis only. So if annual cost of sale is 70, means annual cash cost of credit sale is also 2,70,000 is our assumption. Now using this, we can find what, people? You can find data. Tell me, how do you do it? This 2,70,000 is the data for 1 day or whole year? Whole year means how many months? 12 months. But do you give 12 months credit to your debtor, or how many months credit do you give it to your debtor? On an average, we give how much credit to our debtor? 3 months. So use that as a proportion. Where is it? Here. Annual cash cost of credit sale is 270. 270 is the data for how many months? 12 months. For 3 months, what is this 3 months? Debtors ka collection period or credit period. So proportionate. 270 is the data for 12 months, means for 3 months, how much is the value? 67. That is your debtors. As in your working note number 2. Any problem so far? 1 over, 2 over. What is the third one? Creditor. For creditor, sir, here we have what? What is this? Raw material consumed. But for creditor, we need raw material consumed or raw material purchased. So from consumed, how do you derive purchase? Just now we proved. Or how do you get that? Take raw material consumed, add closing stock of raw material, reduce opening stock of raw material. From annual raw material consumed, if you add closing stock, reduce opening stock, you will get raw material purchased. First, what is annual raw material consumed? 1,80,000. Start with that. Have they given closing stock of raw material anywhere in the problem? Given, or we have to find out? We have to find out. Same thing. This 1,80,000 is the raw material you have consumed for 1 day or whole year? So 1,80,000 is the data for whole year. But whole year ka raw material consumed, will you maintain it as closing stock of raw material? On an average, check how many days ka stock, closing stock of raw material you maintain. Raw material are expected to remain in store for an average 2 months. So this is the basis. 1,80,000 is a data for 12 months. But we maintain closing stock of raw material on an average for 2 months. For 2 months, how much is the stock? By proportionating, we'll get 30,000. Easy. Since it's an existing company, whatever is closing stock, same thing becomes opening stock. So do this plus minus, you will get annual raw material purchased. How much is that? 1,80,000. Sir, since the value is same, some students will say, we'll cut off this. No, you can. Study material uses that. But if you cut it off, then all this data, no, you will have to show it in working capital estimate wala problem. Because in working capital estimate, we need to show closing stock of raw material, closing stock of WIP, closing stock of finished goods. Whatever you want to calculate, you can calculate here. That is another form of presentation. It's acceptable. But just saying, but I don't want to change the format now. All our problem, we have done it in this format. So I'll continue with that. But that approach is also fine. Okay, now come back. What is the annual purchase cost of raw material? 1,80,000. This 180 is for 1 day or whole year? So 1,80,000 is for 12 months. Do we get 12 months credit from our creditors or how many months credit? As per the problem, 2 months. For 2 months, how much is the data? 30,000. Are we good, sir? Now take all this data, put it up in a statement. That statement only we call it as what? Estimation of working capital. All the current asset component you list out one by one. All the current liability component list out one by one. So far, what and all have you found? Closing stock of raw material. Start with that. How much is closing stock of raw material? 30,000. Do you know closing stock of WIP? Yeah, it is there in working note number 1. How much is it? 18,750. Do you know closing stock of finished goods? Yeah, it came from note number 2. Check. Closing stock of finished goods is how much? 67,500. Okay. 3 stocks over. Then debtor. Debtor also came from working note number 2. What is your debtor value? 67,500. Okay. Then cash. Cash, I think they only given the problem. How much is the cash balance we have to maintain? They told 20,000. Cash usually in these problems they will only mention. Don't forget prepaid expense and outstanding expense. Josh, we tend to forget that. But in this problem, is there any prepaid expense or outstanding expense? Prepaid expense, if it is there, means that also will come under current asset. In this problem, not there. So add all the current assets. Only current assets, if you add, that number only we call it as gross working capital. How much is gross working capital? By adding current assets, you got 203,750. Any problem? Next is what? Current liability. One current liability ka estimate we have already done, which is what? Creditors. From working note number 3. Go back to working note number 3. What is creditor? 30,000. Take that. Another one is outstanding expenses. Here we have 2 expenses outstanding. Do you remember what are those? Yes, they only told in the problem, wages and overheads are paid first of every month for the previous month. Meaning previous month ka wages we settle in the next month. Previous month ka overhead cost we settle in the next month. That means 1 month ka wage cost and 1 month ka overhead cost we have not yet settled. It is outstanding. Whole year ka or 1 month ka? 1 month ka. Okay. Now go back to your working note number 2. What is your whole year ka wages cost? All this is what? Whole year ka, no? This is the cost of production and all for whole year. So what is your whole year ka labor cost? 30,000. 30,000 is a data for whole year as in 12 months. Entire 12 months salary, are you keep it outstanding or only 1 month? So for 30,000 is a data for 12 months means 1 month how much? How much is that? 2,500. That is your outstanding wages. That you can show it here. Okay, Naji? That's it, or even overhead is there. What is your whole year ka overhead cost? Sir, all this data in working note number 2 on an annual basis. It is there. So what is your annual overhead cost? 60,000. So 60,000 is the data for how many months? 12 months overhead. Are you keeping it outstanding or 1 month? Or 1 month how much? 5,000. That's what I've shown it here and the value is 5,000. Clear, Raji? So what is the total current liability? Only these are there. If you added total current liability is 37,500. How do you get net working capital? From current assets, if you from total current asset, if you reduce total current liability, that number only becomes your working capital. Okay, Naji? So this minus this will give you 166,250. Okay, Ji? Now all these are pakka number or our estimates. So sometime they will tell in the problem after your estimate. add safety margin 5%, 10%, 20% like this. Because these are estimates. No, our estimates can go wrong. That only here is your safety margin. In some problem it will be there, some problem not there. Here we read the problem. Did we find any safety margin? No. If it is there, means add. So how much to add, that they will tell in the problem. 5%, 10%, 15%, 20%, whatever. Whatever number you get, to that you add the percentage. Then finally you will get the net working capital. That's all is a final solution. Okay, Nasarji. There is also one pointer about safety margin. Maybe I'll discuss it in the next problem. This first basic problem. So are we okay? I've written it here. Leave that. I'll discuss this in the next section when we do the next problem. Can we get to the next type of? I like to do 1 or 2 more questions in working capital. No reservations here. No? Overall, we have a fair idea about this. Those of you who are learning for the first time as well here. Okay, done. Next to 1 minute. Let me find that problem. This one. There's also a study material question. Check this. PQ Limited company newly commencing business. So this itself is giveaway. What is that? If it's a new company, so what does it take away? No opening stock of raw material, WIP as well as finished goods. Okay. In this problem, all the opening stock will be 0 because it's a new business. Fine. Projected P&L they've given, sales they've given, COGS they've given. Sales minus COGS will give you GP. From GP they've reduced admin expense, they've reduced selling expense, and they've got profit. These two addition is 27. They've reduced and got profit before tax, reduced tax, and they've got profit after tax. P&L they only prepared. Great. COGS has been arrived as follows. So material used, wages, and depreciation. Okay, adding all this, how much is COGS? 1,70,000. Okay, but 1 second, hang on. It's what sort of a problem? Working capital estimate. Now, use your common sense. Working capital estimate we are doing to know how much funds are getting blocked. Depreciation is a cash expense or non-cash expense. So all this should be considered or ignored. Ideally, we should ignore because we prepare working capital estimate on what basis? Cash cost basis. So question will specify, if they say working capital estimate, you prepare on a cash cost basis. That means all this non-cash expense like depreciation we will consider or ignore. It may be production expenditure only, but we will still ignore because there is no cash outlay. Suppose they tell in the problem, prepare working capital on a total cost basis. Prepare it on a total cost basis. Then you will ignore depreciation or consider. Fine. So there are 2 ways to estimate working capital wala problem. One is on a cash cost basis, another one on a total cost basis. That's the reason here also you will see, if you remember, you will see the reference over here. See here they mention annual cash cost of credit sales. So usually by default working capital estimate we follow under what basis? Cash cost basis. By default, we do it under cash cost basis, but in some problem based on requirement, we may also do it on a total cost basis. Basically, in cash cost basis, all non-cash expenditures like depreciation, amortization will be ignored. On total cost basis, they will also be considered. If they don't mention, always my preference is do it on a cash cost basis. Because working capital ka estimate ka overall fund is to know how much funds are getting blocked. You will not invest any money for depreciation. Hence, you can ignore that. Done. Next, stock of finished goods, they have only given. How much is that? 17,000. And they told what here? 10% of the goods produced not yet sold. Now, goods produced which are not yet sold only we call it as what? Closing stock. Okay. So, basically they are saying how much ever you produce in the current year, 10% of that we maintain it as closing stock of finished goods. Me telling or question? Question mentioned this 10%. So 10% of current year ka production cost is closing stock of the finished goods in not in every problem, in this problem, because there is a reference there. Okay, people. That is one. Next, the figures given above. Here, whatever data has been given, no, it relates only to the finished goods, not to WIP. So that means this data is accurate or we have to include WIP. For WIP also we would have spent some cost. No? So this WIP ka data they have not included there. Okay. How much is WIP? Check. Goods equal to 15% of the year's production. In terms of physical units, will be in process. Will be in process means what? Will be in process means it is raw material, work in progress, or finished goods. What is it? In process always means WIP. How much? Goods equal to 15% of the production. Okay. Requiring full material. Requiring full material means degree of completion for raw material is 100%. But only 40% towards others. So your conversion cost ka DOC, they have given it to be 40%. Yes, sir ji. If it was missing, we would have taken it as what? 50%. Here it is missing or given? Given. So we will take the DOC of raw material is 100%. DOC of your conversion cost like your labor and other cost is 40%. Specified. Company believes keeping material. Material always means what here? Raw material. They will keep raw material equal to how much stock? How much ever you are consuming in the whole year, 2 months of the consumption we will maintain as closing stock of raw material given. All expense, all expense will be paid 1 month in delay, lag. Lag means delay. Lag in a way becomes your outstanding. Here it is a lag or advance. Means this is outstanding expense or prepaid expense. Every expense you pay 1 month in advance. So every year we have to calculate many prepaid expenses over here. Done. Supplier of material. Supplier of material is our creditors. They will extend how much credit? 1-half a month means there is nothing but your 1.5 months credit we get from our creditor. Sales will be 20% cash, rest will be 80 months credit. That means in this problem, cash sale is 20% means credit sale will be 80%. And how many months credit will we give for credit sale? 2 months. This is one. 70% of income tax will be paid in advance. Go back to the problem. What was our tax? We saw somewhere here. What is the tax amount? 10,000. Out of the 10,000 full you will pay or 70%? 70% you will pay as an advance. On what basis? Monthly, quarterly, yearly, what are you paying? You will pay that in advance on a quarterly installment. So you will pay this is basically an advance tax paid on a quarterly basis. Okay, 1 second. So what is your tax estimated? 10,000. How much did you pay as advance? 70%. That means what about the balance 30%? Paid or not yet paid? Not yet paid means it's a liability. It will come under current liability. Understood? That's a hidden adjustment over here. Which is what? 10,000 ka 30%. Why 30%? 70% you're paying in advance means balance 30% paid or not paid?
Not paid.
Not paid. So there will that come under? Under current liability as an outstanding provision for tax. Okay. Company wishes to keep 8,000 in cash. Cash balance they only given. 10% has to be added to the estimated number for unforeseen contingency. What is this? Safety margin. Whatever working capital, net working capital figure you find out, to that you have to add 10% for safety purpose. So can we work out this problem? This is another type of question. So is WIP not there in this problem or there? There. Okay. But hang on. In the last problem, they gave WIP ka process period, which is how much month? 1 month. Here that they have given or not given? There are multiple ways to structure the question. One, they will give it in time. 1 month, 2 months. Another, they will give it in units. WIP ka units is 2,000, 3,000, like that they will give. Another one is this structuring. Here, time also not given. WIP ka units also not given. But they gave one data. What is that? Goods equal to 15% of the year's production will be in process. That means what? 15% of your production cost roughly is your WIP. Yes, sir. To produce the goods, what and all you have to incur? Should you have to incur material? Yes. Should you have to incur wages and manufacturing cost? Yes. So add this and multiply what? 15%. Automatically you will get what? WIP. Me telling or question told? In the question they did 15% of the year production will be in process. Okay, people. So take 84,000 ka 15%. How much is that? This is your material consumed, 84,000. 84,000 ka 15% is how much? Don't forget the DOC. For material, what is the DOC? 100%. So 84,000 is a total material cost. They said 15% of that relates to WIP. 15 is given in the question. Huh? Multiplied by this. What is this 100% people? Degree of completion. They told in the problem, material ka degree of completion is 100. Others ka degree of completion is 40%. So multiply this, you will get how much value? 12,600. Once more, got it. After material, what are the other production costs you are incurring? Wages and manufacturing expense, how much? 60 to 500. How much relates to WIP they told in this problem? 15%. 60 to 500 ka 15% is how much? 93 something. Now, if this is also 100% complete means, then it is a WIP or it will become finished goods. So always don't forget the DOC. What is the DOC for this wages and manufacturing expense? 40% given in the problem. So multiply 40%. 3,750. Add these two, you'll get the closing stock of WIP. How much is that? 16,350. Okay. Just 1 minute. And just check on YouTube. Battery low. Done. So the two words are WIP. Correct, people? And next, tell me what is the next aspect? What we need to prepare? Working note number 2. What is working? Same format. Working note number 2 is for data. So tell me the data ka funda. First, raw material consumed. So they have told how much is that? 84,000. Now don't take 84. Why? Sir, they told in the problem this data, no, what they have given. Here only they told the figure given above relates only to the finished goods, not work in progress. So is work in progress data included here or not included? Not included. That means what? For finished goods you have spent how much material? 84,000. For WIP how much material have you spent? 12,600. So totally how much material have you spent? 84 for finished goods, 12,600 for in process. So totally how much is your material consumed? 96,600. Any problem or got it? Right, no? For finished goods, totally you have incurred 84,000 material. But even for work in progress, we need material, no? So for work in progress, how much material cost have you spent? 12,600. So totally you have spent 96,600. Same goes for your wages and overhead also. What is the wages and overhead? Wages and manufacturing expenses 60 to 500. This is for WIP and finished goods or only finished goods? So 60 to 500 is only for finished goods. How much is for WIP? Here we got it. How much is that? 3757. Add that. How much is it? 66,250. There is also one more cost given in the problem called depreciation. Consider or ignore. Why are we ignoring? Because we are preparing this estimation of working capital on what basis? Cash cost basis. If it was a total cost basis, depreciation also will be considered. If they don't mention the basis, always my suggestion is to prepare on what basis? Cash cost basis itself. Okay, this we have done. Next, adding all this, you will get the factory cost. From factory cost, what do you do? Add opening stock of WIP, reduce closing stock of WIP. Since it's a new venture, new business, opening stock is 0. Closing stock of WIP, you got it here to be 16,350. Do this, you will get the cost of production. From cost of production, what do you do? Add the admin expense. Is admin expense available? Yeah, here somewhere we saw admin expense is how much? 14,000. Add the administrative expense. Then add opening stock of finished goods, reduce closing stock of finished goods. Since a new company, opening stock of finished goods is 0. Now closing stock of finished goods, you calculate, let's see. They told in the problem, one clue, I am showing you the clue again. 10% of whatever is your production cost is what? Closing stock of finished goods. Me telling or question told? So that means what is your cost of production? Check here. What is the cost of production? 146,500. Of this, how much percentage is closing stock of finished goods they told? 10%. So multiply 10% of this. In every problem, will you multiply 10% or only in this problem? This problem because they have given the question like that. Danaji, by doing this, what are you going to get? Cost of the goods sold. To this, you will add what? Selling expense. Is selling expense available in the problem? Yes. Selling expense is how much? 13,000. By adding this, you will get annual cash cost of sales. We want annual cash cost of sale or annual cash cost of credit sales. Here only cash sale is there, also credit sale. They told in the problem 20% of the sales we make it on a cash basis. That means 80% is on a credit. So first find out the annual cash cost of credit sale. Take this number and multiply 80%. Because 20% is cash sale means credit sale will be 80%. This ka 80% how much? 127,080. Why do we find this? For what joy are we finding this? For debtor. Find out the debtor for me. How do you find debtor? This is annual cash cost of credit sale. So that means this is for 1 day or whole year. Here debtor ka credit period and all, have they given in days or months? Check. Debtor ka credit period and all, how have they given? Somewhere we saw, no? Where is that? Debtors we give how many months credit? 2 months. Here, no? 1. Here, no? All expense will be paid 1 month in advance. So this is your prepaid expense. Creditor give how many months credit? 1.5. Sales will be 20% cash and the rest at 2 months credit. So credit sales we are giving how many months credit? 2 months credit. Okay, come back to your annual cash cost of credit sale. 1,27,080 is a number for whole year. Meaning this is for 12 months. How many months credit do we give to our debtors? 2 months. So this divided by 12 into 2 you do. How much is it? 21,180. That is your nothing but your debtors. Working note number 2 over. Okay. Working note number 3. What is working note number 3? Creditor. For creditor we need raw material consumed or raw material purchased. But what you have here is raw material consumed. From raw material consumed, how do you derive raw material purchased? Take raw material consumed, add closing stock of raw material, reduce opening stock of raw material. So same data. 96,600 is the raw material consumed. We got it from previous working note. Add closing stock of raw material. Now check. I think they have given some reference for raw material. What have they told? Somewhere we saw, no? Raw material ka. Company believes in keeping material equal to what? 2 months consumption in stock. On an average, 2 months ka total annual consumption, we will keep it as closing stock. Now, how much is your annual consumption? 96,600. So this 96,600 is for annual consumption, mean this is for how many months? 12 months. Will we keep 12 months ka consumption as stock or 2 months ka? For 2 months, how much is the consumption? That only we will maintain as stock as given in the problem. Okay, G. And since it's an existing business, opening stock is 0. That way you will get the annual raw material purchased. Using annual raw material purchased, we can find out creditors. Tell me, how do you get that? This 1,12,700 is the data for how many months? 12 months. From the creditor, do we get 12 months credit or 1.5 months? So 1,12,700 is for 12 months. For 1.5 months, how much is the number? 14088. That is your creditor balance. Okay. Now simply a statement called estimation of working capital. Closing stock of raw material, how much we got? 16,100. Closing stock of WIP, 16,350. Raw material is 16,100. WIP is 16,350. Closing stock of finished goods, how much did we get? 14,650. And then debtor, how much is the debtor we got? 21,180. Okay. Then cash, they only gave in the problem to be 8,000. Don't forget the prepaid expense. They told specific expense or they told all expense? All expense are prepaid 1 month. On a prepaid on a 1 month basis. I'll show you that later once again. All expense will be paid 1 month in advance. So all expenses one by one we have to go. You don't have to go to the table. You can come back to working note number 2. All the expenses there here. Material anyway is related to creditor. So material you cannot pay it in advance. For material you are getting 1.5 months credit. Why will we pay advance? So leave material. What about wages? 66,250 is a data for how many months? 12 months. 12 months expense will you pay in advance or only 1 month? So divided by 12 into 1. How much is that? So prepaid wages and manufacturing expenses how much? 552. Okay, G. Like this, calculate for each expense. What is the next expense? Admin expense. Calculate. 14,000 is for 12 months. For 1 month, how much? 14,000 divided by 12 into 1. 1167. Okay. Then selling expense. 13,000 is for 12 months. For 1 month, how much? 13,000 divided by 12 into 1. 1083. Correct? That's it, or even tax is also there. How much is the tax they have given in the problem here? Provision for tax they told. How much is provision for tax? 10,000. full you are paying in advance or 70%? First calculate that. 10,000 ka 70% you do. How much is that? 7,000. Okay, now the 7,000 is a data for how many months? 12 months. All this data is for the whole year, no? Because P&L you will prepare for the whole year. You got all this number 10,000 and all from current year ka P&L. So 7,000 is a data for 12 months. But are you paying 12 months in advance, or it's paid how much in advance on what basis? Monthly basis or quarterly basis? In a quarter, how many months are there? 3 months. So into 3 by 12. Okay, Ji? 7,000 is a data for 12 months. In a quarter, there are 3 months. Hence 3 by 12. How much is this? 1750 is it? So 1750 is the prepaid tax wala portion. Yes. What about balance 30%? 70% you are paying in advance, that too on a quarterly basis. Balance 30%, have they told it is settled or no reference? I mean, that is still outstanding. Even provision for taxation also will come in balance sheet current liability side, no? Right? How much you have paid as advance? 70%. So how much you have not yet paid? 30%. Calculate 10,000 ka 30%. How much is that? So that should come under the current liability side. Okay, Ji. So if you just check all the current assets ticked off, this is the total. One current liability, we already put a working note called creditor. How much is that? 14,088. Bring that in. Another one is your tax ka 30% not yet settled. Any other outstanding expenses there, or every expense on prepaid here? So there is no outstanding expense. So now calculate working capital for me. This minus these two you do. How much are you getting? This is your total current asset. These two are current liability. Net of these. What are you getting after netting off? 68,000. This is pakka number, or it's an estimate? Have they asked us to add any safety margin? They told in the problem how much safety margin we need to add. For some unforeseen contingency, we have to add how much? 10%. So whatever number we have found out, we have found the number 68,713. To that, add 10%. What is 68,713 ka 10%? 687. Add 1. Add that number, you will get the net working capital. Okay, Sarji. Now about safety margin also, we have seen one question in one of the RTP. I would not like to do another question for it. Here only I will discuss. What is that? In this problem, comfortable with everything? What is that adjustment relating to safety margin is? I've written here, but maybe once again, instead of following it up, I'll show it here only. Now, once again, guide me. You calculated safety margin. On what number? Can you tell me? You calculated 687 on what number? This number, right? So this number is including safety margin, this number, or excluding safety margin. This number is excluding safety margin. Now you add safety margin. So that means this number will be including safety margin. Do I agree with you? Agree with my statement? This number is what? This is excluding safety margin. And if you now add a safety margin, this final number, what you're going to get is including safety margin. Okay, Ji. In majority of the problem, they will simply say add safety margin 10%, 15% and all. That is a straightforward. But in some problem, they will say add safety margin 10% on including number. What they will say? Meaning, normally we calculate safety margin on what number? Excluding number. But the question says calculate safety margin on including number. Sir, do you know including number or you don't know? Sir, only after you know safety margin, you will get the including number. But the question says calculate safety margin on the including number. How do we do that? Understood? This is the issue in one of the problems. Okay. This is like your CA foundation we used to do manager commission after charging commission we used to do. No? There, if you remember, we used to do commission into rate divided by 100 plus rate we used to do. Here, what you have to do is, if the first of all, if the question says, I'll write that scenario. If question says safety margin to be calculated on what number? Excluded number or including number? They'll say this number. This word including will be mentioned. Exact sentence will keep changing from problem to problem. They will say calculate the safety margin on an including number. Something like that they will say. In that case, what you have to do is, if you want to calculate safety margin, first take working capital excluding safety margin. Take working capital excluding safety margin, you simply do rate divided by not 100 plus rate. You have to do 100 minus rate only. Okay, do this. How much are you going to do? What is the excluding safety margin wala number? Excluding safety margin, what is the number? 68,730 into rate. Rate could be 10%, whatever. I'm assuming 10%. Divided by 100 minus the rate. What is the rate to? 10. So calculate this. 68,713 into 10 divided by 90. How much is this? 7,635. This will be your safety margin in that particular case. Okay, na Sarji? I had explained to you the logic of this, why we do this. Now I'll not go into too much of all this stuff. Okay. This is good enough for our examination. That is what I've written here. If you just check this problem, I've written here. Including safety margin, excluding safety margin. But you got to know. If it is including safety margin, how do you calculate safety margin? Take excluding number and do 100 divided by 100 minus the rate. Whatever is the rate, you will get the value. That's what I've just proved it to you with some numbers. This I've not proved it. I've done it in the regular class. Now we'll leave that. But calculation is good. You don't see this in many problems. Okay, there's an exception. In one of the RTP, MTP, I'd seen this adjustment. So instead of doing that question, I thought I can explain it here. Okay, people. This is another type of working capital estimate problem. One more type is there that we will learn from this question. Okay. There are multiple types. I think I have time for only these. These are more popular. I'm covering the most. So we have at least another 4 to 5 type of questions in working capital. Okay. In fact, we have done 8-9 questions. Almost everyone were slightly different, right? But time late. Okay. So I'm just taking the most popular question which we often see in the examination and we are revising. Okay. As I said, no, FM is one topic where ICA is literally spoiled for choice. There is like more than 40-50 attempts ka paper. So you can't solve last 40 years ka paper will you solve 40, and that is not possible physically for us. So we'll focus more towards our popular question. In fact, in class also I had given you LDR question if you remember, right? Last day revision question. Focus more towards that. That should work. Yes, but there are some attempts where you will get some totally new questions. That is also possible, which kind of happened in the last attempt. So if it happened in the last attempt, good chances it will not happen in this attempt to attempt. Maybe this time costing will take a hit. You will probably curse your costing faculties this time. You know, last time probably you would have cursed me. Advanced accounting, I got a lot of credit. FM they said, sir, FMs are little tough, sir. Yeah, can happen, right? Even in those papers also somehow you can manage. And moreover, FM ka other part is what? The students forget that. If FM they make it tricky, means SM will be pretty straightforward. So you could have probably scored better in SM. SM I did check last time. They said it was manageable paper of SM. That's what I heard. I don't know. I don't teach SM, so I don't know. Right? So don't take a chance there. FM is a practical papers. Many people will ignore theory. They say like there's no fun in reading that. How much to mug up? We are forgetting. We all focus towards the number. But some attempts may number ka paper can go for a toss. They can bring totally go in the wala questions. So don't ignore. Focus also on the theory. In fact, I always used to say, if you want to become chartered accountants, especially CA examinations, you should pour more focus towards the theory papers. Law, auditing, SM, these are trump cards, in my view. Because in practical paper, ICA has a lot of choice of twisting. Right? But in some papers like SM and all, I don't see too much of twist. Of course, they can create some new cases. I'm not denying that. But that too much twist and turns that you see in practical paper, you may not see it in theory paper. And moreover, lengthy. If you don't want to make the paper tricky, just keep it lengthy. Accounts, one consolidation question, one amalgamation question, investment question, cash flow statement. Over. If they give that, 90% of the people will not complete more than 70 marks. I can bet. Easy, straight out of study material question, but not able to complete the paper. Marks lost. So in practical papers, those are some difficulties that can come, which probably will not arise much in the theory paper. So don't ignore those audits and laws. They are also equally important. Yeah, your favorite paper may be tax or accounts or FM or costing or whatever, but still reasonable amount of preparation you have to also do it for theory. Completely don't agree. Today also I got one message. Sir, FM I will do fully, sir. SM, just to do a little, I'll pass. I don't know. I said you take a chance. Or what can I say? If in this attempt, if FM comes tricky, SM comes easy, then that attempt your paper gone. I am not setting paper, no sir. How will I know all that? What will come in? Just to keep your psychological satisfaction, I will say yes. Right? What if I say no? Then they'll be like, sir, what, sir, and all that. Examination time, I don't want to. You already have 101 stress. I don't want to be one more stress in your life. I will say, okay, take a chance. Who knows? You might have done some good karmas in your life. It might work for you. Yeah. Yes, we have seen some students. I've heard many people say that I watched only your marathon and you have cleared. I've seen so many people say that. I am like, Daivame, good for you. Sir, marathon is for 35 hours. Advanced accounting course is 220 hours. They are saying they skipped to 220 hours and watched 35 hours ka lectures and passed. I'm like, okay, you're super smart. Maybe that attempt, my vastu was good. Whatever question I did in marathon probably came. Every attempt it will not work, no. I'm not setting papers. Those are the chance which I would not like to take. Right? But as a student, if you want to take it, that is entirely on you. I will not comment on that. Your preparation or your choice. But if you ask me and all, I would say prepare everything. That's all I have done, and that's what I would suggest. I don't like to give anything for chance. And we are moreover in that student phase. At student phase, we should not look for shortcuts. We should do what is required in life. That's what my principle is. I keep saying in class, when you're partying, party like crazy. Should not worry about who's standing next to you, who's watching, what they're thinking and all. To hell with all of them. I am enjoying, I'll enjoy. When you're studying, also same principle. I will study like there is no tomorrow. That's it. If you study like there is no tomorrow, you will party also like when there is no tomorrow. So that is much easier approach. You will get a holistic approach. Now, in your study break, give your full efforts. So that once the examination is over, deep down, you will have that signal. I have done reasonably well. I will pass. That time, anyway, 1 month they take, ICI takes to release the results. Enjoy, that time. That time people are full in buku mode. Sir, I don't know what will happen. I don't know what will happen. You don't know what will happen because you did not do what you did in your study holiday. Right? That is the problem. Right? If you focus now 1 or 2 months before examination, after examination 1.5 months, literally that is a chilling period. You should have fun. Right? But it's not happening for majority of the students because of that lack of whatever. I don't want to comment on the reason, but buckle of people. What needs to be done, let's do it. Let's not go for the shortcuts. Let's not get enticed by what somebody else is saying in the market. Yes, I know that there are some people who say that you only do this, you skip that and all that. Some faculties are also endorsing. I have nothing against the faculty, but some attempt may those strategies work. Some attempts may they don't work. At the end of the day, you remember it's your life, it's your career on the line. Right? If the strategy does not work, who has to study? That faculty will come and study for you. You only have to study. Your friend will not study. No matter whom you are following. Sometimes we follow our friend's advice. Hey, macha, all that is waste. Yes, but that friend will not come and study. Next, you only have to study. So better study once. No? Hold the book properly once. So that finally we can drop it once and for all. Otherwise, you have to keep carrying the book wherever you go. If not in your bag, in your mind. Ayyo, still I'm in this level. No. Right? All my friends have already gone to CA final and all that. That regret is there. So let's not lead the life in regrets. Let's give our best. Still we have around 40 days or roughly. So 40 is still good. I know that majority of you are still writing only one group. Right? 40 days, trust me, is an amazing number of days. If you really concentrate and do what is really required, it's a very good days to definitely clear the paper. I believe, yes, it's a very good time. So it depends on how you use. Next 40 days, that's what I say, next 40 days if you prepare, next 40 years, the course will feed you. Otherwise, 40 days will become 160 days ka preparation, 80 days ka preparation. See, ICI has zero tolerance policy for all this. We have seen so many students fail by 1 mark also. 39 means 39 hai. They will say, come. We have seen 39, 38, many students get and still attempt the paper. So there is no partiality, no caste, no this, no reservation in CA system. You prepare, you write, you clear, you go to the next level. Otherwise, ICA will say our affair continues in the same level. Some of them are having this since many attempts. Years together, they are stuck in one level. Right? I don't deny that, but just that you're not doing that whatever is needed. So one attempt may do what is really needed. Pakka, you will definitely go to the next step. Okay, Ji. So let's try. So can we try first question number 23 here? Okay. So this is again our class notes. It's there in study material also. So let's review and see what we can learn from this particular question. After this question, if you feel like you want to take a break, we can take a break and come back. He's like, yes, sir, pakka, sir. All right. Anija Limited is a newly formed company. First line is only giving us evidence. What? New company means no opening stock of raw material, work in progress, finished goods. They applied to commercial bank for the first time for financing working capital requirement. Leave that. Basically, we have to prepare working capital estimate. Same drama that they have told in the last slide. Check this. Estimated level of activity. How much? 1,04,000 completed units. 4,000 units WIP. In one problem, they gave WIP in time. In another problem, they linked it with 15% of production cost. Here, they have given WIP ka unit separately. These are the three ways usually WIP question can be structured. So here, WIP ka units is straight away given. Great. What is the raw material cost per unit? 80. Wages, 30. Overhead is exclusive of depreciation. How much? 60. Anyway, depreciation we should include or exclude. Why? We are preparing this on a cash cost basis. Have they included or have they excluded? In one of the examination problem, they told including overhead it is 70 and depreciation is 10 per unit. Tell me what you will do. Including overhead it is 70 it seems. How much depre per unit? 10. That means excluding overhead it will become 60. Here have they included or already excluded? So should we have to do any adjustment here or take it as it is? As it is. Okay. Raw material stock. Here data is given in days or weeks. 4 weeks consumption we maintain as closing stock of raw material. Work in progress, they are asking us to assume 50% completion in what stage? Conversion stage. Even if they don't say for conversion cost, any which way we assume 50%. But anyway specified. Finished goods cost stock 8,000. So normally if you observe last problem, one problem they told finished goods is an average in a process for how many months? 2 months. In another problem they said 10% of the cost of production is finished goods. But here is the data given in months or linked to production or have they given directly units? If they give the data in units, you have to proportionate in units. If they give the data in time, you will have to proportionate in time. Whatever data, the way they have given the data, accordingly you will proportionate. So here we'll do all the proportionate in what? Time or units? For finished goods and all, we'll do it in units. But for raw material, we'll do it in time. The way data is given, accordingly, we'll have to proportionate. Creditors gives how much credit? 4 weeks. Debtors, we give how much credit? 8 weeks. Lag means we are paying on a prepaid basis or delay. That is nothing but your outstanding. How much? 1.5. So all this data they have given in weeks means we will proportionate in weeks. Okay. Cash at bank, they only told us 25. Any other data? No. Assume that there are how many weeks in a year? 52. Calculate the net working capital. One by one we'll start. For work in progress, any drama here or clearly units is given? How many units? 4,000. What is the raw material cost per unit? 80. Yes, no. But we know that if they don't tell anything, for WIP, raw material DOC is always 100%. So calculate 4,000 ka 80 into 100%. How much is that? 3,20,000. Are we comfortable? Here units is directly given, so we are taking that. Then, what is the wages cost per unit? 30. How many units of WIP? 4,000. Calculate 4,000 into 30. How much is that? 1,20,000. Will you take it as it is or multiply DOC? What is the DOC of conversion cost? Conversion cost means wages and overheads. How much is that? They only told here assume 50% with respect to the conversion cost. So multiply 4,000 into 30 into 50%. 60,000. Okay. Any other cost directly is there? Overhead. 4,000 units of WIP. Overhead cost per unit is 60. Multiply 2,40,000. Will you take as it is or multiply DOC? What does DOC? So multiply 50%. 1 lakh 20,000. That is your overheads. So add all this, you will get the closing stock of WIP 5 lakh. Okay. What about articles? What about articles, Macha? You're going for articles, huh? Okay, go for articleship then. You're saying how to manage time, huh? Study, we break, they'll give you, take it. Study. Right, no, all CA firms gives time, pa. I don't know, if they're not giving time, then you should change the CA firm. Yeah, closing stock of WIP, how much? 5 lakh. Next, working note number 2 is for what? Debtor. So tell me debtor ka cost sheet format. First, raw material consumed. Now, how many units of finished goods did you produce? 1,04,000. And what is the raw material cost per unit? 80. So multiply these two. Now here don't multiply DOC. This is finished goods. Finished goods ka DOC is always 100%. Only for WIP we need degree of completion. So finished goods we don't need. So 1,04,000 ka 80 how much? 83 lakh something you get. But this is only for finished goods. How much is the material consumed for WIP? 3,20,000. Add that. So what is your total raw material consumed? Understood everybody? Or you can also calculate in this way. How much is how many units? Finished goods 1,04,000. WIP how many units? 4,000. Into how much per unit? 8. Like that also you can calculate. But don't use this approach for labor and overheads. Why? For labor and overhead cost, is it 100% complete or only 50%? Hence, better to do separately only. Some of you might be doing like this, so I said. This will work for raw material because raw material ka DOC is 100%. So, but labor and overhead, better to do it separate. How many units of finished goods did you produce? 1,04,000. What is the labor cost per unit? 30. Multiply. 1,04,000 ka 30. How much people? 31 lakh something. To that you add WIP related to labor cost related to WIP 60,000. Add it. How much are you getting? 3180. Similarly, how many units of finished goods have you produced? 104. What is the overhead cost per unit? 60. Multiply these two. You are getting some number. To that number add 120. How much are you getting? 63 lakh 60,000. Adding all this, you're going to get the factory cost. To factory cost, add opening stock of WIP. It's a new company, so opening stock is 0. Closing stock of WIP, just now you got it to be 5 lakh. You'll get the cost of production. Admin expense not given. Add opening stock of finished goods. So new company, so 0. Closing stock of finished goods, now you tell me. For finished goods, have they linked it with production? In one problem, they linked it with production. 10% last problem, they linked. Here they have linked? No. Have they given it in time or units? Check. Finished goods ka they have given. What have they told? Finished goods in stock, as in closing stock of finished goods is how many units? 8,000 units. Very simple. Oh? How much is your cost of production? 1,76 lakh 80,000. This you have incurred for the whole year. Whole year you produced how many units of finished goods? 1,04,000 units. Yes, sir. Entire 1,04,000 you have as closing stock or only 8,000? 8,000. This wala proportionate. Understood? Proportionate this. 36. So last problem mein they linked directly this with cost of production. In one problem mein they linked it on time. Here they have linked it with time or units. The way they have given, accordingly you need to proportionate. That is basis. Yes, sir. Okay. By doing this, you will get the COGS. There is no selling expense, so cost of sale also will be same. We read the problem. Have they told cash sale, credit sale, drama or no drama? So annual cash cost of credit sale is also same. We take this as a basis to find what? Debtor. For debtor, have they given it in units or time? For debtor, we give credit in what? Units or time only. So debtor ka usually will be in time. How much credit we are giving to debtors? 8 weeks. So you'll proportionate this in time. So debtor will linked with credit sales or here cash cost of credit sales. Will you take credit sales or cash cost of credit sale to find debtors? We'll take cash cost of credit sale. Why? Because of working capital estimate. Working capital estimate mein don't forget that one sentence, fund getting blocked. Fund get blocks only to the extent of cost. So what is your annual cash cost of credit sale? 1,63,20,000. They've given the data in days, weeks, months, weeks. In a year, how many weeks are there? 52. How many weeks credit we give it to our data? 8 weeks. So proportionate. This is for the whole year, 52 weeks. For 8 weeks, how much is the value? Done, Sarji? Creditor. For creditor, we need raw material purchased. But here we have raw material consumed. From consumed, how do you get purchased? Take this number, add closing stock, reduce opening stock. So raw material consumed is same data. How do you get closing stock of raw material, people? Same. Check how have they linked raw material. They've given in units or have they given it in time? Raw material in stock for how many weeks consumption? So here they've given the data in time. So proportionate it. What is your annual raw material consumed? 86,40,000. So 86,40,000 is for 52 weeks. How many weeks ka stock, how many weeks ka consumption you maintain as closing stock? 4 into 4. How much is that? 664. New company, so opening stock 0. So this is your raw material purchased. Now you use this as a basis to find out creditor. How? This is the data for whole year. Whole year credit are you giving? Are you receiving from creditor, or how much credit are you getting from your creditor? 4 weeks. So calculate. This 93 lakh is 4,615 is the annual purchase, meaning it is for 52 weeks. For 4 weeks, how much is the value? That's your creditor value. Okay, G. Now your working capital estimate wala problem. That can you take care of it? So here only one lag is there, which is what? Maybe that alone I'll do. Lag in payment of what? Wages. How many weeks? 1.5. So calculate that for me. I've given you the data here. Calculate that. Let's see. Outstanding wages alone you calculate. 90. How did you calculate? 31,80,000 is the data for whole year, meaning it is for 52 weeks. How much lag is there? 1.5. So multiply, how much are you getting? 91. That's it. Okay. Safety margin and all. It's not balance component, straightforward. Okay, na sir? These are the 3 popular problems. Usually when paper is normal, one of these type of question usually comes. Okay, sir? Done, sir. Now, 1 second. I'll just see if there is any small thing quickly. I'll just check off. This is done. Okay, maybe this alone I'll tell. Sir, when it comes to working capital investment, there are 3 policies: aggressive, conservative, moderate. In aggressive level, company would want to maintain lowest level of current assets. What is it? In aggressive, company will maintain current asset at lowest level. What the company ka intention here is, when you're following aggressive working capital investment policy, company will give very less credit to the debtor. They want to collect money from debtor as early as possible, because more earlier company collects the money from debtor. Using that money, they can buy more goods and they can sell more goods. So company ka intention here is to do everything on a faster basis. So they will follow up with the debtor and collect the money faster. So in aggressive, they will maintain the current asset at highest level or lowest level. Since you maintain current asset at lowest level, your liquidity risk, sir, name itself is saying aggressive. In aggressive, we take less risk or highest risk. Liquidity risk will be what? Highest. And risk and return go hand in hand. No, if you're taking more risk, your return also will be highest. Okay, people. Now, this is aggressive. What about conservative? Tell me, construct this thing for conservative. Under conservative, we will maintain current asset. This is lowest, means this will be highest. You are giving lot of credit to the debtor. That means you are collecting money faster or very late. Very late. And you will maintain high levels of cash. Since you're maintaining a lot of amount of cash, if something goes wrong also, will you be bothered or you have enough cash? So liquidity risk will be on the if you're conservative, means are you taking more risk or less risk? So risk will be lowest. Return also will be what? Lowest. Next is a policy called moderate. Moderate will fit somewhere between this. So you could say somewhere around average. Somewhere it will fit between this number. Okay, people. Now 1 minute. In one of the problem, how this concept also can be used in problem, can be constructed. They will say Current asset levels are 10 lakh, 15 lakh, 20 lakh. Okay. And they will say company wants to follow aggressive, conservative, moderate policy. Okay. Now you tell me, they will not tell this current asset of 10, 15 lakh is related to which policy. You tell me. This 10 lakh is related to aggressive, conservative or moderate. Use the concept and tell me. In aggressive may company will maintain lowest level of current asset, which is the lowest number among this 10 lakh. I mean, this number is suited for what? Or this is relevant for aggressive. In conservative may current asset will be highest, which is the highest number among this. So 20 is number relevant for what? Conservative. Somewhere between that is what? Moderate. This is one way of structuring. Okay. Done. So this is taken care of. Okay, with this I think we have done. Next is cash. So can we take a break and resume? So I think we
Sir, in debtors valuation, can we take total cost
total cost of what, ma?
instead of cash cost? We can take all total.
If you're doing total cost approach, then total cost you will take. If you're doing cash cost,
we are taking total
yes.
cost.
Ideally, always solve the problem under a cash cost basis. Better, right? If you're doing under total cost method by any chance, mention a note. Or I would say better always follow total cost only if question mentions. Otherwise, always go for default cash cost basis. Anything else? Okay, so what is it now? Where do we stand? We'll take a break and resume. How much time break you need, people? It's 4:30. So what? 15 minutes can we take maybe? Okay, so we'll take break. Class at what? Class start to 4:45 for online YouTube streamers. Okay, starts from 4:45. Okay, sir. Take 15-minute break and come back. Thank you.
So this will be uploaded.
1 minute. No, I think I'll just pause. Yes, people, welcome back after that short break. So we have done till now working capital estimate wala problems. So let's proceed our discussion. Next is cash management. Next important area is the cash management. In this, usually examiner asks the cash budget. They'll ask us to prepare the cash budget. Maybe before the budget problem, there are a couple of small questions. Let's review them off, or a couple of small concepts. Let's finish off this. One, there are two people, Brahaspatis, right? So they have given how much cash balance company should maintain. Company should maintain how much cash balance. William Baumol model, sir, says, you know, remember in your costing you have studied economic order quantity, EOQ. There you wrote the formula square root of 2 AOC. Right? No. Here UPS. Instead of AOC, here it is UPS. So that means the formula will be 2 times of UP divided by S. That if you do, you will get a number. U here stands for annual disbursement of cash. It will be directly given to you in the problem. How much cash we need. P is the transaction cost. S is your opportunity cost. What is Baumol-Zerka funda as? Sir, you can't maintain idle cash. If I keep, let's say, 1 lakh rupees cash, physical cash in hand, that means it's loss for me. If I at least deposit in bank, I will get some return. If I keep idle money, I will lose out on the return. Okay. But if I keep investing every time, suppose I go on buying shares, right? Each time I buy the share, I have to pay brokerage. So when you want to invest also, there is a cost. If you don't invest also, there is a cost in terms of losing out the return. So Baumol sir is trying to say how much cash you should maintain and how frequently you should invest so that your return cost, your opportunity cost, as well as your transaction cost is minimum. That is what they're trying to say. Basically, it's adopted the EOQ model. So square root of 2 times of UPS. U for annual disbursement, P for transaction cost to invest, S for if you invest, how much return you will get, opportunity cost. Do this, that final number only is your Baumol-Zerka minimum model. All this can get fit in for 1 or 2 marks ka MCQ questions. Miller or model sir is saying this will not work. This will not work for the company. See, when you use this, no, you will get a number. That number could be 50,000 or whatever. Now you tell me, maybe for a smaller companies, maybe like ArivuPro and all, 50,000 cash may work. But do you think for Infosys, Reliance and all, 50,000 cash would be sufficient? Huh? So how much cash you should maintain, that depends on the scale of the company. And also the month. Some months we have to maintain a lot of cash. Some months we can maintain less amount of cash. So Miller or model said we will set three limits. We will set three limits: upper limit, lower limit, return point. Upper limit, lower limit, return point. So this upper limit is denoted with, water ka chemical formula, or what is that? Chemical formula, water ka. What is that formula? H2O. So we'll remember it as, instead of 2 resembles what? Z, no. So we'll remember it as H2Z2 0. Okay, upper limit is denoted by the symbol H. Return point is denoted by the symbol Z. Lower limit is denoted by the symbol 0. Okay, sir. Now this upper limit, lower limit, return point, company only have to decide. What is this upper, lower and return point? What Miller sir is trying to say is, let's say for one company, upper limit is 50,000. Upper limit is a maximum amount of cash a company can hold. The moment cash hits upper limit, let's say return point is 30. Okay, lower limit is 10. This is the limit a particular company has set. The moment cash hits, cash balance becomes 50,000. What the company feels is they are holding too much cash. When you are holding too much cash, what you will do? Invest the surplus cash and get the cash balance back to what? Return point. So from 50, balance has to become 30, means how much will the company invest? 20,000 investment they will make. On some months, when the cash balance reaches lower limit is what here? 10,000. When the cash balance reaches lower limit, then company is holding very less cash. Whatever investment they had purchased before, how much investment they had purchased before? 20,000. That they will sell. When you sell the investment, company will get money. So from 10, you will recover 20,000, means balance will come back to what? Return. So within this limit, company can play around. But the moment company, the limit reaches the upper limit, you purchase the investment. The moment investment reaches lower limit, you sell the investment. But within the limit, you can go around play. In this limit also, company only has to set. That is a Miller or model ka approach. Done, Sarji? All this again for theory MCQ questions or 1 or 2 marks ka MCQ question at best. Not very popular, but possible. Okay, sir. And relating to cash budget, there could be some somewhere between 4 to 8 marker question can come. That is a preparation of budget. Budgeting means what? Forecasting. You are estimating the future. Now we are trying to estimate what is our cash requirement. There are multiple ways to prepare the budget. One is receipts and payment method. In receipts and payment method, we will estimate all our receipt. We'll estimate all our payment. Receipt minus payment will give you your cash balance. That is one way of preparing the budget. Another method, we'll prepare cash budget using adjusted income method or P&L. Remember in your advanced accounting standard 3, cash flow statement you used to prepare. In indirect method, from profit we used to get a find out the operating cash flow. From profit we used to get operating cash flow under indirect method. This is that adjusted income method. From profit try to derive cash flow. That is one. This we have done in accounts. This is not relevant here. Leave that. Next is balance sheet method. If you remember balance sheet may you show all assets and all liability. Estimate all assets, all liability and get cash as a balancing figure. That is your adjusted balance sheet method. These two are not relevant. Usually, if at all question comes on budget, it will be for the receipts and payment method. So we'll take up one question. We have done 4, 5 in our regular class. One we will take up just to and try to cover all those concepts relating to the budget. Wait 1 minute. Let me find that question for you. Here, maybe this. This is also study material question. This is a good question. Couple of extra points also we can sort out using the same question. I'll tell. First, let's do up this question. Study material question. Following information relates to Zeta Limited, a publishing company. Selling price of a book is 15. Sales are made on a credit and invoiced on the last month. Okay. It's a credit sale. Variable cost of production. So we are a publishers, means in order to publish the book, we'll have to incur various production cost or publication cost. To publish the books, how much material cost will be incurred? 5 rupees. 5 rupees per book. How much is the labor cost to publish? 4. Overhead is 2. But we will sell the books eventually for 15. Sales manager has forecasted the following volumes. Volumes means units. Sir, sales manager will forecast production units or sales units. Sales units. So from November to August months, how many sale unit sales manager has given? There's not sale in value, there's sale in units they've given. And you know already know unit selling price. How much is that? 15. If you take the number of units and multiply 15, automatically you will get the sale value. That is one. Okay. Now read the data. Customer. So they only told in the problem we are making a cash sale or a credit sale. We make a credit sale. So how many months credit are we giving to our debtors? Check. Customers, as in our debtors, are expected to pay as follows. 1 month after sale, we will recover how much? 40. If you sell this month means, if you make 1 lakh sale this month, then 40% of this we will recover within the next 1 month. Balance 60% you will recover after 2 months. So in 2 installment, we are recovering money from our debtor. 40 after 1 month, 60% after 2 months. That's the structure of collection. Okay. Or maybe let's do a thing. Here what or maybe I'll read the data once. It's fine. The company produces the books 2 months before they are sold. If you want to sell January May 1000 books means what you have to do. If you want to sell January May 1000 books means 2 months before that only. That is in November only. How many units you should have already produced? Now, 2 months before sale only you produce the book and keep it. So if you want to sell 2000 books in April, when will you produce this? 2 months before. 2 months before means February only you will produce of 2000 books. That's what they're saying. Okay. And creditors for materials are paid 2 months after production. You'll pay in the same month of production or 2 months later. 2 months later. This is for your creditors for material. Variable overheads are paid in the month following production. Whichever month you produce, in the same month will you pay variable overhead or following month? The next month. And this variable overhead are expected to increase by how much? 25% in April. Currently, what is our overhead cost? 2 rupees. Will it be 2 or it will increase by 25? Increase by 25. So it will become 2.5 from April onwards. Okay. 75% of the wages are paid in that month of production only. Balance 25% you will pay the next month. So in the month of production 75, the next month you will settle the balance 25. That's the labor cost ka settlement. Wage increase of 12.5% will happen on 1st March. Currently what is the labor cost? 4. Will it be 4 or it will increase? Increase by 12.5. 4 plus 12.5 is how much people? 4.5. Huh? So labor cost will become 4.5 rupees per unit from 1st March onwards. Okay. Company is going through some restructuring and it will sell one of the property in May for 25,000. Sir, in budget mein very simple. All the receipts you show it as a positive number as an inflow. All the payments we show it as a negative number outflow. That's all we are trying to do over here. Okay, all the receipts you show it as positive. All the payment you show it as a negative number. Here you are selling the property. So it's a payment or a receipt? Receipt. Which month may you will get this receipt? May month. But it is also planning to buy a new printing press in May for 10,000. So this is inflow or outflow? Outflow. Depreciation is 1,000. I'll not even bother reading depreciation. Why? Sir, I am preparing cash budget. Depreciation is cash or non-cash? So they can give whatever depreciation data. I'll not even bother reading it because it is purely a non-cash expenditure. Tax is 10,000 rupees. When you have to pay this 10,000 tax? March. So inflow or outflow? Outflow. Company presently has a cash balance of on 31st December x 3,500. So now budget, no, sometimes they'll ask us to prepare for 3 months, 6 months, 1 year and all. Here what you need to do? You need to prepare cash budget for 6 months. From what date? January to June x 4. That means budget period is 1st January 20x4 to 30th June 20x4. Do you agree? But they have given 31st December ka balance. What is 31st December ka? 31st December ka closing balance will become 1st January ka opening balance. How much is that? 1,500. Done na ji. So basically January, February, March, April, May, June cash ka closing balance we have to derive. Every month ka we need to do. How do you get closing balance? Take the opening balance, add all the receipt, reduce all the payment. Automatically you will get what? Closing. This receipt and payment data they've given here. That's all. We have to capture this on a monthly basis. We prepare ledger like this only, no? We used to prepare cash ledger this way. Instead of presenting this as a ledger, we have to present them as a statement. That's it. But this statement you have to prepare on a monthly basis for how many months? 6 months. Okay, let's start. Okay, this is the solution. This is budget from January to June. First, we'll start with what? Opening balance. January ka opening balance, they only given. How much is that? 1,500. Now, receipt. Now, you read the data. Tell me what and all receipt can come. One receipt is from receipt of money from debtor. That is one. Then we sold some asset. That is another receipt. What and all payment can come? Tell me. When you, after reading the data, what you could capture? One, to produce the book, you need material. Material you will buy it from creditor. Creditor ka payment you need to make. Then you have to make overhead payment. Then you have to make wages payment. Done. And there is some tax payment, machinery payment. Some 6-7 components you need to capture. Debtor ka collection, is it straightforward or 2 installments? So hence, let's prepare a working note for it. So some receipt, if it is straightforward, you can bring it into the cash budget directly. If it is not straightforward, then better to put a working. So first, let's put working note. Working note number 1 is what? Collections from debtors. All right. Collections from debtors. Okay, people, I'll just read the data once for you. Just check. First, sir, we need the collections from November to August or January to June. Our budget period is only January to June. But no, people, I do want to break my head from which month I need to start my data. Because if you make a sale in November, little bit money you will collect it in December. Another partially you will collect it in January. Now, I don't have to, I really don't like to break my head from which month I should start. From which month they have given the data? November. I'll copy that. I'll start from there. Okay. So this data from November to August, whatever they have given, let us copy that. If you want, you can stop at June, because beyond June it is what? June is beyond our budget period. Or if you want, you can copy as it is. November to August. I don't know here what I've done. Yeah, I've copied from November to August. Yes, sir. People okay? But they have given what? Sale value or number of books sold? Number of books sold. So, and each book ka selling price is how much? 15. So, 1 or 2 quickly to find out. 1,000 units here you have sold. Each ka selling price is 15, means sale value is 15,000. 1,000 ka 15 again is 15,000. This is also 15,000. 1250 into 15, how much? Like this. I've just got the sale value like that. Comfortable, sir? I've taken the number of units sold and multiplied 15 rupees and I've got the sale value. Okay. Now this is the credit sale. And what are the credit terms? What are the credit terms? If you sell in this month, 40% money you will collect it within 1 month after sale. 60% you will collect 2 months after sale. Okay, so let's look at this. What is November ka sale value? 15,000. If you November if you sell 15, means that month only you will collect, or 40% next month? 15,000 ka 40%, how much? This is your within 1 month. Within 1 month, how much will you collect? Within 1 month. And this is within 2 months. Okay, 15,000 ka 40%, how much? 6,000. Balance 60% you will collect 2 months later. 2 months later means it will come in January. 15,000 ka 60%, how much? 9,000. 1 or 2 I will show. Are we comfortable? Okay, December if you sell 15,000, means how much money you will collect in December? Anything? No, or next month only. Next month. Next month you will collect 40% of this. 15,000 ka 40%, how much? 6,000. And balance 9,000 you will collect in February. Comfortable? 1 or 2 more you want me to show, or got the idea? Like this, fill out the columns. But ultimately we need the collections for every month or Jan to June. Jan to June. This is what we need for our preparation of budget. Hence, other column ka, though we can find total, I have not done. If you want to do the total, absolutely okay. But this is my budget period ka data I need. This is the collections from data. Yes, no? Others you can manage. No, it's okay. In the same fashion. Next is what? Payment to creditor. Now, creditor you will make when you purchase the goods. Yes, no? But there is a sentence in the problem that said something. Let's review that once again. Company produces the books 2 months before they are sold. So if you want to sell 2,200 units in June, you have to produce the books 2 months before. That is in April only you need to produce. Agreed? So in January, May, if you want to sell 1000 means this 1000 books has to be produced in November. Yes, sir, people. So that means I'll have the same column. I'll start from November. But November, May, I'll start copying from what date? I'll start copying from here or I'll start copying from here? I'll start copying from November. Why? Or rather, I'll start copying from January. Why? January, May, if you want to sell 1000 means that books you should have produced it in November only, 2 months before. So check here, I've just copied that. I've started the data from November only. Previously, I started the data from November. No, so this also I started from November. So November, May, how many books will you produce? Can you tell me that? November, May, how many books? Or maybe I'll write it here. Just for this alone, I'll write it over here for our quick reference. November, May, how many books will you produce? January, May, if you want to sell 1000 means you have to produce that in November only. So February, May, if you want to sell 1250 means this unit has to be produced 2 months before only, which is what? December. So you have to start copying data from what? Jan. So 1000 to 1250. Next data what? 1500. Next data what? 2000. Next data 1900. Like this you'll have to copy. Comfortable, sir? Basically from here we need to start. Because that sentence, 2 months before sale only, you will start the production. So from here to here, I've copied the data if you want to check. From 1000 to 2300. That is what I've copied it here. Done, sir. What is this? This is the number of books published or produced. Okay. But in order to publish the book, you need material. What is the material cost per book? They have told. What is the material cost for one book? Material cost for one book is 5 rupees. So what is the total material cost? For one book, 5 rupees, one book 5 only, you know. One book 5 rupees means 1000 books, how much? 5000. One book 5 means 1250, how much? 6000. Like this, we will get the material cost. This we will have to settle whom? Creditor. We will pay the creditor that month only, or there is a credit check. What did they say? Creditors for material are paid 2 months after production. So creditor ka payment, will we make it in that month only or 2 months later? So November, May, if you have incurred material cost, means this ka settlement will happen 2 months later. 2 months later means it will come in January. So December ka creditor payment will happen 2 months later, which is February. Like this. This ka payment will come here 2 months later. Like this. Yes, sir. So that means you tell me for our budget, I need this data or I need payment data. Payment data is what it is relevant. We need only inflows and outflows. So this is the actual outflow we need to capture. Done now? Okay, that's the only payment or 2 more payments? 2 more. What are those? Wages and overheads. Wages and overheads also you will incur when you produce the goods. So production data again I have to calculate, or I already got it here. So same data I will copy for overheads also. Same, how much units produced the same. Now you will incur all this cost only when you produce the goods. Correct, Ajay? What is the variable overheads per book? Check. They have told in the question. How much is the variable overheads per book? 2 rupees. Will it be 2 rupees only forever or it will increase? This variable overhead, they said from April onwards it will increase by 25%. So will it be 2 or it will increase by 25%? 2 plus 25% is how much? 2.5. So up to March it will be 2. From April onwards it will become 2.5. So calculate what is the variable overhead cost up to March. Variable overhead per book is how much? 2 rupees. So this is the books you have produced. For one book the production cost is 2. So multiply 1000 into 2, 2000. Up to March you will multiply by which number? 2 rupees. But from April onwards, will it be 2 rupees or it will increase by 25% and it will become how much? 2.5. So you take the number of units produced and multiply 2.5. From which day onwards? April onwards. April, May, June, you will multiply by 2.5. Done, Sarji? This is the cost. But when are we settling this? When are we paying this? Check what have they told for variable overheads. When are we settling this? Variable overheads are paid in the month following production. Following production means same month or next month. So variable overheads are paid in the month following production means next month. So November month ka variable overhead cost you will settle it in December. Okay. December I have written 0. Why I have written 0? It is actually not 0. It is actually 2000. But I have not written why? Because my budget period is what? January to June. So that's it. If you want I can write. Absolutely no problem. December ka 2500 payment will happen 1 month later, which is what? January. January ka payment will come in February. February ka payment in March. March ka May ka payment in June. This is your variable overheads ka payment. But I need the payments and receipt only for my budget period, which is January to June. All other month, even if you don't update it, it's absolutely fine. Okay, or even if you update it also, it is okay. This is what variable overheads. Is that the only thing, or we have labors also? Labor cost also you'll incur only when you produce the goods. How much production of books is happening every month? That data is missing or given. You already found out. Same data you copy for labor cost also. Fine. What is the labor cost per book they told? Check the problem. Labor cost per book is how much? 4 rupees. Will it be 4 forever or it will increase? They said labor cost will increase by how much? Where is that? Wage increase of 12.5% will take from which date? 1st March. So it will not be 4 rupees. It will become 4 plus. It will become 4 plus 12.5%. So it will become 4.5. From which day onwards? Up to February, it will be 4 rupees per book. From 1st March onwards, it will become 4.5. That's what I've taken here. So this is your number of units produced. Up to February, you will multiply by what? 4. From March onwards, you will start multiplying 4.5. This is your cost. Agreed? This is your labor cost. But when are you settling this? What is the labor cost? They told one sentence. What is that? 75% of the labor cost you will settle that month only. Check. 75% of the wages are paid following month of production or in the month of production. So means whichever month you are producing, 75% of the wages cost you will pay that month only. Balance 25% you will settle following month. Okay. So now this is your labor cost, 4,000. What is the settlement pattern of this? Can you tell me? If you incur 4,000 that month, mean that month only you will pay how much? 75%. 4,000 ka 75% how much? 3,000. Balance 25%. 4,000 ka 25% how much? 1,000. That you will settle in the next month. Next month means December. Okay, ji. Similarly, 5,000 is labor cost in December means what you will do? 75% of 5,000 you will settle that month only. How much is 5,000 ka 75%? 375. Balance amount in the next month. Like that you have to go on doing the settlement. And ultimately we want January to June ka settlement. Other month ka total, though you can find, I don't need. We need from Jan to June. This is your payment. Clear? All these had some extra fitting. So we did this as a working note. Rest all is pretty straightforward. So we can capture directly in the budget. Can we do so? Everybody okay? So the pattern is very simple. Start with opening balance. Add all the receipts. Deduct all the payment. Opening balance we already know. How much is the opening cash balance, people? 1,500. Start with that. Receipt. One receipt is what? Collections from debtor. What is the collections from debtor from Jan to June? Here it is there. This to this data. Copy this as it is here. This is your collections from debtor in the respective months. Agreed? Everybody? Next, payment. 3 payments ka working out we have done. What is that? Creditor payment, variable overhead payment, labor payment. So that copy it as it is. Creditor payment from Jan to June is this number. Okay, which we have captured. If it's a receipt, show it as positive number. If it's a payment, show it as a negative number. So variable overheads and labor overhead also will come from the respective working notes. Any confusion in this? Are we okay? Now, other than this, there are some straightforward cash information. Let's capture them. I think they told we have to sell a machinery. When are we selling? Company is going through restructuring. It will sell one of the freehold property in May for how much? When you sell a property, you will pay the money or receive the money. So this is the receipt of 25,000 in which month? May. At the same time, you will also buy a new printing machinery in which month? May month only. By paying how much?
10,000.
So May month mein there is a payment of 10,000. There is a receipt of 25,000. Capture. May month mein receipt of 25. May month mein there is a payment of 10. Okay, ji. Then we saw that there is a tax payment also. When is a tax payment? Check. Corporate tax of 10,000 is due in March. So March month mein tax ka payment will come. March month tax payment of 10,000. Clear, sir? How do you get closing balance? Now calculate this for me. Take the opening balance. Add all the receipt. Reduce all the payment. Quickly do it. 1,500 plus 15,000. That's the only receipt in the month of Jan. And these are the payments. Minus this. Minus all this you do. Basically 1,500 plus 15,000 minus these 3 numbers.
3,000.
That is your closing balance. January month ka closing balance will become February ka. Again the same exercise. Take opening balance, add all the receipt, reduce all the payment. If you want to do it, you can try it once again. 3250 plus 15,000. There is no other receipt. Minus this numbers, minus these three you do. 1,500. That is the closing balance. This month ka closing balance will become next month ka opening balance. So on, go on filling it up. Minor people. So if the question is lengthy like this, they will only give this many adjustment. If they give you shorter adjustment, if they cut off all this, then they may include one extra adjustment. This question is over. Now I would like to discuss that adjustment also using the same question. Okay, what is that is? In this problem, it is not there. Just for our reference, we are discussing this. Some problems may they will say maintain a minimum cash balance. Maintain a minimum cash balance. In this problem, not there. Suppose if they tell, I think I've structured that. Okay, here. Suppose they tell in the question, we have to maintain a minimum how much cash balance? 2,000. If they have to maintain minimum cash balance means every month ka closing balance should be how much? 2,000. Because that's what the question is saying, that we have to maintain minimum how much balance? 2,000. Let's do it for January 1st. Take your calculator. How much is the opening balance? Add all the receipt. There is only one receipt, 15,000. Add. Okay. Reduce all the payment. Reduce all this. How much are you getting? You are getting a balancing figure of 3250. Still 3250 cash is left. But company has to maintain only how much balance? 2,000. We have to maintain 2,000 balance. But how much cash we have? Do we have surplus? So when they say we have to maintain minimum cash balance, if you have extra cash, then you will invest. So how much extra cash we have? We have 3250, but we need to maintain only 2,000. So how much extra we have? What do you do for this 1,000? Investment. So in January month, you will purchase an investment. Correct? So that the closing balance will become 2,000. Agreed, people? Sorted? Everybody good? Now start with the February ka. January ka closing balance will become February ka opening balance. February mein what and all receipt is there? Only one, which is 15,000. I have jotted down here for your reference. Okay. And what are the payments of February month? 3 payments. 6,250, 3,000, 7,500. Add all this. Adding all this. And not only addition of this. Only payment ka addition. These 3 ka addition. 16,750. That is the payment. Now do all this. Opening balance plus receipt minus closing balance. Do that. How much are you getting? You're having 250. 250. But we need to maintain minimum how much cash balance? From 250 it has to become 2,000. What we have to do? Previously when you had surplus, what did you do? Invest. Now you have surplus or shortage? When you have shortage, you will invest or sell the investment? When you sell the investment, it will become a receipt. Add 1 to 5. How much it will become? 1,500. Now here to here, if you add, you're getting how much? 1,500. But we need to maintain 1,500 or 2,000. Any more investment is there to sell or no more? Still, if you have shortage, you will take a loan. You will take how much loan? 500. That's your borrowing. Usually in the examination question, it will be either investment purchased or investment sold. Or it will be either borrowing taken, borrowing repaid. Both will not come. But both can also come like this. This is another type of adjustment they can include in budget. Maintain minimum balance. Sometimes they'll include, sometimes they'll exclude. Are we comfortable with this? Okay, this is also sorted. Now with this budget ka, we are done. Budget problem are very straightforward, but watch out, budget mein lot of students will do this silly mistake of updation in the wrong column. They know that this 5,000 has to come in this column, but by mistake they'll write it in the previous column or next column. Hurry. Because when you are maintaining 8 to 10 columns, the column size are big. So sometimes it is difficult to track. You are thinking you are updating in January, but by mistake you are updating the number in February. Those sort of clerical errors happens a lot in budget. Conceptually, this is very straightforward. It will take a lot of time. Budgets are meant to take time. Okay. Another one is this arithmetical errors. Posting in the wrong column. That watch out. Okay. That I don't know. You are creative. What creative mistakes you will make, I can't tell. Once you solve, you will get to know what and all you can go wrong. Make a note of it so that we don't commit that in the examination. Watch out for that. Done. So budgeting part is done now. So with this cash is over. Next to people, two important ones, or in fact, one only under the two section, debtor management. Debtors management or receivable management. This you could say is quite important. Okay. In receivable management, two types of problem can come. I'll only discuss all these are theory. Okay. I'll not go into the theory now. I'll focus more towards the examination oriented. Fine. So in debtor management or receivable management, two types of problems can come. One is evaluating the credit policy. Another one is factoring. Okay. Both are popular in exams. Some attempt may they ask this, some they ask this. It keeps varying. If it is not debtor management, it is usually estimation of working capital. Or if it is not that, then maybe it's a budget. So these are 4-5 questions which ICA uses to play around for 6 to 8 mark. Okay. All right, we will see. First, we will take up this evaluation of credit policy. What is this? Straightforward. Currently, let's say company is giving 30 days credit to their debtors. Currently, we are making credit sales with giving how many days credit to our debtor? 30. Now, company is thinking from 30 days, why don't we give 50 days credit? Now, you as a finance manager should recommend, should company continue with 30 days policy only, or should they go for implementing 50 days policy? This is your evaluation of credit policy wala problems. Okay, Sarji. There are 1 or 2 questions on this. Can we take this up? Everybody good? Using your common sense, how will you do the evaluation? Can you tell me? So basically, you'll find out the net benefit. If when you give 30 days credit, how much is your net benefit? When you give 50 days credit, how much is your net benefit? So if suppose the net benefit here is 1 lakh. For 50 days policy, if the net benefit is let's say 1,70,000, then here it's only 1 lakh benefit. Here it is 1,70,000. Then you will say what? Go for 50 days credit. Suppose here benefit is 1 lakh. Here benefit is only 90,000. Then you don't go for 50 days credit. Continue with 30 days. That's what. You just need to find out the benefit. If the new policy ka benefit is more than the existing policy ka benefit, accept a new policy. Otherwise, reject. Okay. All right. For this also, if you remember, we used to have a format and we used to solve all that question in that format. I'll show you that. Maybe I'll first show you the format and then do it. Yeah, here. This is the format we used to use for evaluation of credit policy. Anybody remembers what is that format? Sales minus variable cost. In fact, we never used to say plus minus. We used to jot down them in numbers. Sales, so next to variable cost, so next fixed cost. Then you will get total cost excluding bad debts. Then take the 3 components: bad debts, discount, and collection expenditures if you have any. From income, if you reduce all expense, you used to get profit before tax. Reduce tax, we used to get our profit after tax. Lastly, we used to consider opportunity cost and get the net benefit. If you remember, at least 7-8 questions we have done using the same format. Others who are wondering, we'll review 1 or 2 questions more here in this particular format. Okay, it's basically same. How do you get basically PAT? How do you calculate PAT? From sales, you can reduce all the expense. But here I've segregated the expense into few categories because of one of the working note, which I'll tell you in the problem. What is that? This is the format. Same format, maybe we will solve the question now. Let me show you that question once again. Maybe we'll start with this question. It's simple. Okay. A trader whose current sales are in the region of 6 lakh. So as per their current policy, how much is the sales, people? Okay, 6 lakh. Okay, per annum. With an average collection period of 30 days. Our current credit policy is spanning over 30 days. The company wants to pursue more liberal policy to improve the sales. Company is thinking instead of giving 30 days credit, we want to give a little more. If you give more and more credit, we have already studied this. If you give more credit means debtor will buy more from us. Rather, sales will increase. So that is what finance manager of the company is thinking about. A study made by management consultant gave the following information. Now, our current policy ka credit period is how much? 30 days. Now we have 4 new policy. Consultant has proposed 4 new policy. If you go for policy number A, in policy number A, what will happen? Collection period from 30 have to increase by 10. So it will become 40. If you do this, Sales no will not be 6 lakh. It will increase by 30. So it will become 6.3 lakh. But bad debts is default means what? Bad debts. Bad debts is how much? 1.5%. 1.5% of sales with sale. Credit sale. If they don't give any data, all the sales will assume it as what? Credit sale. Consultant also told, if you go for a different policy called policy B, in policy B, what are you doing? You're increasing the collection period by 20 days. Now, don't say 40 plus 20. No. Currently, what is our policy? 30. If you go for policy B, you will increase the credit by 20 days. So, 30 plus 20, how much is that? You will give 50 days credit. If you do that, from 6 lakh, sales will increase by 48,000 and it will become 6.48 lakh or a 6 lakh 48,000. Bad debt will become 2%. If you go for policy C, then you will increase the collection period by 30. 30 plus 30, how much? 60. Here 30 plus 45, how much? 75. Sales from 6 lakh will increase by 75,000. So it will become 6 lakh. From 6 lakh, it will increase by 90. It will become 6 lakh 90,000. Are we okay, Ji?
Yes.
This is the data given. And this is the bad debts given. Okay, what is current policy ka bad debt? Have they given a check? Yeah, somewhere here they have given. The current bad debt is how much? 1%. This is new policy ka bad debt. Current policy ka bad debt of 30 days collection period is 1% given. They told here selling price per unit is how much? 3 rupees. 1 unit you will sell it at 3. What is the average cost per unit? 2.25. Did they say average fixed cost, average variable cost or average cost? Average cost means average total cost. What is the total cost per unit? 2.25. What is the variable cost per unit? 2. Sir, total cost is 2.25. If variable cost is 2 rupees means what is the fixed cost per unit? Fixed cost per unit will be what? 2.25 minus 2, which is 0.25. Agreed? Everybody good? Sir, okay. How much is your current sales? How much is your current sale? 6 lakh. Currently your selling price is how much? 3. So that means how many units are you selling? Number of units is how much? Your total sale is 6 lakh and selling price per unit is 3 means how many units? 2 lakh units. Agreed, sir? If you want to sell 2 lakh units, you must produce 2 lakh units only, right? So for 1 unit, what is the fixed cost? 0.25. For 2 lakh units, how much is the fixed cost? So what will be your total fixed cost? For 1 unit, 0.25 means 2 lakh unit, it will be 50,000. Done, Sarji? Sir, name is fixed cost. That means what? Whether you go for any policy, will fixed cost change or same? Whether you continue with existing policy or go for any of these 4 new policy, fixed cost will still be how much? 50,000. Got it, sir? Okay. Now, format. Same format, we will stick to it because of another advantage. It's not mandatory. You have to present the exam in that format only. But if one of the advantage of format is, in case they give any new adjustment, in case you get lost, that format will kind of guide you. You don't even have to know the logic. Automatically put the numbers into the format. You will get the answer. That's one of the advantage. So here format we have taken is first is sales. How much is sales, people? Now I'll have how many columns? 6 columns. Particulars, existing policy and 4 new policies. So that is what I've made the columns here. Okay. Particulars of current policy and 4 new policies. Okay. Current policy ka credit period is how much? 30. A ka credit is 40. B ka 50. Then 60 and then 75. What we calculated, I've copied. Start with sales. Currently, what is the sales? 6 lakh. If you go for new policy, this is a sale. Remember this number, 6 lakh, 630, 648, 675, 690. That I've copied here. Okay, na, Sarji? Yes, people. Fixed cost, just now we found out. How much is that? 50,000. I've copied the fixed cost here. No matter which policy you go for, fixed cost will be same. But what about variable cost? Variable cost is based on sales, no? Right? So 1 minute. How do you calculate variable cost here? I think we can structure a formula here. So this I'll call it as A. How do you get variable cost? So can I say first you want number of units. How much is number of units? 2 lakh. You will take number of units and multiply variable cost per unit. How much is that? 2. So 2 lakh into 2. How much? 4 lakh. But how did you get this 2 lakh? You took the sales, you took the sale value divided by selling price. From sale value, if you divide selling price, what are you going to get? Number of units. From number of units, if you multiply the what? Variable cost per unit. Automatically, you will get what? Variable cost per unit. That means if you want to structure this as formula, what will be the formula here? How do you get variable cost? Simply, it is nothing but what? Sales. So, because sales is same in every policy or changing? Take the sales divided by what? 3. Selling price per unit is 3 only. Multiplied by variable cost per unit. That is also what? 2. That means if you want variable cost, simply you can say it as sales divided by 3 into 2. Agreed? Everybody good, 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 good. So calculate. What is existing policy ka variable cost per unit? Sales 6 lakh divided by selling price 3 into 2. How much? 6 lakh divided by 3 into 2. How much? 4 lakh. Okay. Policy A ka variable cost you calculate. Sales 630 divided by 3. If you do sales divided by 3, you will get number of units. And variable cost per unit is 2. Multiply. How much? 4 lakh 20,000. Or maybe one more we'll try. This one is 6 lakh 48,000 divided by 3 into 2. How much? 4 lakh. Can you take care of the balance too?
Yes.
Sales we got it. Variable cost we got it. Fixed cost we got it. Add these two. Only variable cost and fixed cost you add. How much are you getting? 4 lakh plus 50,000. How much is that? 4 lakh 50. 420 plus 50. How much? 4 lakh 70. This we give the name as total cost excluding bad debt. Total cost excluding bad debt. I'll tell you why I calculated this in a bit. So far, okay? So I've just added variable cost and fixed cost. And that number I'm calling it as what? Total cost excluding bad debt. You can give any name. That's fine. This is the name I prefer to call it by. Okay. I've done it for all the policies. Easy, easy, easy.
Yes.
Is there any bad debts? Yeah, bad debts is also there. Current policy ka what is bad debt? 1%. 1% of what? Credit sale. But here they have not specified any credit sale. So we are assuming total sales, credit sales are same. So current policy bad debt is 1%. What is the current sales? 6 lakh. 6 lakh ka 1% how much pa? 6,000. That is your bad debt. And different policy ka, if you follow ABCD policy, what are bad debts? 1.5, 2, 3 and 4. Copy that. Existing policy ka bad debt is 1%. 1% of sale, which is this number. New policy ka what is bad debt? 1.5% of sale. 6,30,000 ka 1.5% how much?
9,004.
For policy B, it is 2% of sales. So 648 ka 2%. 1296. Like this, can you calculate? Done now. Any problem? Is there any collection expenditure or discount given in the problem? Some problem they will give. Here given or not given? Leave that. Okay. Now we want to calculate profit before tax. How do you get profit before tax? From income, reduce all the expenses. What is your, take your calculator. What is your income? 6 lakh. Minus, we have 3 expenses. What are those? Variable cost, fixed cost, bad debt. But variable for fixed cost I've already added. So hence, how do you calculate profit before tax? Sales minus total cost excluding bad debt, which is there in column number 4. Minus bad debts. You these 3 you minus. How much are you going to get? 6 lakh minus 450 minus 6,000. How much pa? 1,44,000. Understood? Or you can simply calculate in normal way also. 6 lakh minus 4 lakh minus 50,000 minus 6,000. From sale, reduce all the expense. That way also is okay. Okay, na sir? Similarly, calculate for second policy. Income is 630. Fixed cost, variable cost put together is 470. Reduce that. 630 minus 470. Minus bad debt 19450. Circle the number you minus. And tell me what are you getting? 1,50,000.
550.
This is your profit before tax. In the problem, have they given any tax data? In this problem, have they given any tax data or no info? No info. So tax is 0. Some problem they give, some problem they don't. So reduce tax. What are you going to get? Profit after tax. If they have given tax rate, then you can also find out profit after tax. Any problem in this so far? Now people, for accounting purpose, opportunity cost we consider or ignore. For accounting, journal entry, ledger and all, opportunity cost we ignore because we have not actually incurred that. But for FM decision making, opportunity cost you will ignore or consider. So here also there is an opportunity cost. What is that? Very simple. Sir, under current policy, how many days credit are you giving? 30 days. That means if you sell the goods today, You are recovering the money today or after 30 days? 30 days. Okay. Now 1 minute, hang on. Here, your funds are getting blocked for how many days? Now you already know the concept. Fund gets blocked to the extent of sale value or cost. Cost. That's the reason I found out total cost excluding bad debt. This number is helpful for us to calculate what? Opportunity cost. So it's not mandatory to have this column. If you have it, opportunity cost ka calculation becomes easy. Because fund gets blocked to the extent of cost price, not to the extent of selling price. Okay. Now? So hence I've calculated. Now check. Take your calculator. How much is the total cost excluding bad debt? 4,30,000. Okay. Now this 450 you will recover now or after 30 days. Now think. If you had recovered this 450 today only, if you had recovered 450 today only, you could have invested this money for how many days? 30 days and earned some return. How much return? They check, they would have given opportunity cost in the problem. What is the required rate of return on investment? So 20%. So if you had invested, you will get how much return? 20%. See, once again I'll tell. Currently you are recovering the money now or after 30 days? If only if you had recovered this 450 today, immediately, what you could have done? You could have invested this 4,50,000 for how many days? 30 days and earned how much percent return? 20% return you could have earned. But now are you getting this money? No, you are not recovering this money now. You are recovering this money after. So means can you get this investment income or you are letting go? This investment income, if you're letting go, means that only we call it as opportunity cost. One benefit, one investment income, that is benefit if you're letting go, means opportunity cost you'll add or you'll minus. Opportunity cost you have to subtract. That's what I've done here. 8 minus 9. Understood, people? Okay. And opportunity cost of calculation, right, is based on the fund blockage. Fund will get blocked to the extent of sales or cost. So now calculate. What is the total cost excluding bad debt? 4,50,000. If you had got this money now, you could have earned how much return on this? 20%. For how many days? Current policy, the delay is for how much is the credit period? 30 days. Some problem they will say 360, 365 and all. Check, have they told anything here? Here they've told. How many days in a year you have to assume? 360 days. So calculate. 4,50,000 into 20%, that is 20 by 100 into 30 divided by 360. How much is that? 7,500. Everybody okay with this calculation? 7,500. This what? We should ignore or consider? This is an opportunity cost. What sort of an opportunity cost? Is this a cost that you are letting go or income that you are letting go? An income you are letting go. How much number you said? 7,500. Even this also should be considered. This you will add or minus. So from PAT, if you reduce the opportunity cost, you will get the net benefit. Agreed, sir? That's what I've written here as 8 minus 9. Don't take it as positive number. I've not put in any sign here because I've done 1 minus 4 like this. So this minus this, if you do, you will get the net benefit. Agreed? Okay, let's do it for one more. In policy A, you will recover the money now or after 40 days? I mean, money is getting blocked for how many days? So 40 days return you are getting or sacrificing? Sacrificing. Yes. So fund is getting blocked. Funds ka blockage calculation is done on the sale value or cost? So what is the total cost excluding bad debt here? 4,70,000. Now calculate. 4,70,000 you cannot invest. So how much return you are losing? 20% return. For how many days return you are losing? 40. And they're asking us to assume 360 days in a year. So into 40 divided by 360. Opportunity cost is 10,000. Now tell me what is opportunity cost ka formula then, if you want to tell it as formula. Total cost excluding bad debt into rate divided by 100 into credit period or collection period divided by 360 or 365 or 52 or 12 depending on how they've given the data. Done, sir. Sir, why should we not consider bad debts for opportunity cost, sir? Now, bad debt when you will incur? After selling. So, to the extent of bad debt, your fund will get blocked. Now, fund will get blocked to the extent of cost. When you see, cost will come when you purchase the goods. At the time of purchase, bad debts will come. Bad debts will come after sale. Hence, I have bought a line between this variable fixed cost and bad debts. I brought one more line. What is that? Total cost excluding bad debt. This data is helpful for only calculation of one component called what? Opportunity cost. To calculate opportunity cost, we have brought in this particular column. It's not mandatory. If you want, you can cut this, and opportunity cost, you can present it as a separate working note also. That is your call. Okay, na, Sarji? Now, okay, retrace this as format for me now. Tell me. We'll start with sales. Don't write plus minus. Just call it as 1, 2, 3, 4. Okay, point number 1, sales. Point number 2, variable cost. Point number 3, fixed cost. Variable cost and fixed cost you add. That added number only here we're calling it as total cost excluding bad debt. Point number 4. Then 3 expenditures extra can come. Bad debt, discount, collection expenditure. Here all the 3 are not there. Only one is there, which is bad debts. Okay. Now from income, reduce all the expenses. What are you going to get? Profit before tax. Reduce the tax. You will get profit after tax. That's it, or even opportunity cost. But keep in mind, opportunity cost should always be on what basis? Net of tax. Because this is after tax. No? So even opportunity cost should be on a after tax basis. It will come in this problem. Before tax, after tax. Now how do you calculate opportunity cost? Total cost excluding bad debt into rate of investment divided by 100 multiplied by collection period divided by 360, 365, 52, 12 based on what data has been provided. That's it. Okay. From PAT, you minus opportunity cost, you will get what? Net benefit. Easy enough, sir. Now you tell me, you will select which policy? That policy which has the highest net benefit or the lowest? You will always go for that policy which has the highest net benefit. Which, this is your net benefit. Which has the highest net benefit here? Highest number that is looking to my eye is 140. 140 is which policy? Here. This is your 40 days. That means you will select which policy? Policy A. Because it has the highest net benefit. Okay. So far good. But sometimes they will say, calculate incremental benefit and give the decision. In this problem, not told. But some problems we have seen, they'll ask us to calculate incremental benefit. Incremental benefit means very simple. Current policy is giving what benefit? 1,36,500. This policy is giving what benefit? 140. Compared to our current policy, this policy is giving how much extra benefit? Instead of 136,500, you are getting 140,106. So how much extra benefit? 3,606. This only we call it as incremental benefit. Take the current policy number and compare it with the new policy number. Accordingly, you will get what? Incremental benefit. So what does policy C ka incremental benefit you calculate? This policy ka incremental benefit you calculate. How? Or guide me. What is current policy ka benefit? Don't compare these two. Current policy ka benefit how much? 136,500. C ka benefit, policy C ka benefit. Okay, he's saying I got it, you move on. That's his way of saying. Current policy ka benefit is 136,500. Policy C ka benefit is 138. Compare these two. How much extra benefit? 1,583. Done now. Now, if they ask us to calculate incremental benefit, then you will give the decision also based on incremental. You will select that policy with the lowest incremental benefit or highest. Which policy has the highest incremental benefit? Which number among this is highest? 3606. So you will go for policy A. That's your decision rule. Easy. 1 or 2 questions are there here. Can we review that on the same lines? Everybody cool? Okay, so let's go for a couple of more questions then. Come to question number 14. You know, opportunity cost, there was pre-tax, post-tax wala drama. Opportunity cost ka pre-tax, post-tax will come here in this particular problem. So let's see what we can learn from this particular question. Company is presently having credit sale how much? 12 lakh. Okay. Is it okay as and when we see the data we'll tick off now? Yes. Because we already know the format. So current policy ka what is sales? 12 lakh. So I'll take this. Current policy ka sale 12 lakh. Okay. Oh, next what data they have given? The existing credit term is 1/10 net 45. In FMA, whenever you see this nomenclature or this presentation, 1/1/10 net 45. What it means is, we are ready to give 1% discount to our debtor, provided they make us the payment within 10 days. Otherwise, they have to make the payment within 45 days. So actually, we are giving how many days credit? 45 days credit. But by chance, if the debtor pays us within 10 days, their choice, then we will give extra discount of 1%. This is what it means. This particular presentation you will see for creditor also, you will see for debtor also. Nana Sarji. So first number is a discount percentage. Second number is, to get this discount percentage, we have to get the payment within how many days. Last number is the credit period. That's what I've written here. Okay, Ji. Fine, we will see. That means in this problem, there is some discount. In the last problem, there was no discount. Here, probably there is also a discount. So, what is the average collection period? 30. Sir, how, sir? Sir, we have given 45 days credit. Some debtors, no, they will pay early to get the discount. I mean, some of them will pay within 10 days. Some of them will say, I don't want discount, I will pay after 45 days. So, on an average, within 30 days, we are able to collect the money from debtor. Which debtor will pay when? They have not told, but they told on an average, within 30 days, we will collect the money from our debtor as per our existing policy. Current bad debts is how much? 1.5%. Calculate 1.5% ka sales. 12 lakh ka 1.5%. How much is that? 18,000. That is your bad debts. I'm just fitting in the format numbers. Okay. All right. Next is what, sir? In order to accelerate the collection process further and also to increase sale, company is contemplating liberalization of existing credit terms. How they want to liberalize? They are going for 2/10 net 45. What does this mean? Now you tell me. We are planning now to give. Earlier, how much was the discount? 1%. Now we are planning to give it to 2% discount, provided a debtor pays within 10 days. If they don't want discount, they have to pay us within 45 days. Okay. It is expected that the sales are likely to increase by 1/3 of the existing sale. Existing sale is 12 lakh. 12 lakh ka 1/3 you do. How much is it? 12 lakh ka 1/3 is how much? 4 lakh ka. That means if under new policy, sale will increase by 4 lakh. From 12 lakh, it will increase by 4 lakh, means it will become 16 lakh. So under the new policy, sale is 16 lakh. Agreed? Yes, people? 1/3 is an increase amount. So 12 lakh ka 1/3 is 4 lakh. So new policy, sales will increase by 4 lakh and it will become 16 lakh. Okay. But bad debt also will increase by to how much? Increase by increase it to 2%. So new bad debts will be 2% of sales. What is sales? 16 lakh. 16 2s are 32. So 32,000 is bad debts. 16 lakh ka 2%. 32,000 is existing or rather new policy ka bad debt. Done, not done? Okay. What is the next one? Average collection period now will become how much? 20. Maybe some more debtor, because now 1% discount has become 2%. Now maybe more and more debtor will pay early. So hence from 30 days collection period, now collection period will become how much? 20 days. Because many debtors probably in the discount ka lalach, they might pay little early. Okay, the contribution to sales ratio is 22%. Sir, you know this order already. From sales, if you reduce variable cost, what are you going to get? Contribution. They are saying contribution to sale is how much? 22%. So this is 22% of sales. Okay. So if sales is 100% means contribution is how much? 22% of sale. So from sales, if you reduce variable cost only, you will get contribution. No? If this is 100 and this is 22 means variable cost has to be what? 78%. Because 100 minus 22, if you do, what are you getting? 78%. Because from 100, if you reduce 78 only, you will get what? 22%. Means indirectly what they are saying, variable cost is 78% of sale. Everybody good? So calculate. Existing sales is 12 lakh. 12 lakh ka 78% is how much? 936. New policy ka sale 16 lakh. 16 lakh ka 78%? 1 lakh 48. We got the number. Sales we have got, variable cost we have got. And what else number, people? Look at this line. No? Opportunity cost of investment in receivable is how much? 15%. So if you invest the money, our investment will earn how much return? 15%. This 15% number is relevant for what calculation? Opportunity cost ka calculation. But hang on there. What have they told in bracket check? This is on what basis? Pre-tax basis. Sir, the order is first you will find out PAT. First you will find out PAT. From PAT you will reduce what? Opportunity cost to get the net benefit. Since this is profit after tax, opportunity cost also should be on a what basis? After tax basis. But have they given after tax wala return or before tax? So in FM, very simple. If you want to get any number on an after tax basis, whatever number, you simply take that number and multiply 1 minus tax rate. You simply do 1 minus tax rate, you will get after tax. What is opportunity cost before tax basis? If pre-tax is 15% means take 15% ka 1 minus tax rate you do. What is the tax rate in this problem? 30%. 0.3. How much is this? 10. I'll take this number as it is. 15. 15 ka 0.5. How much? 10.5%. So opportunity cost on an after tax basis is how much? On a post tax basis, it is 10.5%. Are we good with this, sir, everybody? Any number, if you want to get on after tax basis, you simply do 1 minus tax rate. If you want, I can just quickly write here. Let's say profit before tax. Profit before tax is 100. Maybe I just. Profit before tax is 100. Let's say tax is 30%. Tax is 30%. So how much is the tax amount? 100 ka 30%, which is 30. So what is profit after tax? 70. Correct? Now instead of doing like this, if you want to get PAT, if you got to get any number on an after tax basis, what did I say? Take before tax wala number. What is before tax wala number? 100 into 1 minus tax rate you do. What is tax rate? 30%, which is 0.3. So calculate this. 100 into 0.7. How much is that? 7. Oh, after, yeah. 70. Are you getting different number or same number? Same number. This is a shortcut to calculate after tax wala number. If you want to get any number on an after tax basis, simple is take a number on a before tax basis and multiply what? 1 minus tax rate. Yes. So opportunity cost return also we want it on an after tax basis, but they gave it on a pre-tax basis. So pre-tax return is 15%, means post-tax return will be 15 into 1 minus tax rate. How much is that? 10.5. Comfortable? So this we will take for our opportunity cost ka calculation. Any doubt? No. Okay, look at this. 50% and 80% of the customers in terms of sales revenue are expected to avail cash discount under existing scheme and liberalized scheme. Under current scheme, how much of percentage of debtor will go for discount? 50%. Under new scheme, 80%. This will help us to calculate the discount. So let's calculate. 50% of what? 50% of what? Sales. Currently, what is our sales? 12 lakh. Will 100% on sales, will the discount be offered or only 50%? Under existing policy, only 50% debtors will go for discount. Calculate 12 lakh. 12 lakh is current sale. Only 50% of them will go for discount. How much is that? 6 lakh. 6 lakh is what discount or sale amount? Sale amount. How much is the discount we are giving currently? 1%. So calculate 1%. How much is that? So the existing discount is how much? 6,000. Existing policy ka discount is 6,000. Done now. Under new policy, what will be the discount? Under new policy, how much is the sales? 16 lakh. Okay, let's calculate. Under new policy, the sale is 16 lakh. Under new policy, 100% of the debtor will go for discount or 80%? So 16 lakh ka 80% you calculate. What is this amount? 12 point something. That is discount amount or sale amount? So we'll give how much discount under new policy? 1% or 2%? Under new policy, we will give 2% discount. So multiply 2%.
25,600.
25,600. 6,000 and 25,600 is a discount. I've fit in here. Check. 6,000 and 25,600. This is your discount. Easy G. Okay, sir. Again, tell me the format once again. Sales. Point number 1, sales. Point number 2, variable cost. Got it. Fixed cost. Point number 3, not there. 0. Then total cost excluding bad debt. How do you get total cost excluding bad debt? Variable cost plus fixed cost. These two addition. Here it will be same. Okay, then 3 components. Bad debts, discount, collection expenditure. These 3 maximum can come. In this problem, bad debts is there, discount is also there. Bad debts we got it, discount also we have got it. Now from income, if you reduce all expense, you will get profit before tax. Okay. Reduce the tax, you will get profit after tax. Okay, G. The last one is opportunity cost. Can we calculate opportunity cost? Now, opportunity cost, will you calculate on sale value or total cost? Total cost. But to calculate opportunity cost, we want to know for how many days our fund are getting blocked. Under our existing policy, what is the average collection period? 30 days. But in our new policies, the average collection period under new policy will become 20 days. That means under our existing policy, funds are getting blocked for 30 days. Under new policy, fund is getting blocked for 20 days. So let's calculate this. And opportunity cost ka rate, what they give is 15%. This 15% is after tax or before tax? 15% is opportunity cost ka investment return on a pre-tax basis. On a post-tax basis, how much is it? 10.5. Okay, let's calculate opportunity cost here only. How do you get opportunity cost under existing one? First take total cost excluding bad debt. What is the total cost excluding bad debt? 9,36,000. Okay. Into 15% will you do or 10.5%? After tax return, that is 10.5%. Multiplied by what? How many days funds are getting blocked under current scheme? So are they asking us to take 360 days anywhere check? Yeah, assume at the end where they told, assume 360 days in a year. So funds are getting blocked for 30 days. So into 30 divided by 360, how much is that? 8,000? 8190. Okay, this is under the existing. Can we calculate opportunity cost under the new scheme? So what is the total cost excluding bad debt under new policy? 12,48,000. So let's calculate 12,48,000. This 12,48,000 money is getting blocked. So that means are we getting the return or we are sacrificing? How much return are we sacrificing? 10.5%. For how many days under new scheme the fund is getting blocked? The new scheme fund is getting blocked for 20 days. So into 20 divided by 360 you do. 81907280. 81907280. From PAT, if you reduce opportunity cost, you will get the net benefit. If they don't ask incremental benefit, stop here only. If they ask incremental benefit, what you will do? Existing policy ka benefit is 159. New policy ka benefit 198. Compare these two. This existing ka is 159. New ka is 198. Means is new policy giving extra benefit? Yes. Yeah, compare these two. How much is that? 38,990. You are getting extra benefit in new policy. That only we call it as incremental benefit. Now tell me, follow the continue with existing policy or go for new policy? New policy. Why? One, net benefit is highest or incremental benefit is positive. Something like that you can say as a decision rule. Or simply you can write except new proposal. Got a fair idea about this question now? This is another type of question. Done. I think we have one more. I think I would like to do that. This one. Question number 30. Slow payers. Study material question. Same on this concept only, one more. Slow payers are regular customers or good dealers. Okay. So that means this is our data. Maybe we are working from good dealer. This is us and we have a customer called slow payers. Like us. We have become a little slow now. No? 6 o'clock almost. We are slowly reaching that Buddha zone. No? Enough, sir. One more hour. Excuse me. They have approached the sellers for extension of credit policy. First of all, they are paying slow. Now they want more credit. Crazy people. On an analysis of past performance and on the basis of information supplied, following pattern of payment schedule emerges with respect to slow payers. What is this slow payer doing? This is pattern of payment. By the end of 30 days, how much will they pay? How much ever we bill, 15% of the billing amount they pay within 30 days. 34% of the bill they pay within 60 days. 30% of the bill amount they pay within 90 days. 20% of the bill they pay within 100 days. Add all this. 15 plus 34 plus 30 plus 20. How much is that? 99. What happened to that balance? 1%. Non-recovery. Non-recovery means bad debts. 1% they will not pay. That is bad debt. Indirectly they are telling 1% is bad debts. Okay. Now, slow payers want to enter into a firm commitment for purchase of goods of how much? 15 lakh. We are purchasing means we are selling. So we can sell how much goods worth to them? 15 lakh. Okay. All right. The selling price per unit is how much? 150. What profit is how much? 5. Sir, from the selling price, if you reduce profit, what are you going to get? You'll get the total cost. What is the total cost? Selling price is 150 and profit is 5 means the total cost will be 150 minus 5, which is how much? 145 per unit. Agreed? So let's calculate. Let's do it up there only. First, sales is how much, people? 15 lakh. So sales is 15 lakh. Now we need to analyze, should we give them more credit? Here we don't have multiple policy. Okay. Under this particular scheme, should we sell them or not? That's a decision making here. So if you sell, how much sales will happen? 15 lakh. So what is the variable cost here, people? Tell me. 145 per unit. total sales is 15 lakh. What is the selling price per unit? 150. So that means how many units? 15 lakh divided by 150. If you do, you will get the number of units. And each unit ka variable cost is how much? 145. Multiply. How much are you getting? Understood this now? 15 lakh is the sale value and selling price per unit is 150. So if you take total sales divided by the selling price per unit, you will get the number of units. And what is the cost per unit? Cost per unit is 145. So multiply. What is the cost you said? 14 lakh 50,000. Done, Aji? Okay. Next, what else data they have given? It is anticipated that the good dealers, that is us, by taking up this contract would incur an extra recurring expenditure. How much? 5,000. If you go ahead with this deal, then we'll incur a recurring expenditure. How much? 5,000. So it is fixed cost, or fixed cost is also one same number is same, no? So fixed cost or recurring expenditure is how much is that? 5,000. This we found out, or it is given in the question? Given in the question. Okay. Other than that, what else is there? If opportunity cost of funds in the hands of good dealer is how much? 24%. Have they told 24% is before tax? No. Okay. Here, moreover, I think tax rate only not given. So analyze, basically you need to analyze and tell, should we make a sale of 15 lakh worth of goods to this particular data? And we have to assume how many days in a year? 365. So calculate. What is the format again? Sales. That we got it. Next. Variable cost. We got it. Recurring cost, they only gave how much? 5,000. So total cost excluding bad debt is how much? These took a addition, which is how much? 14 lakh. Okay. Why do we need this? For what calculation? Opportunity cost calculation. Then bad debt. Bad debt, collection expenditure, discount. Collection expenditure, discount is not there. Bad debt, we already know it's 1%. 1% of sales. 15 lakh ka 1% is how much? 15,000. That is your bad debt. So from income, reduce all expense, you will get profit before tax. We read the problem. Is there any tax rate? No. Tax is 0. So profit after tax is also same. Clear? Then the last one. What is the last one? Opportunity cost. But here, this is the crux. For opportunity cost only, we are doing this particular problem. Sir, tell me, opportunity cost, how do you normally calculate? Normally, how do you calculate opportunity cost? Total cost excluding bad debt, fine. Multiplied by rate, that is also given, not a problem. Multiplied by collection period. Here you have one collection period or 5. Some amount you will collect within 30 days. Some you will collect 60. Some you will collect 90. Some you will collect 100. That means one collection period of 4. Bad debt you will not collect at all. So you can't do anything about that. Right? But you have one collection period of 4. Now how to calculate opportunity cost? That's the crux of this problem. Whole problem is on opportunity cost. Very simple. No? Each collection you treat it as a separate component and calculate opportunity cost. So here we'll calculate opportunity cost once or 4 times. 4 times. Then add them up. You will get the total opportunity cost. So calculate. Same. What is the total cost excluding bad debt? Here we got people. Total cost excluding bad debt is how much? 14 lakh. I'll maybe quickly do it here only. 14 lakh 55,000. Yes, sir. Correct. Entire 14 lakh 55,000 you will collect in one installment, or first you will collect only 15% of this. So calculate 15% of this. Yes, sir. Right. This amount is getting blocked for how many days? 30 days. That means how much return are you sacrificing? What is your return percentage? Where they told here 24% into 24%. Tell me people how much? 4,305. Like this we have to calculate once or 4 times. Each collection. Here this much money, 15% money is getting blocked for 30 days. So calculate that. Okay, same way calculate the other one also. Tell me the calculation. Total cost excluding bad debt is how much? 14 lakh 55,000. Next you will recover how much money? 34%. So calculate 34% of this. How much is that? Some amount. Okay. Now this amount is blocked for 30 days or 60 days? 60 days. So into 60 divided by 365. That means you are losing out 24% return on this. So calculate. 9,000? 19,005? One. Tell me one. I know different brand calculator. It can happen. But tell me one number. 19,000. 517. Okay. Next, the same calculation. Total cost excluding bad debt, 14 lakh 55,000. How much money is getting blocked here? 30%. For how many days it is blocked? 90 days. So into 90 divided by 365. So how much return are you sacrificing? 24%. 20? 830? Okay. Last, 14 lakh 55,000 ka. How much percentage is getting released? 20%. This 20% money is getting blocked for how many days? 100 days. Into 100 divided by 365 into 24%. How much is this? 19, no? 19,134. Sir, what about bad debt? Okay, bad debt you want to calculate. Okay, let's calculate. 14 lakh 55,000 ka 1%. How many days? See, that is collection period. Bad debt means you are collecting or not even collecting. So on this, you cannot calculate opportunity cost. Opportunity cost means for how many days funds are getting blocked. Bad debt means it's permanent block. No? So on this, you don't have to calculate. Add all this, that is your opportunity cost. How much is that? Add all of this total. 68,787. 787. That's your opportunity cost. Okay, people. That's what somewhere close enough number I would have taken here. 68,787. For opportunity cost, I've done a separate working note here. Clear? That's about this particular question. Okay. Fair enough. We have done 3 questions. So I think even if some adjustment comes tricky here, at least other part you can take care of. Format is there. So at least if you put that up, instead of maybe 6 marks, maybe you will get 2 to 3 marks you may get for the other things. So focus on that. Even in new adjustment, some of the things will be existing. Existing part at least try to do it properly. So some marks let's try to capture. Okay, this is done. Next type of question is when it comes to debtor management, 2 types of problems I told can come now. One is evaluation of credit policy. Another one is factoring. Lately, factoring has gained a lot of importance. A few questions. Earlier, we hardly had any questions on factoring. Of late, a lot of RTP, MTP, and factoring questions have been added. Maybe that's a signal that you can expect factoring questions to turn out more. Could be, we don't. First, we'll understand what is the meaning of factoring. Then for factoring also, we have made a format. 1 or 2 questions we will solve based on the time. Then more or less over. Okay. All right. So let's go for this factoring first. What is this factoring? Okay. So factoring ka meaning is, let's say there is a company A Limited. They have sold goods to debtor totally worth 50 lakhs. To many debtors they have sold. Let us say credit period is 90 days. That means A Limited will recover this 50 lakh now or on an average after 90 days. After 90 days. But A Limited wants funds. They want a fund. Can they ask the debtor to pay early? We can ask, but will they pay? They will say, "Poda day, I will pay only after 90 days because you have given me 90 days credit. I would like to utilize it fully." But A wants money. So now factoring could be an arrangement through which A Limited can get this money. So what happens in factoring arrangement is, what is this debtor value? 50 lakh. Whose debtor is this? A Limited ka. So what A Limited, the original seller, will do over here is, this debtor, they will sell it to an entity called factoring entity. This debtor only, they will sell to an agency called what? Factor, or to an entity called factor. Okay. And factor will pay the money to A Limited immediately. A will sell their debtors to an entity called factor and factor will pay the money to A Limited. What is debtor value? 50 lakh. Factor will not pay full amount. Factor may say, I will only pay 45 lakhs. That is a negotiation. Amount could be 47, 48, whatever is the number. Let's assume factor paid immediately to A Limited how much? 45 lakh. Now think from A Limited perspective. The amount A Limited would have recovered after how many days? 90 days. But because of factoring, A Limited got the money immediately. Okay. Then what will happen is, how much credit period is there? 90 days. So factor will wait. Now, factor now will follow up with debtor and collect the money from what? Debtor. Or rather, debtor now will pay A Limited or debtor will now pay factor. Now, debtor will pay all their money. How much money? 50 lakhs. To whom? Factor. Now or over a period of 90 days? Or after 90 days? Yes, sir, people, this is the arrangement of factor. So, what is the benefit? For debtor, is there any harm? Debtor had to pay 90 days. Originally, debtor had to pay after 90 days how much money? 50 lakh. To whom? A Limited. Instead of paying A, now debtor will pay the factor. So, debtor is a neutral party. Instead of paying A, now they are paying the factor. What is the advantage of A Limited here through factoring? Can you tell me what is the advantage for A? A, instead of recovering the money after 90 days, they were able to recover this money immediately. What is the advantage of factor? Factor paid how much? But factor is recovering how much? 30 lakh. That difference will be factor ka commission. That's the win-win for everybody. This will vary, okay? I've just assumed for simplicity purpose. So this is the factoring arrangement. Any doubt? Now factoring arrangement can be of two types. With recourse, without recourse. With recourse, without recourse. With recoursing means going back. Recoursing as in going back. With the without, it's a negotiation. Alright. In the exam, always assume it is without recourse in absence of information. Okay. I should not forget, so I'm telling you first only here. Okay. In exam, if they don't mention whether it is with or without, always select by default what? Without. Okay. That's ICA, a normal assumption which they make. But let's understand the meaning. If it is with recourse factoring, what will happen is, with recourse means going back. Suppose after 90 days, debtor does not pay the factor. Debtor defaults. After 90 days, if debtor does not pay the factor, if it is with recourse factoring, what will the factor do is, factor will go back to A Limited and recover the money. How much money? 50 lakh. If debtor does not pay the factor, what will the factor do? Factor will go back to the original seller and collect the money. How much money? Full money, 50 lakhs. Okay, na Sarji? If this is the arrangement, means we call it as what factoring? With the recourse wala factor. Okay. That means ultimately you tell in with recourse factoring, who is bearing bad debt risk? If debtor defaults, factor is bearing bad debt risk or A Limited? A Limited. That is what I'm telling you. In with recourse factoring, bad debt risk is with whom? Original seller. If you know that, tell me if it is without recourse factoring, what will happen? If it is without recourse, it means if debtor does not pay the factor, then can factor go back to A Limited or they cannot? They cannot. They cannot. That means who will bear the bad debt risk here? That is without recourse factoring ka arrangement. Fine. So whether it is with or without, it is a negotiation. But for examination, we will always take what? Without recourse wala factoring. That's the overview of factoring. Did you understand the meaning of factoring, how it works? One way of factoring is you can sell the debtor. Another way of factoring arrangement is instead of selling, you can make your factor collection agent. Instead of selling the debtor, you can make the factor collection agent. See, now we'll have one debtor or many debtors. A company may think following up with each debtor and collecting the money is a big headache. Company may tell the factor, you collect on my behalf. You remember in movies and all you must have seen. When bank gives loan, bank will send gundas. If the loan default happens, bank will send all those big mustache gundas. Right? Will bank manager go and collect the amount? If bank manager goes and collect the amount, the bank manager will not be able to collect any money. But if one bring hattak puttak gunda goes, then instead of 10 lakh loan, you can collect 11 lakh also income. Yes or no? So you can make factoring. Instead of selling debtor, you can make the factor your collection agent also. That's another way in which you can use factoring arrangement as well. But in our most problem, it will be a sale wala case. Okay, sir. Now, how is this relevant in examination context? As a finance manager of the company, you need to tell, should we go for factoring or not go for factoring? This is evaluation of factoring wala problems. As a company, should we go for factoring or should we not go for factoring? That is a type of problem we are about to solve. Got the funda, people, or meaning, everybody? Now, factoring arrangement will have some benefit also. It will have some cost. It will have benefit also. Suppose factoring ka benefit. One benefit is, if it is without recourse factoring, A Limited will bear the bad debt risk or it is passed on to the factor? If it is without recourse factoring, who will bear bad debt risk? Factor. Who is the seller? A. Ideally, who should bear that bad debt risk? A Limited. But is A Limited bearing or factor bearing? So because of factoring arrangement, one benefit you are getting, which is what? Savings in bad debts. Yes, sir. So that is a benefit. Suppose savings in bad debts is 10 lakh. Just a random number I've assumed. Savings is how much? Savings in bad debts, which is a benefit, I've assumed it to be 10 lakh. This is the benefits due to factoring. At the same time, factoring arrangement will also have a cost. Look at this example. Tell me what is the cost? Commission. How much commission? 5 lakh. Okay. That means you tell me, sir. Benefit is 10 lakh. Cost is 5 lakh. That means are you getting net cost or net benefit? What is a net benefit? Now you will reject factoring or accept. So if this net benefit is positive, then you will accept. If it is negative, reject Allah. You'll have to do further analysis. Okay, na? If it is positive, straight away what? Hey, positive. If the net benefit is positive, straight away accept. If it is negative, we'll have to do further analysis, which I tell you in the form. Okay, people. For factoring also, I've made up a format. I'll show you that. 1, 2. These two formats we'll use for factoring. Okay. I'll go through this. Carefully watch out over here. All the contents may not come in the problem. I've just brought all sorts of contents over here. Let's see. First, it's better learn through numbers, but once I will discuss the format with you. Maybe 1 or 2 more problems. Maybe we will discuss the same format once again. What is that? Is first, what are we selling to our factor? As an entity, what are we selling to our factor? Debtors. First find out the debtors. They will not give you debtors. They will give you credit sales. From credit sales, how do we get debtors? Tell me. Suppose credit sale is 10 lakh. Credit sale is 10 lakh. Annual credit sale is 10 lakh. That means this 10 lakh is a data for how many days? 365 days. Will we give 365 days credit to our debtors or lesser? Suppose debtors ka credit period is 30 days. For 365 days is the value 10 lakh, means for 30 days what is the value? Proportionate. How do you get X over here? 10 lakh into 30 divided by 365. Some number you're going to get. 80? 180 to 192. Fine. I'm not interested in number. But are we comfortable with calculation? Tell me this is formula. What is this 10 lakh? Credit sale multiplied by 30. 30 is your collection period. Actually, first priority you should give it for factoring period. Okay. They'll mention in the problem. If factoring period is missing, then you'll always go for collection period. Check this. In the same order, whatever I've written, write in that fashion only. Factoring period, first priority. If it is not given, average collection period. In one of the problem, when it comes, I'll tell you. Divided by what? 365. If the data is given in days, you will take 365. If it is months, 12. If it is weeks, 52. This way you will get what? Debtors. Are we comfortable? Okay, sir. Let's say debtor value, you got it as 5 lakh. Debtors value, you got it as 5 lakh. Assumptions. I'm taking a smaller number for a round off number for easy purpose. Now, will factor give full amount or there will be some commission? Let's say commission is 10%. Commission is 10%. So calculate 5 lakh at 10%. How much is that? 50,000. This will be deducted. Okay. That means factor will pay 5 lakh or 450. 450. In some problem, they will say factor wants to withhold 5% as reserves. How much as reserves? It could be anything. 5%, 10%, 20% or whatever. How much is your debtor value? 5 lakh. How much factor wants to hold as reserve? 5%. So calculate 5 lakh ka 5%. How much is that? 25,000. That means factor is ready to give how much advance to us. How much is amount is the advance in this problem? 4 lakh 25,000. Any problem? Everybody good? This 50,000, how did you calculate? Tell me. How did you calculate 50,000? 5 lakh ka 10%. How did you get reserve amount? 5 lakh ka 5%. Tell me that in formula. 5 lakh is what? Debtor. So debtors ka, if you multiply commission, A is your debtor amount. Okay. A ka rate, commission rate, if you take, you will get commission amount. Then debtors ka, if you multiply reserve percentage, you will get the reserve amount. So this is the amount ready for advance. Okay, sir. In some problem, they will also say, in fact, this will be there. There will also be an interest. Factor will not only collect commission, they will also collect some. Because factor is giving the money early, no? So in a way, factor is giving a loan to us. Because then are we getting the money after a normal credit period or earlier? Earlier. Since we're getting the money early, factor may charge commission also, factor may charge interest also. That's based on negotiation. But in all our examination problem, this will be there. Okay, sir? Now, let us say interest rate is 10%. Interest rate is how much? Or maybe we'll take it as 8%. So calculate. Interest rate is 8%. How do you calculate? How much is the amount of advance factor is ready to give? 4,25,000. This is your loan amount. Into interest rate. Interest rate is how much? 8%. But 8% is per annum. 8% is per annum. Now, people, you'll calculate for whole year or what? Factoring period. Suppose factoring period is 40 days. Then you'll do what? 40 divided by 365. That's what I've written over here. I'll tell you in problem over here once more. Okay, I'm just giving you an extract. Instead of orally calling out the format, I'm just giving some numbers. Why we calculate this way, I'll tell you in numbers little better. Okay, sir? So how much are you going to get here, people? 425 ka 8% into 40 divided by 365. How much is that? Huh? 20? 26,000. Huh? 3,000? 3726. Okay. Now what happens in factoring arrangement is whatever expense, every expense will be fully deducted and net amount will be advanced. So factor will not give 425. They will deduct interest also. After deducting interest, how much money remains? From 425 deduct 3726. How much money remains? 4 lakh? 4 lakh 21? 274. This is the final amount of advance factor will give it to us. So this is the amount advanced by the factor. Clear, people? This is one working note we need to do. How much is the advance amount given by the factor? Sir, same factoring question they can ask in MCQ also. In MCQ, they can say how much is the amount advanced by factor. So you'll select that option with 4,21,174. Okay. They may ask you interest amount. So you'll select this option with this amount like this. So same data they can be asked in multiple MCQ questions. This is working note number 1. Any problem here? Same thing we'll do it in next, but I wanted us to be a little more comfortable. Done now. Now we need to put up one statement called evaluation of factoring proposal. So this is where we are trying to find should we go for factoring or should not go for factoring. As I told, how do you decide basically? How do you decide? First find out all the benefit, deduct all the cost, and then you will get the net benefit. If the net benefit is positive, straight away what you will do? Accept. If it is net benefit is negative, if it is negative means it is net benefit or net cost? Net cost. Then you'll have to do further analysis. Finding that is this particular statement. Finding the net benefit or net cost is what we are trying to do in this exercise. But keep in mind, every number in this particular statement has to be annualized. Has to be on an annual basis. Factoring period could be 30 days, 40 days, collection period could be 50, 60, whatever. But any number that you show in this working note always has to be on what basis? Annual basis. Why? Again, I'll tell you in one of the problem. Leave that for the time being. Okay. So first you'll have to call out all the benefit. What are the benefits that can arise due to factoring? One, we can save some bad debts. Agreed? Okay. Because we are always assuming that factoring for examination is what sort of factoring? Without recourse. We are always assuming that it is a without recourse factoring. So we as a seller should bear the bad debt risk or we have passed it on to the factor. So hence we have saved our bad debt loss. So that's a benefit for the company doing factoring. This is one of the benefit. Second one. Now you tell me in our example, should A Limited now follow up with the debtor and collect the money or we don't have to do this? See, if the company has to follow with the debtor means they need to have a person for it, right? And that means that person we have to pay salary. All this A Limited will have to do now or not required. It means all this administrative cost company will incur or they will save. Because now we don't have to follow up with the debtor at all. Who will follow up and collect the money? Factor. That means all this administrative cost we can save. That's a benefit for us. That's the second one. Savings in administrative cost. So savings in bad debt, savings in administrative cost. Done na, Sarji? Everybody good? This one I'll tell you in problem, maybe after one problem, leave that. Okay. So these, usually we see only these two. This is very rare. Okay. This is your benefit. Adding all this, you'll get the total benefit. But do remember, all this number are on what basis? All number are on a annual basis. I've written here everywhere. Okay. Every number is on a annual basis. Only benefit you will have, or you also have cost. Two costs you have already identified from previous working. Tell me, what are those? Two costs. Commission, no interest. Don't say reserve. Reserve is amount withheld now. Factor will give it to you later. For the time, reserve means for the time being factor is holding. Later they will release. So this is not cost. Commission and interest. These two are cost. But commission and cost, no, you have incurred for the factor period. Now we have to take factor period or annualized basis. So this commission which was there for the collection period, we have to get it on what basis? Annual basis. I'll tell you in problem how to do that. So you have to take annual commission and you have to take annual interest. How to do it? I've just written it here. Leave that. Better we'll learn it through numbers. Very straightforward. This is done, sir. Sometimes they will say due to factoring there is some other cost. It will be given to us in the problem. Any other cost, if it is there, it will be mentioned in the question. Copy that. So these are the three costs. Okay, na sirji. So from total benefit, if you reduce total cost, you will get what, sir? Either you will get a net annual benefit or you will get net annual cost. If it is net annual benefit, what you have to do? Reject or accept factoring. If it is net annual benefit, straight away you accept factor. If by chance, if it is a net annual cost when it will come? When benefit is more than cost or benefit is less than cost? If benefit due to factoring is less than cost of factoring, that scenario will create net annual cost. If it is net annual cost, we will not reject. We find something called effective cost of factoring. We find what? Effective cost of factoring. This is in percentage. How do you get effective cost percentage? Is net annual cost divided by amount advanced by the factor. Once more, what is that? To get effective annual cost percentage, we take net annual cost. Previously you calculated net annual cost, no? Take that number and in working note number 1, we have amount advanced by the factor. Divide that, you will get the effective factoring cost. Okay. Then you will do some analysis. Again, this also I will tell you in problem. Leave that. Okay, people. First one basic question we will take, then we will derive all this. Can we review a couple of questions on factoring? No. 1 minute. And I know that some of you may still have reservation. We'll take up a question that should help you sort out few things. This is MTP May 24 question. It is there in our class notes also. Factoring question. So let's see what we can take away from here. NV Industries Limited is a manufacturing industry which manages accounts receivable internally by sales. Okay. It supplies small articles to a full story they've given. What is the total sales, people? Sir, in factoring we are selling debtor. Debtor will come with respect to total sales or credit sales. Total sales is 200. How much is credit sales? 80%. So calculate. How much is credit sales? 200 ka 80%, which is 160 lakhs. So credit sale is 160 lakhs. $200 lakh ka 80%, which is 160 lakhs. Okay. Company has a credit policy of 2/40 net 120. Now you tell me, what does that mean? 2% discount if paid within 40 days. Else normal credit period is 120 days. That's the normally what we have currently what we are following. Past experience of the company say that average 50% of the customers will go for discount. That means other balance 50% will pay within 120 days. 50% of a customer will pay, they want to go for a discount means they will pay within 40 days. Other 50% will pay on 180 days. Stop there only. Average collection period you tell. Some problem hai, average collection period they will give. Some may we have to calculate. Here you calculate average collection period for me. They have not given. Average collection period, I'll call it as ACP. How do you calculate? Very simple. 50% of our customer wants discount. That means they have to pay within how many days? 40 days. Correct now? Yes. And another 50%, do they want discount or they don't want? They don't want discount. If they don't want discount, they will pay us now or after 120 days? 120 days. So calculate this. 50% of 40 is how much? 20. 50% of 120 is how much? That means your average collection days is how much? ACP. Okay, sir. current policy mein our collection period is how much? 80 days. Some problem is they will give this. If they give it, take it. If they don't, we have to calculate. Here, sir. Any problem? I've calculated here once again. Okay. All right. So let's go further. Finance controller estimates current bad debt loss how much? 1%. Currently, we are incurring 1% of credit sales as bad debts. Okay. Now let's read further. With escalating cost associated with in-house management of debtor, blah, 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 blah. Management, CFO is now saying we are going for what? We want to go for. CFO is thinking, why don't we go for factoring? Now, terms of factoring they've given. Firm currently spends 2,40,000 as administer the credit sales. To follow up with our debtor, currently how much admin cost we are incurring? 240. After factoring, we'll incur this or we will save this? And this is 240 on what basis? Per annum basis. Keep that in mind. These are avoidable. Because after factoring, we don't have to follow up. Who will follow up? Factor. So this is the benefit. Agreed? Okay. And one more benefit is there, which is what? Bad debt we will incur or we will save. Save. That is another benefit. Okay. These are avoidable as factoring firm is prepared to buy the firm's receivable. Okay. The factoring proposal ka main elements are factor will charge how much commission? And it will pay advanced against receivable, and there is also interest. What interest rate? 18%. When they say percentage, it is always on a per annum basis. Huh? This is the interest of 18% on a per annum. Is there any reserve? Yes. How much reserve? 10%. Okay, stop there only. First working note. What is first working note, people? Calculating how much money we got from the factor. Okay. How do you calculate that? Walk me through. First, what are we selling to the factors? Credit sales or debtors? Debtor ka amount given or not given? Not given. But how much is credit sales? We already got. Total sales is 200 lakh. Credit sale is how much? 80%. So this is annual credit sales. Keep that in mind. Yes, sir. This is annual. Total sales ledger means annual. Annual credit sale is how much? 160 lakh. Have they told 360, 365 anywhere? They're saying take 1 year as how many days? 360 days. Okay, very simple. Oh? This 160 lakh is a number for how many days? 360 days. But what is your average collection period? Just now we got. For 80 days, what is the value? Okay, now. So 160 lakh is the amount for 360 days. But on an average, your debtor is outstanding for how many days? 80 days. Your collection period is 80 days. No? If you don't collect the money, then only you will call it as what? Debtor. So 80 days, how much is the value? Calculate this. 30? 160 into 80 divided by 360 you do. How much is it? 35 lakh 55,000 triple. That is the value of debtor we are planning to sell to the factor. Agreed?
Yes.
So first working note you already know. Our first working note is ACP. Average collection period. If they give, no need to prepare this working note. Otherwise we need to prepare. Point number 1. Working note number 2. What are we trying to calculate in working note number 2? How much money we will collect by selling our debtors to the factor. Amount advanced by the factor is what we call this. So debtor amount is 35 lakh. Everyone is clear with how to calculate debtor? We'll use what as a basis? Credit sales. Because debtor will only arise with respect to the credit sales. Credit sale is 160 lakh, but 160 lakh is for whole year, 360 days. But average collection period is only 80 days. For 80 days, what is the number? Done now. But will factor give this or there is commission? How much commission? 2%. So calculate 2% of this. 2% commission, 10% reserve. Here they told. I'll show you once again if you want. 2% commission, 10% reserve. 2% of this number is 71,111. Agreed? Same. 10% of this number how much? Reserve will be calculated on debt. Commission and reserve both are calculated on debtors amount. Calculate. Okay. By reducing all this, will factor pay this or deduct and pay the balance? This we call it as amount available for advance. Reduce all this. Your calculator should show this. That's it, or there is interest also. Now calculate the interest. How much is the loan amount? 3128 889. How much is the interest rate they told in the problem? 18%. Okay, now calculate interest. 31 lakh 28 889 is the amount to into interest rate multiplied by first priority factoring period. Have they told anywhere in the problem factoring period is 45 days, 50 days? If that is not given, you calculate for collection period. What is the average collection period? 80 days. And they're asking us to consider 360 days in a year. So calculate interest for this 80 days. 18% is for whole year. For 80 days, how much? 1,25,156. Any problem in this? Anybody? Now, why do we calculate this? Very simple. Sir, factor now took up the factoring responsibility. That means factor will get the amount from debtor now or after 80 days. Collection period is how much now? 80 days. That means factor has to wait for how many days to get the money? 80 days. Yes, no? That means for a factor, fund is getting blocked for how many days? 80 days. So will factor let go of this or recover that from you? Factor will recover from you as what? Interest. Hence we take 80. Because for factor, fund is getting blocked for 80 days. Suppose factoring period, if they give 40 days, means now money is getting blocked for 80 days per factor or 40 days only. Hence first priority, we always give it for what? Factoring period. If it is not there, you will take what? Average collection period. In majority of the problem, factoring period will not be given. So you will calculate based on what? Average collection period itself. Then sir, this interest factor will collect later or now only. So from this amount, interest also will be deducted, and finally, how much amount factor will pay us? 30,03,733. This is working note number, or this is this particular working note ka feature. Any doubt or okay? Give me a walkthrough of this. What is that? Tell me. First, we'll calculate what? They're confused. Remember, what are we selling to the factor? Debtor. First, find out debtor. They will not give debtor. So use what as a basis to calculate debtor? Credit sale. But credit sale will be for the whole year. For average collection period, how much is the debtor value? Prorate and find out debtor. Then reduce commission, reduce reserve. Straight away calculation. Okay, people. By doing that, you will get amount available for advance. But will this amount factor give or also interest? This amount interest will be calculated for what period? Factoring period. If factoring period is missing, we will use average collection period. Reduce interest also, and finally this is the amount factor will give us. Okay, sir. This is working note. Now is the next statement. Statement comes under the evaluation. What are we evaluating? Factoring proposal. Meaning, should we accept factoring or should we reject? So what I told in evaluation statement, everything should be on what basis? Annual basis. So due to factoring, there will be some benefit also, there will be some cost. It's better show all the benefit in one section. Show all the cost and separately in another section. I say a suggested answer will be like this. Better if you show it in that fashion. If you show one benefit, one cost, nothing wrong, but it's okay. Let's make the evaluator's job a little easy. Now, two savings we have identified. Can you tell me what are the two savings? One, you can save administrative cost. Administrative cost is already on per annum basis. How much? 2,40,000. Savings in administrative cost is 2,40,000. Got it? That's it, or even bad debts. Because we always assume factoring is on what basis for problems? Without recourse. By default, whether they mention or don't mention. In fact, if they don't mention, we'll always take it as without recourse factoring. So we as an entity, as a seller, should bear the bad debt risk, or we have passed it on to the factor. Passed it on to the factor. What is our annual credit sales? What is our, see, bad debts will come on total sales or credit sales. What is the annual credit sale? 160 lakh. What is the current bad debts? 1%. So calculate. 160 lakh ka 1%. How much? 1,60,000. Sir, this 160 lakh is annual credit sale. That means bad debt also what you get is on annual basis. If you take annual credit sale and multiply 1% bad debt, you will always get the annualized bad debt. How much is that? 1,60,000. Done, Sarji? Any problem? Or good? This is your savings. That's it, or there will be some cost also. Now tell me two costs we have identified. What are those? Commission, no? Interest. But hang on. Commission you calculated on debtor. Debtor is for 360 days or 80 days? 80 days. But that means this commission is not for 360 days. It is for 80 days. But every number in the statement we want on what basis? Annualized basis. So 71,111 is the cost for how many days? 80 days. For 360 days, how much is the cost? Proportionate. 71,111 is on which platform? 80 days ka platform. For why 360? Because question told us to assume there are 360 days in a year. So multiply by 360. How much is that? 3 lakh 20,000. That is your annualized factoring commission. Easy. Everybody good? I'll tell you why we do this, but so far are we good with the numbers? Next, same interest also you calculate. But this interest what you calculated here is for whole year or 80 days? Now, 1,25,156 is on which platform? 80 days. But we want it on 80 days or full year platform? Full year in this problem has how many days? 360 days. 125,156 into 360 by 80 you do. How much are you getting? That is your annualized interest. Okay, Sarji. Anything else? Any other cost have they given or nothing? Nothing. So total benefit is these two. What is the addition of these two? Admin, bad debt saved 160, admin saved 240. So total benefit is 4 lakh. There are two costs. Addition of these two you do. Adding of this, it's a total annual cost is 8,83,202. Okay, people. Total annual cost. Total annual savings is how much? 4 lakh. Total annual cost is how much? 883. That means this is a net annual benefit case or net annual cost case. Benefit is 4 lakh, cost is 8 lakh. That means it is a cost only is more. So it's a net annual benefit or net annual cost. If it's positive number, net annual benefit. If it's a negative number, net annual cost. I'm simply doing A minus B. A is your total benefit, B is your total cost. A minus B you do if it is positive, benefit, negative, cost. You're getting a negative number. 4 lakh minus 883 if you do, you're getting negative number how much? 4,83,202. Agreed? Okay, once more, got it. This is what net annual benefit or net annual cost. Whenever you get net, see if it is net annual benefit, should you have to check further or automatically decision? If it is net annual benefit, automatic decision is except factory. Here net annual benefit or net annual cost. Whenever you get net annual cost in your problems, find out this is cost in amount. This is cost in amount. We want cost in percentage. We want cost in percentage. That only we call it as effective cost of factory. Effective cost of factory. Okay. How do you get this? The formula is very simple. Net annual cost divided by amount advanced by the factory. Do that. Net annual cost. How much is net annual cost? 4 lakh. Punch in this number in your calculator. Net annual cost is 483,202. Divided by amount advanced by the factor 30,03,733 into 100. We want it in percentage. How much is that? 16.08%. What is this? This is the net annual cost. The same cost, if you express it in percentage, you get it as 16.08%. Now, what is this formula? Very simple. You remember you used to calculate cost of debt, in capital structure problem. How you used to calculate? If it is irredeemable debt, there was an approximation formula. What was that? Interest into 1 minus tax rate divided by net proceeds. You remember this, huh? Interest, company was paying. Net proceeds, company was receiving. I told cost of debt ka, in fact, cost ka simple formula, payment divided by receipt. I used to tell this in many problems in question. Do you remember? Huh? Interest company pays. So that means the cost ka formula is what? If you want to calculate cost ka percentage, effectively it is what? Payment divided by receipt. So this 483 we are receiving or paying? Paying. But what did we receive from the factor? 30,03,333. Receiving this much money, we are giving how much money to the factor? We received 30 lakh and how much are we paying to the factor net mein? 483. So what is the cost? Then now. Or if you want it in another way, suppose you take a loan of 10 lakh. Interest rate is 10%. How much is the interest amount? 10 lakh loan, interest rate is 10%. How much is the interest amount? 1 lakh. Agreed? Okay, Sarji. Now, if I give you interest amount, if I give you loan amount, can't you find out rate? Tell me what is the rate ka formula? Simply you will do what? Interest amount divided by loan amount. Now, interest amount, if you take a loan, interest amount you will receive from the bank or pay the bank. That means interest amount is what? Payment. Loan amount, you are paying the banker or you receive. Loan you receive from the bank. That means what is the denominator? Receipt. So the simple way to calculate the cost percentage is payment divided by receipt. So what are we paying to the factor on a net basis? 483,202. What did we receive from the factor net basis? 30,03,733. So calculate that. How much did you get? 16%. Understood? That only we are expressing as formula. What is the formula? If you don't want all this logic, what is the formula? Simply net annual cost divided by the amount advanced by the factor. If you do that, you will get effective annual factoring percentage. Basically, this is the cost in amount. This is the cost in percentage. Why do we find this? Very simple. Suppose here in this problem, they have not told, or have they given? Let's see. Here actually they've given. Check. Company also has an option to take a long-term loan at what interest rate? 15%. If they want to take working capital loan, they will take, what is the interest rate? If they want to take a long-term loan, interest rate is 15. Working capital loan interest is 14%. Sir, factoring also is one way of raising money, no? Factoring also, what are we doing in factoring? Selling the debtor and recovering the money immediately. Yes, sir. So factoring is also a source of finance. One way to raise money. And this factoring is costing us how much? This factoring is costing how much in percentage? 16%. So if you go for factoring arrangement, you have to pay how much cost effectively? 16%. If you don't go for factoring, then you will take the loan from bank. Bank interest rate is how much? 14. This is debtor. Debtor ka more related number is what? Long term or working capital loan? What is bank ka working capital loan percentage? And that means you tell me, if you are finance manager, will you take working capital loan or will you go for bank factoring arrangement? Sir, factoring is costing us 16%. This is cost. Factoring is costing us 16%. Bank loan is only costing us 14%. So that means accept or reject. Accept or reject. Reject the factoring here. Fine. Now, why did we understood this analysis? Okay. Now, why did we get all this number on annualized basis? When you take a bank loan ka interest rate will always be on what platform? Annualized platform. Now, if you want to compare this with the bank loan, this number also has to be on the annual platform. That's the reason every number, first we get it on what platform? Annualized. So that's the reason if you take every number on annualized platform, then this cost also will be on what basis? Annual cost of factoring. This annual cost of factoring, you compare it with the bank rate. If factoring ka rate is greater than bank rate, means what you will do? Reject. Suppose factoring ka rate is 16.08%, but bank ka rate is 20%, then what you will do? Sir, if you take finance from factoring, it is costing only 16. If you take finance from bank, it is costing 20. In that case, you will reject or accept. This is a fund. Okay, Sirji. This they may give you factoring ka rate, bank rate, they may give you in some problem, they may not give. But either ways, you always stop your question here. If they don't give bank rate, you stop here. Done now, everyone. This is one sort of factoring question. Now, if you just check this MCQ question, check what else. See, this they gave it as a case study and asked 5 questions. First, check what have they asked. Average level of receivable. It will be there in which working note? Working note number 1, we found out debtor. Remember, what was our debtor we got? 35 lakh. This is what they've asked. What is the average level of debtors? What is it? 35 lakh, 55,555. So C, A for Alpha or B for Bengaluru, right option. Okay. Next, they asked how much advance factor will pay. How much advance factor will pay is there in which working note? Working note number 2. I think working note number 1 was ACP. In working note number 2, what was the final advance factor gave? 30 lakh 3,733. Which option has 30 lakh 3,733? C for Chennai. That's right. Or C for Coimbatore. Yeah. What is the annual cost of factoring? They did not say annual cost of factoring in percentage. I asked annual cost. But here also be careful. Did they ask net annual cost or annual cost? Annual cost means only the total cost. What is the total cost, people? Only adding these two. What is the total cost? 8,83,202. Read the question carefully. There will be this also as one option. Don't select of that Prabhu. This is net annual cost. They asked net annual cost or annual cost. Annual cost is these two addition, which is how much? 8,83,200 alpha. Then they ask net cost. Net cost means the final number. What is the net cost we got? 4,83,202. You can select the closest option. 4,83,200 is the closest option. D for Delhi. Then they asked effective factoring percentage. What is the effective cost of factoring? 16.08. Using the same thing, they've asked 5 different MCQ questions. Possible? Comfortable? I would like to do one more question on factoring with your permission. Can we?
Yes, sir.
Can we try? Okay. Another 15 minutes class will go. Another 5 minutes here, another creditor management, another 5 minutes. Overall 15-20 minutes is still there. Okay. Okay. This is a May 2024 exam question. No? Okay. 3,12,000 or what is that? 31,80,000. This is already there. Why we calculate interest? Hey, no, this is the loan amount, macha. Factor is ready to give this loan amount. On this, factor will also collect interest. On when bank gives loan, they will collect interest, no? So, if factor is ready to give this much amount, means on this they will calculate interest. Okay? Because factor ka money is getting blocked. For factor will give the money now and they will collect the money from debtor after how many days? 80 days. Since money is getting blocked for factor for 80 days, you have to calculate the interest for 80 days here. Okay, now NAVCA. Okay, done. Now come back to the next problem here. I think it's 80% will be same, but you remember first priority is ACP or factoring period. Factoring period. That and ACP will come into picture over here. So be a little careful here. Following is the information of Bright Limited. Annual sales is how much? 7.5 crore. In this annual sales, they told 90% is on credit. So what is credit sales? 7.5 crore ka 90%. How much people? Can I say 675 lakhs or 6 crore 75 lakhs? Okay. We'll read off the whole data once. Credit period is how much? 45. I don't want credit period. I want collection period, factoring period. Because no, see, we give now. We announced 6:30 we will end marathon. It's already 7 o'clock. Did we end? No. Now I'm saying another 20 minutes. After 20 minutes, I may say. Yes, no. That means what? You are interested in what? 6:30 or actual ending time? Actual ending time. We gave 45 days credit to our debtor, but are we collecting within 45 days or what is our collection period? So what we need is our actual collection period because our money is not getting blocked for 45 days. It is getting blocked for 70 days. Okay, na Sarji? So this is irrelevant. This is what we need to take. If collection period is not given, then we'll assume what? Credit period, collection period, both are same. But here they have given collection period 70 days. Fine. Bad debts, how much? Bad debt will come on total sales or credit sales? So credit sale is 675. 675 ka 75% how much? The 0.75%. 675 ka 0.75% how much? 5,06,250. Anyway, this number was on what platform? Annualized. I mean, this is bad debt is also annual bad debts. So we'll maybe fill out on that. Savings and bad debts on annual basis how much? 5,06,250. Straightforward. No? This is okay. Alright, next one. What is the next one? Administrative cost is how much? 18,60,000. If they don't mention, we always take it as admin cost is on a yearly basis. Fully you can avoid. If they don't tell anything, full we can avoid. But here check what they told. 2/5 is avoidable. Due to factoring, how much you can avoid? Only 2/5. So calculate. 18.26 ka 2/5. How much? 7,44,000 only you can avoid. So this is what? Cost of savings. Savings in bad debt, savings in admin cost. If that 2/5 was not there, means what we would have done? Entire 18,60,000 we could have taken it as savings. But here they've said 2/5 only is avoidable. Hence we took that particular number. Okay, this is done. Next check. A factor firm has agreed to manage company's debtors on what basis? Non-recourse. Any which way we will assume it as non-recourse means without recourse. Service charge. Service charge is nothing but commission. How much commission? 2%. Factor agrees to grant advance against debtor but charging how much interest? 14% interest. How much reserve? 20% reserve. Okay. Factor payment period guaranteed by factor is how much? 45 days. Easy. So here factor period is there. How much? 45 days. Be careful. Okay, on this. Now you'll do the calculation for 70 days or 45 days. But then some calculation you have to do for 70, some you have to do it for 45. I'll tell you in this problem what. Cost of capital is how much? Cost of capital for factor or company? For company, the cost of capital is 12.5. Okay. One time redundancy payment of 50,000 is required to be made to the factor. So one extra cost we have to pay to the factor. How much is that? 50,000. This we are receiving or paying.
Pay.
So I mean, this is what? Benefit or cost?
Cost.
So one extra cost called redundancy cost, they only given, how much is that? 50,000. Copied as it is. And now the same working note, they are asking us to assume how many days in a year? 360 days. You need to calculate effective cost of factoring. No decision, just effective cost of factoring. Sir, effective cost will come only when it is net annual benefit or net annual cost. Effective cost will only come when it is a net annual cost. But we will follow same pattern. Working note number 1. ACP. ACP we have to find or given? Given. Then next working note. What is next working note? Amount advanced by the factor. Give me a walkthrough. How will you find out that? First, debtor. From debtor you will reduce commission and you will reduce reserve. You will get amount available for advance. From that reduce interest. You will get amount advanced by the factor. Yes, sir. Now one by one components. First, how much is debtor? Given or not given? What is the credit sale? 7 crore 50 lakh is total sales. 90% is on credit, means what is credit sale? 6 crore 75 lakh is for 1 day or whole year? Whole year means how many days? 360 days. Yes, sir. Now 1 second, hang on. Okay. You are selling the debtor, or maybe I'll tell you one trick. Before, whenever they give you this period, no, when factoring period when they give, fill out one table. Company factor. Company factor. Whenever you're doing calculation from company's perspective, you will take company ka period. What is a company ka collection period? 70 days. So you will take 70 days and do the calculation. Whenever you're doing the calculation related to the factor, you will do which period? ACP or factor period? Factor period. So for company, company period. For factor, factoring period. Yes, sir, Sarji. Everybody good? Now this is for days. The percentage. How much interest factor is charging? How much interest factor is charging? 14%. So 14% interest you will take for what calculation? Factor. Okay, there's also one more. I'll fill it up in a bit. Okay, now. So have this column. Company factor. I think I've written that. Here, yes, your reference. Always fill out this data, company and factor. For company, the period is ACP. For factor, the period is factor period 45 in this problem. Okay. Interest rate, I'll tell you in a bit. Okay. Now, this debtor, what you got? This debtors, once again, will tell how much is the credit sale. Annual credit sale, how much? 675. This is for 1 day or whole year? Whole year. Whole year means 360 days in this problem. Now, you will multiply by 45 or 70. You will multiply by 45 or 70. Debtor, you are selling it to the factor. I mean, this is from whose perspective? Factor perspective. So you will take the numerator as ACP or factoring period. That's the reason I said first priority factoring period. If that is missing, ACP. So multiply. Tell me how much. Understood? Debtor we are selling to the factor. Whenever you're doing calculation for a factor, the period you will take it as 45. Okay, Naji? So calculate. How much is that? 84 lakh 37,500. That is the value of debtor you are planning to sell to your factor. Point number 1. Done now. Will factor give this or there is a commission? How much commission? I think 2%. Some way saw service charge or something. How much is that? 2%. And reserve is how much? 20%. So service charge 2% calculate. This number ka 2% is commission or service charge. And reserve is how much, people? 20%. Calculate this ka 20%. How much is that? 16 lakh 87,500. By doing this, what are you going to get? Amount available for advance. Any problem? Will factor give this amount or there is also interest? Reduce interest. Interest, who is charging? Company or factor? So whenever you're doing factor, you will take 70 days or factor period. Factor period is how much? 45 days. Calculate that. 65. Punch in the number in your calculator. 65 lakh 81,250. How much interest factor is charging? 14%. For 70 days or 45 days? So calculate. 65, 18, 250 into 14% interest for 45 days. But don't take 365. They asked us to take 360. How much is the interest? 1 lakh 15, 172. Are we comfortable? That means finally how much amount factor will give us? These two come minus. Finally, what is the amount advanced by the factor? 64 lakh 66,070. Simple thumb rule. Whenever you're doing calculation for factor, take what rate? 14%. Take what period? For factoring period of 45 days. But whenever you're doing calculations for a company, you'll take collection period of 70 days. Done, Aji? Okay. Now next statement. What is our next statement? Guide me. What is the next statement ka heading? Evaluation of factoring policy. Here they did not ask us to evaluate. They ask us to calculate factoring percentage. If you want, you can give that only as a heading, or this is also fine. Okay. So in this statement, first you will show all the benefit. Then you will show all the cost. Benefit was two things. What are those? Savings in bad debts, savings in administrative costs. This we have already captured. Done now. Alright. One more is there. Leave that. I'll come to it in a bit. Cost. What are the two? Here, in fact, there are three costs. What are those? Commission, as in service charge, interest, and also some redundancy cost of 50,000. But hang on. This particular commission is for, see, we know that all the number in the second working note should come on what? Factoring period or annualized basis. Now you know the logic of this, right? Because we want the annualized cost percentage. We want percentage on an annual basis. So that's the reason. Now this commission is for how many days? See, commission you are calculating on debtor. Debtor is for how many days? 45 days. So this commission of 1,68,750 is for how many days? 48 days. We want for 48 days or whole year? Whole year means 360. Proportionate that. 1,68,750 is for 45 days, means for 360 days how much? 13,50,000. That's your annualized factoring service charge or commission. Agreed on? That's it, or one more? Interest. How much is the interest? 115,172. This interest is for whole year or 45 days? So 115,172 is the interest for 45 days. For whole year 360 days, how much? Proportionate? 9,21,376. Redundancy cost they had only given copied as it is. Okay, Naji? Everybody good? Cool so far? There is one more saving. What is that is? Sir, what was the collection period when company was taking care of receivable? When company itself was collecting money from debtor, what was the collection period? 70 days. Now is the collection period 70 days or 45 days? That means factor is able to collect the money from debtors how many days early? Instead of 70, see, payment period guaranteed by factor is how much? 45 days. That means instead of 70 days now, because see, factor is a specialist in collection. See, our business, no, we are specialists maybe in manufacturing. When you run a business, no, our main focus will be to produce a quality product, right? Now, we are ArivuPro. Now, our focus will be what? To teach in the best possible way. Now, do you think our main focus will be to collect money from you? If you are not paid money, if you have not paid installment, so we also offer, I think, installment fee. Daily we'll call you, hey, you did not pay fees, you did not pay fees. No, because our priority is more towards the service. Similarly, company ka priority will be the product. Company ka that much expertise may not be there in collection, but factoring has only one job. Factor has only one job, which is what? Collecting the money. So they will put full efforts. So what we were able to collect in 70 days, factor is able to collect in 45 days. So how many days early factor is able to collect? 25 days. Yes, sir. That means your average collection period is same or it is reducing. How much it reduced by? 25 days. Clear? Now, if you are able to collect money from debtors faster, that means company can use that money to buy more and to sell more. Yes or no? If you are able to collect the money from your debtor faster, what will the company do with that money? They'll again use it to buy it and again sell it. Yes, sir. I mean, this is what is cost for the company or benefit. If collection period reduces for a company, it is the benefit. Last problem and all, this data was available or not available? Here it is available. Okay, now. So money is getting released how many days early? Here money is getting blocked or getting released? Early release. How many days early? Instead of 70, we are recovering now in 45 days means how many days early? 25 days. Okay, now. You remember opportunity cost? Now, if you are getting early money means you can invest and get extra return. You are sacrificing or you are getting extra return. I mean, this is opportunity cost as a benefit, as a cost or as a benefit. Benefit. That means it should come under the cost column or benefit angle. Benefit angle. Now, opportunity cost, will you calculate on credit sales or cost of sales? Cost of sale. But in this problem, cost is given or not given? If cost is not given, next best information is what? Credit sales. Yes, everybody. That means here we will calculate opportunity cost on total sales or credit sale. Ideally, we should calculate it on cost of sale. But is cost of sale available or not available? Now calculate. How much is the cost of sale? Rather, how much is the credit sale? 675 lakh. Understood, everybody? Pakka? Now, company can invest this money and earn return. How many days extra return they can earn? 25 days. How 25 days? Instead of 70, now they are collecting the money in 45 days. So, how many days early they are collecting the money? If they're getting the money early for 20 days, means they can invest for 20 days and earn a return. Who will earn the return? Factor or company? The factor is charging 14% interest rate. But what is the cost of capital to the company? 12.5%. Right? So if company takes any funds, how much interest they will pay? 12.5%. Now company is taking fund or investing? Investing. That means on investment also how much return they will expect? 12.5% return. That means you will calculate what? Into 12.5 by 100. How much is this? Calculate this number first. 675 lakh into 25 divided by 360 into 12.5 by 100. How much is that? 5,85,938. Got it? This is a cost for the company or benefit? Tell me why. How is the benefit? How is the benefit over here? Instead of 70 days, we are collecting in 45 days. So how many days early? 25 days. If you are collecting the money early, means we can invest the money and get how many days ka return? 25 days ka return. When company invest, we will get 14% interest or 12.5%. Factor is charging 14%. Now you're doing this. Who is investing this money? Factor or company? So for company, what is the percentage? That's what I've written here. For factor, interest rate is 14. For a company, what is the rate? 12.5%. So you will get 12.5% return. For how many days? 25 days. Ideally, you should calculate this on cost of sale. That is available or not available. Hence, we calculated this on what? Instead of cost of sale, we took next best number, which is credit sale. So this is benefit for the company. So this benefit will come only in one case. When what? When there is a reduction in ACP. If there in the collection, average collection period, if there is any reduction, then this number will come. Otherwise, it will not come. Done, people. That's a takeaway of this particular question. Okay. So now total benefit is this. Now normal format. Total benefit is 18 lakh. Total cost is how much? These three ka addition, which is 23 lakh. Total annual benefit 18.36. Total annual cost 23.21. So benefit is 18 lakh. Cost is 23 lakh. So what is it? Net annual benefit or net annual cost? These two ka minus. How much is that? Net annual cost. How much is that? 4,85,189. Now we want cost percentage. How do we get cost percentage? Simple formula is payment by receipt. How much are we paying? 485. What did we get from the factor? Amount advance. So calculate. The formula is basically net annual cost divided by amount advance by the factor. Net annual cost is 485. Amount advance by the factor is 64,66,078. What is the net cost? That's it. That's all it is about this. Okay, na Sarji? This is about factoring. Can we go for last one? 5 minutes wala question. Okay, this is a 2-marker MCQ question. Creditor management. What? Creditor management. Now we have to manage the creditor. Now, is there any advantage by delaying the payment to creditor? Instead of 30 days, if you make the payment to creditor on the 90th day, how many days did you delay the payment? Let's say we have to pay 10 lakh to the creditor. How many days did you delay? 60 days. That means what you can do? Company can utilize this 10 lakh for 60 days. And are they paying any interest or no interest? So by delaying the payment, advantages, it becomes a free source of fund. But disadvantage, loss of reputation. Creditor may increase the price of the goods. Creditor may stop supplying the goods on credit, or creditor may stop supplying the goods altogether. Okay, these are some disadvantages which we discussed. Now relating to creditor management, one MCQ question they can ask. 2-marker ka. What is? Sir, even creditor wants money early. Now let's say creditor has given 50 days credit. What is the credit period creditor has given? 50 days, I assume. Now creditor also has given one more option to us. If we pay within 10 days, if paid within 10 days, we will get 5% discount. We will get 5% discount. Done. Sir, what is the credit period we have got from our creditor? 50 days. But one more option creditor is saying, instead of 50 days, if you If we pay the creditor within 10 days, then we don't have to pay full amount. We will get 5% discount. Now, as a finance manager, you have to take a decision. What decision? Should we go for this discount offer or not? That's a problem. Okay, na, sir? And now this, what you have to do is you have to find out this discount for us. We are giving the discount or we are receiving the discount. So this is discount received means this is what? Cost or benefit? This benefit. You have to find out this benefit in percentage. For factoring, you found out cost in percentage. Similarly, here benefit you have to find it out in percentage. Same on an annualized basis, because we have to compare this benefit with some other benefit. Some other benefit will be on what platform? Annualized platform. Hence, you always get it on what? You get this on an annual benefit percentage. For this simple formula, if you want to get annual benefit percentage, it's simply given by the formula D divided by 100 minus D divided by 360 into 365 divided by T into 100. D divided by 100 minus D into 365 divided by T for Tom into 100. This is for percentage. It's written over here. Clear? This D is the discount. D is the discount. T is the early payment. T is the how many days early you need to pay to get this discount. That we call it as what, sir? T. T is the prepayment days. Now look at this example and tell me prepayment days here. What is T here? Can you tell me? What is T in this particular case? T for Tom. How much? Instead of paying within 50 days, we have to pay within 10 days. So how many days early we need to pay? 40 days early. So that becomes your T. Okay, sir. All right. Let's take up a small question to prove this, and then we will. Yeah. Well, I can wind up. RTP May 2018 wala question. I think it's there in study mat also now. A is in manufacturing business. Okay, their problem. Leave that. Payment must be made within how many days? So we are purchasing or we are acquiring raw material. When we acquire raw material, we have to make the payment to our creditor within how many days? 40 days. However, A Limited, us, we have a choice of paying how much? Right. 1 second. I think pen also took a break. Pen is not writing now. Give me a minute. Now it came back. You thought long break, huh? Okay. All right. So A Limited, us, we have a choice of paying how much? Huh? Screen gone, huh? Oh, now display gone, huh? Okay. One by one, everything is going, huh? Now came, huh? Another 5 minutes, Prabhu, everybody. Wait, huh? So we have a choice of paying how much? 98.5 per 100 rupees. Instead of paying 100, we have a choice of paying 98.5. So that means how much less we're going to pay. Instead of 100, we are paying 98.5 means how much less? 1.5. That is nothing but your D. D is your discount. You can calculate total discount or you can express it on 100 platform. It's fine. Either ways you do, answer will be same. So what is D? 1.5. But in order to get this discount, we have to make the payment within how many days? Credit period is how much? 40 days. But in order to get the discount, we have to pay within 10 days. So what is T? T is your prepayment. How many days early we need to make the payment? 30 days. How 30?
40 minutes.
Instead of paying on the 40th day, now we have to pay before 10th. That means we have to make the payment 30 days early. Agreed, sir? Now, this discount offer, should we take it or not is what we need to analyze. So we'll read this part later. Leave that. Calculate the annual benefit percentage. We have done it, but here once again we'll quickly do it off. Annual benefit percentage is given by what formula, people? D divided by 100 minus D into 365 divided by T into 100. What is D here? You can take total discount. Here how much totally we have to pay to the creditor? 10 lakh. Either we can take total and do it, or you can take this individual number and do it. Answer will be same. Individual is faster, so I'll prefer this. What is D? 1.5 divided by 100 minus D, 100 minus 1.5 into 365 divided by T. T is what here? Early payment days, which is 30 into 100. How much are you getting? Here it says 18.52 is what we got previously. You are also getting same number.
Yes.
18.52%. So what is this? This is the discount. This is the benefit expressed on in percentage. On what basis? Annualized. This is your annualized benefit percentage. Okay, sir. So if you take up the discount offer on an annual basis, how much benefit you will get? 18.5. And how much you have to pay to the creditor? 10 lakh. Okay, now read this line. Examine whether A should accept the discount offer. What is average billing? 10 lakh. Meaning 10 lakh we have to pay to the creditor. Okay. An alternative investment will yield how much return? 15%. Now people, if you have money, if you have extra money, as a finance manager, we have two choices. Either pay creditor and take discount offer, or invest. If you take discount offer, how much benefit you will get? 18.52% on an annual basis. If you don't pay the creditor, what will you do with that money? Invest. Investment will just give how much return? There's also benefit, but investment ka benefit is only 15%, but creditor ka benefit is 18%. So what will you go for? Will you go for investment option or creditor ka discount offer? So final answer here is creditor ka discount offer should be rejected or accepted. Accepted. How did you decide that? Because the annual discount benefit percentage is greater than the investment return. That is the reason this discount offer should be accepted. Either you can do it like this, or you can also do it on a full amount basis. Answer will be same. This also I have shown. Yes, sir, people. Now what is this? If you want to know the quickly logic of this, what is this is? Sir, are you paying 100 rupees to your creditor or 98.5? 98.5. How much benefit you are getting? How do you get GP percentage? Tell me what is the formula? GP divided by sales into 100. So here instead of GP, the benefit you are getting is discount. How much is the discount amount? 1.5. And are you paying 100 or 98.5? Okay. So express this in percentage. How much is this? GP upon sales into 100. Basically, you're paying one instead of you're paying 98.5 and getting a benefit of 1.5. How much is this? 1.52%. Agreed? Everybody good? Same like GP percentage. GP upon sales into 100. Here, GP is the benefit. What benefit here? Discount, which is 1.5. Divided by how much payment? Sir, regarding creditor, sales will come or amount paid to creditor will come? So substitute sale with amount paid to creditor. Are you paying 100 or 98.5? Now we want benefit in percentage. So we multiply by what? 100. Are we clear with this? Everybody okay? Yes. What percentage did you get? Again it went up. Okay. Now 1.52% you got. Yes. Now 1 minute. Hang on. 1.52% is a benefit you will get provided you make the payment to creditor how many days early? 30 days early. I mean this 1.52% is the benefit for whole year or 30 days. 30 days. But this investment ka return is for 30 days or whole year?
Whole year.
So for 30 days, 1.52% is a benefit means for 365 days, how much is a benefit? Proportionate that. 1.52 into 365 divided by 30. How much is that? 18. That is what this formula is trying to calculate. As a quick fix, understood? No, you don't have to know all this. For examination, quickly you can use what? Formula. Understood? So if that annual discount benefit percentage, if it is greater than investment return, then discount offer can be accepted. Suppose investment return is 25%. Investment return is 25%. Then what you will do? Creditor ka discount benefit is only 18.5. But investment ka if it is 25, then you will go for which option? Investment option. Discount offer should be rejected. Like that. Compare and accordingly take the exception or rejection. Okay. 1 minute. I'll just quickly check if I've covered everything which I wanted to have. Okay. More or less, I think everything is done. Okay. This one is there. I don't know. I think it's there in the MCQ section of study material. Main section they have removed. 1 minute. I'll quickly review off. There is something called maximum permissible banking finance. So how much maximum loan you can take from the bank? Sir, we are a company taking a loan from bank. There is one committee called Tandon Committee who recommended how much loan banks should give to the company. I mean, this is relevant for company or banks. But we are doing all this calculation for company. Hence in study material, this section they have removed. We had a question on this that they have removed. But I think in MCQ still they kept it somewhere. So quickly I will do it. This Tandon Committee, they have recommended. First of all, it is what again? This committee recommended how much loan bank can give to their customers. Working capital loan, how much maximum amount bank can give to their customer. They recommended three limits. First limit is 75%, all are 75%. 75% of net working capital. How do you get net working capital? From current asset, reduce current liability. Of that, you calculate what? 75%. This is first limit. Second limit is calculate 75% of current assets. Calculate 75% of current asset, then reduce current liability. This is one. Okay, it's more stricter and stricter and stricter. So if the organization ka credit rating, if it is good, we can go for method number 1. If organization ka credit rating is bad, they can go for either 2 or 3. So like this, each limit will give a lower amount. Okay, now based on the credit profile of the customer, banks may decide whether they want to go for method 1, method 2 or method 3. Method 1 is what? 75% of current asset minus current liability. Second method, 75% of current asset minus current liability. Third method, 75% of first from current asset reduce core current asset. From current asset reduce core. Core current asset means permanent. You remember permanent working capital we studied previously? Like minimum cash balance and all that. Suppose company wants to maintain minimum cash balance of 1 lakh. Okay. Now this you want to take bank loan or it should come from your pocket? This is permanent amount. No permanent funding and all. Will you take it from bank or it should come from company own promoters contribution? This we call it as core current asset. They will give you in the problem. Core current asset or permanent portion of current asset. From current asset reduce core current asset, CCA. Of that you multiply what? 75%. Then reduce what? Current liability. So third limit again, from current asset reduce core current asset, then multiply 75%. Then reduce what? Current liability. You will get. You just need to calculate the limits. Which limit bank will go for is the bank ka mercy there. This is not relevant for company. This is relevant for what? Banks, how much finance they can give to the company. So hence, it's okay. May not be that very important. Fine, Sarji. So yes, I think, 1 minute, anything else? No. Yes, people, all the questions and concepts I think I had in mind, we have covered. So took a little extra time. Apologies for that. Hopefully, whatever limited knowledge I have, I was able to kind of impart it to you and you found the sessions to be helpful. Okay. So now just everything I'll pass it on to you now. It's your total ball game. Okay. So I'm not saying only this marathon will help you in clearing examination. I don't know. Right. Some attempt what we do only can come. Some attempt what we do nothing can come. So I don't know. If it comes also, your grace, so your thing. If it doesn't come also, don't give galis to me. You only keep it. Fine. But at the end of the day, prepare as much as possible. Keep the confidence up high. I know you'll do well. There are still an umpteen number of time. 35-40 days is still a good number of time. Give your best. Don't focus on the negative aspect more now. Just always visualize on the positive side that we can make it. There are many people who have cleared exams within 25-30 days. So it's not a total mystery. Many people have done it. So maybe you are one among them. So till your examination, let's that be our motto. Okay. So let's give it our best. So I think I will leave it at that. So thank you for your wonderful time and patience. Take care. Thank you. Bye. Online also. Thank you, Pa. Some of you are still there. So that is great to see. Take care. See you. Bye bye.